Hello, everyone, and welcome to Infra4dev 2024. This is where we all clap. On behalf of the World Bank team, welcome to the conference, and we're so happy you could join us here in Morocco at UM6P, where we'll be discussing the future of infrastructure financing. My name is Erin Scrons. I'm Senior External Affairs Officer with the World Bank, and I'll be your guide through the next 2 days of programming. We have a packed schedule ahead of us, so I won't take long, but before we begin, you all know who I am now, and I'd like to get a sense of who's here with us in the room. So, real quick, if you're from the World Bank, will you raise your hand, please? Okay. And if you're here from university, UM6P, will you raise your hand? Okay. Yeah. Okay. Anyone else from neither of those places want to raise your hand? Welcome. Okay, thank you for joining. Okay, so we have a good mix of people here. Looking forward to getting started with the program. And I also, in addition to those of us here in the room, we also are live streaming this conference. So perhaps if everyone could just turn around and wave to our online audience and welcome them. If you're watching online, thank you for tuning in, and we want to hear from you, so please, your ideas, comments, questions, global solutions, we want to hear them. You can send them to me or share them on X with the hashtag Infra4dev. So with that out of the way, here's a roadmap for the morning. We will start here with our welcoming addresses and keynote addresses, our first keynote address. And then we will pause for a coffee break so we can all refuel for the rest of the panel discussions this morning. Okay, so please, if everyone can give a hand for our first speaker, our Vice President of Infrastructure at the World Bank, Guangxie Chen.
Good morning, or good afternoon for those maybe connecting online. Karim, very nice to have you here with us today, and dear colleagues and friends. It's really a pleasure and honor to welcome you all to this beautiful campus of Mohammed VI Polytechnic University for our 4th annual Infrastructure for Development Conference. This is organized in partnership with the university here in Rabat, Morocco. The Infrastructure for Development Conference is a series started 4-5 years ago. It's the initiative of the World Bank Group's Infrastructure Vice Presidency. The idea of this conference is to bring together leading-edge economic researchers and also policymakers, practitioners, and really to look at some frontier issues that confront the infrastructure sector. And this is very important for us because they will inform our work with our client countries in address some of those challenges. The Infrastructure Vice Presidency at the World Bank covers digital infrastructures, economic networks, and energy system, livable cities, and that's where we focus on. Of course, water and sanitation is part of the infrastructure as well. That's also covered for some of my colleagues at the World Bank. We all know that access to efficient and affordable transportation, water and sanitation, and also energy provide the necessary means for an opportunity to learn, to receive good quality of healthcare, access to education, and the business to operate efficiently. In addition, infrastructure also provides an important indirect effect through agglomeration of economy in cities, and that's created opportunity for ideas, innovations, and of course, education, health, and growth. This year's conference is being held at a very important juncture because never before over the last several decades that the development community is facing poly-crisis as we speak. This is talking about the multiple climate change challenges, of course, the geopolitical conflicts, ongoing wars, and then also a very lukewarm economic recovery since the pandemic crisis. And of course, not to mention the fact that we are in a much tighter financial conditions worldwide in meeting the development challenges. Just give some numbers as of 2023. The infrastructure need worldwide is huge. We're talking about over 1 billion people that live more than 2 kilometers away from an all-weather road. And about 685 million people still have no access to electricity, and 80% of that is in sub-Saharan Africa. 2.3 billion people lack clean cooking facility, meaning they still use traditional biomass as the means of cooking. And you know the health impact that on families, on kids, on women. 2.6 billion people have no access or not able to use internet, while we all take it for granted in many parts of the world. And something like 2 billion people also have no access to safely managed drinking water facilities. And another 3.6 billion people with no access to safely managed sanitation services. So this infrastructure gap is huge. Of course, much of this gap is in low-income or low-middle-income countries. But even in well-developed countries, some of the infrastructure gap also exists. And this is just talking about physical infrastructure. And then the other aspect of infrastructure is the quality of the infrastructure services. They're often not affordable to people at the lower income category of the societies, or are not reliable or bad qualities. A large population, a portion of the world's population lack energy connection. They actually live within the grid that is available. And we mentioned about the 2.6 billion people that have no or not using internet. They actually live in an area where there are mobile services or internet coverage, but not able to use them. So policymakers around the world are really, and also all of us at the World Bank working in this sector, are really grappling with the need on how we can support this critical infrastructure in different sectors and address all these challenges that I highlight above. Just 2 weeks ago at the World Bank Group and IMF spring meeting, we set out a very ambitious target. Our president, along with the AFDB president, set out a target that by 2030, we want to connect 300 million people in sub-Saharan Africa with electricity. And that's a very tall order. That's more than 50 million people that we want to provide access per year over the next 6.5 years. And if you look at our track record, we know this is a very ambitious target, but at the same time, it's very necessary. So delivering all these challenges really means that we need to find a way to bring resources to provide such a services. And this is where the theme of this particular conference today, which is the future of financing for infrastructure. For those of you that follow the World Bank's group's recent work, so-called the Evolution Roadmap, which is kind of a strategy to reinvent ourselves, to make us a better bank and a bigger bank to meet all these development challenges. We make some estimate. The estimate is that to meet all these needs, particularly the climate change and other needs, infrastructure need, we're talking about the need of something like $2.5 trillion per year by 2030. And I think for those that work in the infrastructure sector, you'll know that any estimate for the infrastructure gap being in energy transition, access, transport gap, are all estimated in the amount of trillions. Now, public sector don't really have that kind of resources to fill all this gap, being from multilateral development bank or from the government's fiscal resources. Which is why we need to find ways, innovative ways, to bring in resources to meet all this need. And again, this is the theme of the conferences today. I really hope that the different sessions of this conference over the next 2 days will actually really connect the policy practitioners, academic researchers, and really help us to find means to address some of these challenges, being in different way of mobilizing financing using different instruments or different practices. To that end, the video program is to include a mix of these sessions to addressing this need. With that, let me stop, but before I finish, I really want to also take this opportunity to highlight the fact that, as I mentioned, we started this series some 4 years ago, but this is the first time we're actually holding these conferences with one of our client, a university in our client countries, Morocco. The previous 3 sessions were in Toulouse School of Economics, London School of Economics, and UC Berkeley. And I think this also sort of signified that really our desire to connect really policymakers and researchers from developing world, the global south, to manage the challenge that are ahead of us. And with that, let me stop here and pass on to Corinne, who happened to be the executive president of the policy think tank for the New South. So thank you, Corinne.
Okay, thank you, Vice President Chen. Let me first welcome you at Mohammed VI Polytechnic University. This is great to have you here, and also transmit my salutation from our president, Hisham Al-Habdi, was supposed to do the opening here. He had to travel at the last minute. So welcome and thanks to our staff, your staff, Vice President Chen, your colleague, and the UMCSP colleagues that have put together this conference. I think this is part of an intense partnership that the university has with the bank in general. I'm a bit lost in my days that we used to be IFC, but in charge of infrastructure, but we won't get into that. I guess it's one bank, so it's one UM6P, so it's one partnership. I think it's interestingly getting more densified and intense. We have interns also and you know, training partnerships and, you know, in the broad sense. I would like also to commend you. Who has read the report? Frankly, who has not read the report? You should read it. It's a great piece. It's a great piece, and I don't know who are the authors, but it's a great piece, but it's a depressing piece. And I think I'll be in the panel in the afternoon, so I don't want to get into the substance of things, but there is something that is not working, and you're the most sort of operational people of the bank, facing the financial sector, the toughest people, with very strong incentive, very transactional, and I think we don't speak the same language. When I say we is Africa, Africa doesn't speak the language you're speaking. Doesn't speak the Basel IV language. Basel IV is not for us. I can't get into that, but the BIS is not working for the developing world. And we are seeing actually a huge sell-off of global banks leaving Africa. This very country, by the way, it's happening, but it's happening in many countries in Africa. Because of the regulations. So those who are doing the regulations, you know, I was at the central bank, now I'm a free man, I can tell you. It's those who are doing the regulation, the G7 countries, that's a little bit of the G20, but are not taking, you know, into account what it means, what is the impact for financing development in Africa. It's not only infrastructure. And I think if we want a larger bank, a better bank, financing infrastructure is there. It's the big chunk. It's the most difficult one. You know, it's long-term money. It has many complications, as are very well shown in the report. So I guess if there's something we need to try to achieve here, say, how can you guys speak, be the intermediary, be the advocates between some people that speak a language that the client doesn't understand? You're in the middle, And this is, I think, fundamentally the role of international institutions. Your decoders in between. I mean, the report says it all. Regulations, guarantees, governments, capacity, legal frameworks, end users. We can't complain there is no solvable demand in Africa. Of course, we're talking about low and middle income countries. Of course, that's not, Luxembourg, okay? So we need to find a solution. How can we, sort of find a solution which is a time inconsistency problem? We know that it is, it's a good profit in the long run, but in the short run, it's very difficult. Nobody will invest if there's no offtake in this sector, if those are government guarantee, etc. So I think I would like you to, to try to solve this complex issue. It needs to be simplified, I would see the bank as a platform sort of to intermediate that missing middle, that market failure. When we know that a country, most African country will have growth over the next 50, 70 years, that would be the double or triple the growth of advanced economy. There is no, that's gonna happen. And urbanization is about infrastructure. It's also urbanizing very closely, and it's happening within, the the need for us to do it smartly and with the lowest possible impact on climate. So this topic is really at the heart of the developmental challenges of Africa in a difficult context, and the paper does a good job in describing the context, but we understand it, macro, interest rates, etc. But this is, again, we need to find a mechanism. So I will invite you, since you're in Morocco, you're in a university that is looking at the world, it's looking at the world in a non-ideological way, in a friendly way, with these traditional partners of the North, but still looking at the interests of Africa and the South in general. So this is also the tone of our studies for students. So confident, comfortable, aware of the challenges, but also very passionate about the place of Africa and the future of Africa, in this world. So if there's anything we will try to send you back with, this is this idea that, guys, it's easy to do a deal. I don't want to mention the banks, but your usual counterparts, in some countries that are quite sophisticated, but it's harder, but it's more interesting. You'll have a stronger impact. If you want, this afternoon, we can say, I don't know if there's a speaker that will say something about how Morocco did it. It's an interesting model where the state has been very present in the middle of organizing that missing market, okay, using public enterprises, state-owned enterprises that have a sort of specific role to play. It has interesting results. It achieved, access for most Moroccans, for most network infrastructure, but it has also some, drawbacks. So I think these are interesting models in other countries as well, which I invite you also to focus on. It is, and I'll close on that, at the juncture of many things. It's at the juncture of public policies, at politics, because end users, prices to access to services. Let's not forget that in infrastructure, what is important is the service of the infrastructure. If we build this university and there's nobody in it, it will have zero productivity effect on this economy. It will have an aggregate demand effect when we build it and it's finished. So it's very political. How do you increase prices of electricity in a country like Morocco, water, etc.? So politics, public policies, the global world of finance that speaks its own language, that is not interested in getting into the nitty-gritties of Africa and the details. You know, the guy sitting there in Orange County doesn't care about us. It's so difficult to understand these guys. You know, so, and there's one thing that a bank provides is trust. Trust, you're a trusted institution. I can tell you, I'm on the other side, been there since 2005. The trust, and trust is what is most valuable, is what we miss in many countries today. Look at the political scene in many countries. The issue is trust. We don't trust each other anymore. You know, facts, invented things we're not able to discuss rationally, but when you're around governments, private sector, they behave. They behave and they trust you. They know you're not going to stab them in the back, you know, to cutthroat deals and stuff that happens in finance. So I want you to reflect on these ideas, which are not necessarily mine, but this is, I'm sharing with you what I get from the discussions we're having, because we've been highly involved in the discussion of the reform of the international financial architecture, and of course the financing of infrastructure and the reform of the bank, etc. So once again, many thanks. It's a pleasure. You should get closer, you know. It's like English soccer field. They're warmer than, you know, let's say German or French soccer fields, you know. So get closer, and if you want, maybe in the afternoon, I'll see with the organizer, if you want a warmer room, we have other spaces here where, depending on, you know, the technical facilities, but we can get something more of a round table given the number of people here. So once again, thank you for being here, and looking forward to exchange with you during this day. Thank you.
Thank you both for getting us started today. I'd like to welcome our first keynote up to the podium. Peter Blair Henry is the class of 1984 senior fellow at Stanford University's Hoover Institution, a senior fellow at Stanford's Freeman Spogli Institute for International Studies, and Dean Emeritus at New York University's Leonard N. Stern School of Business. He also leads the PhD Excellence Initiative, which is a program designed to address underrepresentation in economics with mentoring. So Peter, thank you for coming, and welcome to the podium. Oh, Stefan, I'm sorry I skipped you. Before that, Stefan Schraub, our chief economist.
Thank you. You already did part of my job, which is great. Thanks so much. So I have a few notes. I won't repeat. So I want to thank Guang and Karim for the grateful introduction. I mean, I'm really happy to see you all here. So I'm a bit stressed as well, obviously, as you can see. So this is the first conference in person we're doing, the first in a client country. I actually organized the first conference on the other side with Vivian, who's not here yet, but will be later, in Toulouse in 2019 when I was a professor there. So for me, it's kind of and I've repeated that so many times, sorry to say that again, but I was actually born in this country. So, you know, it's a lot of emotion coming together today. So just coming to our keynote speaker, I'm really, really happy to introduce Peter. I had a few notes. You'll say it. Peter is a fellow at Stanford University, Hoover's Institution, a senior fellow at Freeman Spogli Institute of International Studies. He used to be the dean at NYU, Leonard Stern Business School, and still dean emeritus. He was the youngest dean, and he set a record in fundraising there. I mean, as usual, when you introduce someone like Peter, you cannot go through the whole thing because it would take all the time that is actually dedicated to him. So he has a PhD from MIT. I was told he also has skills in basketball and American football. I mean, at least it's part of his bio. So. And I think Peter is a friend of the house and increasingly interacting with us. I think he's the ideal person to set the stage in terms of, you know, big ideas of what we need to understand in terms of the challenge of bringing finance to infrastructure, both from the public and the private sector. We had few very interesting discussions previously, and I'm very happy to have him here today. And please, Peter, the floor is yours.
Thank you, Stefan, and thank you to all of the organizers for having me here. It's a real pleasure. So I'm going to make sure my slides are in order here. Don't see anything yet. I get a little help there. So while we're waiting for the slides to go, let me just say that although slides are here. So just a little background, just to connect to things that Karim said. I sound very American, but my roots are in, as I like to say, the third world. I was born in Jamaica, moved to the United States in 1978. And so issues of development are personal for me. And over the course of my career, I've had the opportunity to learn enough economics to be able to sort of connect, as I like to say, the heart and the head. And the heart and the head are very much in play when we think about infrastructure issues in developing countries. So the title of what I want to talk to you about today is Private Finance for Public Priorities, Roads to Alignment. This is joint work with my colleagues Anusha Chari and Pablo Picardo, who are part of the Hoover Emerging Markets Working Group, and part, as Stefan alluded to, and I'll say more about this later, a bigger effort that's really getting more and more connected to colleagues and friends at the World Bank and elsewhere. All right, so my remarks this morning are motivated by three facts. As Vice President Chen said earlier, if you look around the world, there are roughly 1 billion people with no access to electricity, the vast majority of whom live in sub-Saharan Africa, where the working age population is growing rapidly at almost 3% per year. There are almost another 1 billion people who don't live closer than 2 kilometers to an all-season road. And then observation number 2, or fact number 2, is that in 2015, the World Bank made this claim. The World Bank made a claim that by moving from billions to trillions of private investment in infrastructure, that private capital in rich countries could do 3 things. 1, solve the infrastructure services gap, and it is a services gap, as Karim pointed out. 2, help achieve the Sustainable Development Goals. And 3, make money. Okay? So that's a threefold claim. All right? And so if we look at fact number, and then before getting to fact number 3, it's very important to think of this threefold claim the World Bank has made in the context of where we are today. So where do we find ourselves? We find ourselves with rising public debt. In particular, in emerging market and developing economies, we're seeing, once again, a cycle of debt, distress, either default or desire for debt relief, and a repetition of that cycle. Yet again, going back to the third world debt crisis. So the question is, how can we get out of this cycle? And if the World Bank's claim is true, then private finance could play some role in that. In particular, if you think about the budget constraints that governments are facing and the prospect of public debt actually being the source of financing for infrastructure investment, then the World Bank's claim in 2015, right, whether that claim actually has empirical basis or not, matters greatly. This is no small question. So, what do we know? Well, fact number 3 tells us that billions to trillions hasn't had much impact on private investment in emerging market and developing economy infrastructure. So the figure that you see, the orange line is the flow of foreign direct investment into African countries. And the blue line is the flow or the participation, private participation in infrastructure. And what you see from looking at that graph is that kind of pre-2015, right, if you do the averages, private participation in infrastructure is a fraction of FDI flows into Africa, or about 10%. Post-2015, post kind of this call to action, the number's 11%. So there's been no great surge, okay? So what I want to do with my time this morning is ask the question, is there a basis for the claim that the World Bank made in 2015 that there's money to be made in infrastructure in developing countries and good to be done? In other words, is it the case that it is both publicly efficient from the point of view of the countries that have the infrastructure services gap, and privately profitable from the point of view of rich country private capital to invest in infrastructure in emerging market and developing economies? So, to understand and get a sense of how we would evaluate such a claim, we need to have a framework. And I'm going to propose the very simple framework that Camille Gardner and I proposed or put forth in our December 2023 Journal of Economic Literature paper. So let's think about the World Bank's claim. The framework I'm going to share with you generalizes to any kind of infrastructure. It could be roads, it could be electricity, it could be schools, it could be water. I'm going to mostly speak about roads today. So start with the general point. When will it ask yourself the following questions? There are two questions you have to ask. Number one, when will it be publicly efficient for an emerging market, developing economy to say, build a road? Okay? And two, when will it be privately profitable? To answer the first question, imagine you're building a road. The question that the benevolent social planner has to ask is, well, given $1 of savings in a country, let's say Kenya, when is it efficient for the public sector to allocate that $1 of savings towards building a road? Well, the answer is, if the social rate of return on building that road exceeds the rate of return on private capital in Kenya, then it's going to be efficient to build a road, right? So if the rate of return on that road, let's call that RX, the social rate of return on infrastructure in that country, is higher than the rate of return on private capital, let's call that RK, that's efficient to allocate another $1 of savings towards that project. So look at the x-axis. The x-axis is a ratio of RX, which I like to call R public poor, to the ratio of the return on investment in the poor country. I call that R private poor. So if the ratio of R public poor is greater than the ratio of R public poor is greater than R private poor, in other words, if we're to the right of the vertical dashed line, then it makes sense, it's publicly efficient to invest in infrastructure. Now come to the second question. When is it efficient for rich country private capital to invest in that same road? Well, the relevant benchmark for rich country private capital is actually going to be not the rate of return on, the relevant benchmark for rich country private capital is not the rate of return on public capital in the rich country. Because we look at rich countries, what we find is that the rate of return on public capital is actually below the rate of return on private capital. So the relevant constraint is the rate of return on private capital. And so what matters then, from the social planner's perspective, is whether R public poor is greater than R private rich. So that's what's plotted on the y-axis, right? So if Rx is greater than Rx star, in other words, if we're above the horizontal dashed line, then we fall into, and we also satisfy the first constraint for public efficiency in the poor country, then we're in quadrant 1. In other words, the public efficiency criterion is a hurdle rate for domestic investment in infrastructure to be efficient, and the second constraint is a hurdle for foreign investment to be efficient. And so, so answering the question for a given type of infrastructure in a given country, the World Bank's claim is true if for that given type of infrastructure in a given country we fall into quadrant 1. So this framework provides kind of surprisingly simple clarity about how to ask the question, is it true? The challenge is going to be, given the clarity of the framework, what data do we have? And here we run into a problem. If you ask the question, how can you take this dual hurdle framework to the data and actually understand in which projects, in which countries, is the dual hurdle framework actually satisfied, and which projects in which countries fall into the quadrant 1 in the previous figure that I showed you? The first thing you need are data on the social rates of return to infrastructure. And it turns out that those data are antiquated. There are only systematic estimates of the rates of return on infrastructure across emerging market and developing economies are from 1985. So in the year 2000, the World Bank commissioned a white paper that was done by David Canning, who's a professor at the Harvard School of Public Health, and Ezra Benathan, who's now deceased. And they estimated social rates of return across 53 developing countries using cost data on the cost of infrastructure that was essentially from 1985. So for all practical purposes, our most recent estimates of the social rate of return on infrastructure in developing countries is roughly 40 years old. Okay? So the number one point I want you to take away from today is that the absence of data on both the rate of return, prospective rate of return to infrastructure, and also data on the hurdle rates, the required rates of return by investors, are the number one obstacle to actually answering the question, in what is it publicly efficient and privately profitable to invest? And without answering the what, the how doesn't get us very far. So it's important to think about different financing mechanisms, but without understanding what projects in what countries investment in infrastructure will actually drive growth, the financing discussions are essentially noise. Okay, so in the absence of updated data, what's true? Governments and investors are basically flying blind, right? So going back to the points that Karim made in his opening remarks, no data equals no rational prioritization of projects, right? So in the absence of systematic, publicly available, independently validated, and by the way, the best institution to provide the validation of that kind of data is in fact the World Bank, per Karim's earlier remarks about being a trusted institution. So in the absence of this information, what do we have? We have poor country leaders, think African governments in particular, claiming that suppliers of capital overstate the lending risks to those countries, okay? Thereby elevating the hurdle rates. And we have private investors, their supply of capital is based on demands for subsidies and guarantees associated with particular projects, rather than the underlying economics of these projects, right? And this is in large part driven by the absence of publicly available, independently validated data on which to base these discussions, okay? So what is the information that's required to actually have rational, fact-based discussions about which projects in which countries we could find both public efficiency and private profitability? Well, we need several things. We need social/economic rates of return at a macro level. At a micro level, we need financial rates of return, right? Because social rates of return give us a good sense of what's good for the economy, but we know private investors care about what they can appropriate, so financial returns are gonna be very important as well. And we need estimates of the risk-adjusted cost of capital. Now, I should say, private investors are in the best position to estimate their own required rates of return. But there is still a role for public purveyors, public bodies, right? Just think of the recent release of GEMS data, for instance, to provide more clarity, more transparency about potential default rates, right? So whereas private investors, whether it be CalPERS or pick your favorite sovereign wealth fund, they're in the best position to make a determination about their required rate of return. But their risk-adjusted cost of capital still needs to be fact-based. And information about historical default rates, for instance, will play a significant role in doing those calculations. So in the absence of, again, publicly available, transparent information about the relevant underlying rates of default, those risk-adjusted rates of return may not reflect underlying reality. Okay, so what's the solution? Okay, so the solution we're proposing is a new collaboration between the Hoover Emerging Markets Working Group, the Inter-American Development Bank, and the World Bank Group. So we call it Learning from Lending. And what is learning from lending? Learning from lending is going to be an effort to pull together all the data we have, historical data, to learn as much as we can about past lending in the form of both debt and equity to emerging market and developing economies for infrastructure projects. Okay? So the goal is to provide a country sector-specific database on one, social, economic, financial rates of return, and two, the cost of capital for infrastructure projects that can catalyze publicly efficient, privately profitable investments. So the goal going forward, we will be kind of scouring all corners of the bank, the IFC, the World Bank, DEC-RG, our partners in Dime, Stefan's group. We look forward to working with all of our friends and colleagues at the bank to pull together whatever information we can to shed light to produce a publicly available database that provides this kind of information. So when we think about the social/economic rates of return on roads, I'm going to provide you with just a high-level overview of what my co-authors and I have found so far as we've just begun to basically try to update the data from that other earlier study that I mentioned. So what do you find? When you look at the social rate of return on infrastructure, and just think of that as essentially you're estimating the marginal product of infrastructure, the marginal product of GDP, the elasticity of GDP with respect to infrastructure, which gives you the marginal product of infrastructure. And you basically want to look at that relative to the price or cost of infrastructure. That's essentially how you get the return. So what you find is that there's a high mean and high median, but there's also really high variance, right? Both across countries and across projects. So in other words, there's some evidence to support the World Bank's claim, but you have to be very careful because there's a great deal of variation across projects and across countries. And there's high variation both in the marginal product of infrastructure across countries and projects, and there's high variation in cost as well. And so what I'll do with the remainder of my time is just to give you a little bit of a flavor of what do we mean by high, how big are these numbers, so what should we care, right? And give you a sense of just how big the variation is. Okay, so this is really just beginning, but I want to give you a flavor of what might be possible with more data. Okay, so let's do a thought experiment to think about how big might the opportunity be to generate, public efficiency and private profitability in infrastructure in emerging market and developing economies? So I want you to do the following thought experiment and go back, almost 40 years to the point in time where emerging market and developing economies weren't called emerging market and developing economies. They were called third world countries. And specifically before those countries that were called third world countries allowed foreign investors to hold shares in their equity markets. Okay, so this is kind of mid-1980s. And the IFC actually pioneered the Emerging Markets Database, which is actually how I cut my teeth as a graduate student working on the Emerging Markets Database, to think about what was the expected return differential between holding stocks in advanced economy markets, let's say the United States, and what you could earn if you could actually legally invest in portfolio equity in, say, Mexico, Argentina, Brazil, or South Korea. So go back to sort of the late 1980s, before stock market liberalization occurred in these countries, and look at the earnings price ratio. If you looked at the earnings price ratio in local markets in emerging economies at that time, it was about 1.7 times the earnings price ratio in advanced economy markets. So in other words, the excess return was about 1.7x, okay? And once liberalization occurred, right, we actually saw large flows of portfolio equity going from rich countries to poor countries. Contrary to what Lucas said in his 1990 paper, we actually saw capital flowing from rich to poor countries. Flowing to rich to poor countries to basically arbitrage away that 1.7x differential, right? And that differential has basically gone away, okay? And in its wake, created a $2 trillion industry called emerging market equity. So as a frame of reference, think about a 1.7x return differential was large enough to generate a $2 trillion industry in emerging market equity. So take that as a frame of reference. Now ask the question, how big are the potential excess returns on poor country infrastructure? Well, so far this is what we find. So let's take the case of two-lane highways. So for two-lane highways, we estimate the return on infrastructure. We do it essentially by estimate an aggregate production function. You can use a Cobb-Douglas specification, translog specification. I won't go into the details, but once you do that, right, and you look at the marginal product of infrastructure relative to the price, across 72 projects in 11 countries so far, we find that the ratio, going back to the dual hurdle framework that I showed you, of our public poor to our private rich in two-lane highways is about 28. And when you take 28, the ratio of Rx to RK star, or our public poor to our private rich, and divide that by the 1.7x excess return that I told you existed in emerging market equity, what you find is that the mean excess return is about 17 times as high in roads as it was in emerging market equity. That's a big number. That's a very big number, okay? Now, I know there's some investors in the room. Before you get too excited, okay, there's also a lot of variance, okay? But what these raw data are telling us, right, is there's something there to think about, right? And there's a lot of variation across countries as well. So, and I'll talk about that in a second. So this excess return, whether it's going to be kind of a marketable or sort of, a tradable opportunity in terms of actually thinking about how to create, publicly traded assets or how to securitize this, we think of these calculations as giving orders of magnitude that can allow us to think about when, in what kinds of assets, in what countries, is this a worthwhile conversation, versus having a conversation about the need first to just address underlying macroeconomic fundamentals, to essentially get the rate of return on infrastructure to a higher level where this is a more fruitful conversation. Okay, so that just gives you a sense of how big the numbers are and how much variation there is. So we've done this so far for two-lane highways. We also do it for road reconstruction. And you can see the road reconstruction numbers. The numbers are even bigger. Okay. But just to give you a sense of how cautious you need to be, aggregate estimates mask a lot of variation across countries and road projects, right? So for example, for two-lane highways, what you find, the rate of return for Indonesia is as high as 30%, Senegal is 200%, Bolivia, actually minus 50%, Kazakhstan minus 29%. So it just gives you a sense of the range, okay? And what drives the variation? Is it marginal products, marginal costs? Is it temporal? Is it cross-sectional? One example, in the case of Bolivia, you find there's a very high marginal product of infrastructure on two-lane highways, but it turns out MPX over PX is low because PX is very high. You know, why might that be? You know, one hypothesis, just kind of a working hypothesis, we haven't actually explored it in any detail. Bolivia is a very mountainous country. Bolivia is a very mountainous country, so building highways is very expensive. So this one example just begins to give you a sense of what you can learn by doing this more granular analysis, right? To distinguish between countries and projects, what's possible. So to give you just a sense of some of the granularity that are in the data, about which there'll be a lot more learning to do as we go forward. I hear some of my rural bank colleagues talking to each other. They're aware of the ROCS database, right? So this is a road construction knowledge systems database. And so co-authors and I have just kind of dug into the database and began to really say, okay, what can we actually learn to actually piece together the data on road construction costs, okay? And so the main point of showing you this, this slide is just to show you how many different types of roads there are, right? So the Canning and Beneath and initial estimates from 2000 were for just for paved roads, but there are many kinds of paved roads, right? There's new construction, there's maintenance, there's local roads, there's highways, and so in order to really understand, again, going back to the big point, right? What are the prospective rates of return? And what are the required rates of return? In order to determine whether the prospective rates of return exceed the hurdle rate, it really matters what kind of road you're talking about. Just to give you a little more sense of the data, I'm going to actually turn to the screen so I can see the dots in front of me are a little too small. Bolivia. So if you this is just giving you a sense of the marginal product of infrastructure in two-lane highways and reconstruction for a variety of countries that are in the ROCS database. And I would just point you to Bolivia, which you can see is roughly at the same level of MPX as Indonesia, right? If you look at the marginal product of infrastructure in terms of how much GDP is generated per each additional kilometer of roads, and you go back to the estimates, right? You see Indonesia had a 30% rate of return, Bolivia is minus 50%. Well, why is that when they roughly have the same MPX? Well, the reason is the costs are very, very different, right? So you can see Bolivia way up near the top in terms of road construction costs, in terms of building a new two-lane highway. It's more than twice as expensive per kilometer as Indonesia, right? So this may not be surprising to anyone who's been to Bolivia, but the point is, by getting into the data and really pulling the data apart, we can begin to really understand how to think about these issues. And I want to just take you back very briefly to this simple schematic. So we're really trying to identify those projects and countries that land in quadrant 1. And I won't go through it in detail, but in the paper with Camille Gardner, we talk about what's going on all these different quadrants. And in particular, I would just point out quadrant 2 is an interesting case of countries where the domestic hurdle is cleared. In other words, it would be publicly efficient to invest in an infrastructure project, but the rate of return isn't high enough to attract foreign investment. These are projects in countries that are, in principle, candidates for aid of some kind, right? And so it isn't so the fact that you've got some countries with projects that would be publicly efficient but aren't privately profitable doesn't mean they shouldn't be done. But this schematic gives us a way of thinking about what are those projects that are actually potentially feasible attractors of private capital, right? Versus those that actually are going to require some sort of non-market financing. And just by beginning to sort of separate these things apart, we can begin to move to more rational use of, more efficient use of public funds. All right, so let me wrap up. So what do we learn? So for certain projects, private rich capital does appear to have the potential to earn large excess returns in publicly efficient poor country infrastructure investments. Right? There's some evidence to suggest that this is a real possibility. Okay? But there's enormous variation across countries and projects. So there's a lot more work that we need to do. And what I'd like to submit to this audience is that learning from lending has the promise to increase understanding and catalyze real activity by providing what I would consider to be updated ingredients to use in this recipe of the dual hurdle framework to understand which projects in which countries actually satisfy those conditions. And there's a lot of good work that's already being done in the bank. You know, I point out, I recently had the opportunity to review a concept note that Stefan and his team had put together, so Rabat et al., 2024, point to a number of advances in how we think about data and how we think about going from micro data to macro data and how to think about using estimates across a wide range of studies, basically taking kind of meta approaches to think about how we extrapolate across studies to get parameter estimates that can give us a sense of how to make the most of the data that are available to us. And one can imagine, as learning from lending begins to collect more data on things like financial rates of return on various kinds of projects, getting us closer and closer to being able to answer, I think, the fundamental question, which is for a given project and a given hurdle rate, right? And I know that Shomik Lal and Maria Vajilasindi, in their new working paper, which I encourage you to take a look at, are trying to get more granular with actually looking at how hurdle rates are determined, for instance, in renewable energy, right? Because hurdle rates are going to vary by country, by project, by investor. But as we begin to get more granular data, both about prospective returns and data about required rates of return, in some sense, the kind of the North Star we want to be able to, that we should be thinking about is, what would you have to believe about a given project in a given country in order to think that the economic rates of return, the social rates of return, are high enough to clear that hurdle rate? And in order to answer that question, we're going to need to look at social rates of return, we're going to need to look at financial rates of return, we're going to need to look at economic rates of return, and we're going to need lots of different techniques to help us not come up with a point estimate, but to help us realistically answer the question, what would you have to believe in order to think that there's economic surplus, a rate of return, prospective rate of return that exceeds the required rate of return? So learning from lending can help us learn, and by providing data, we provide a basis for more rational discussion about what projects in what countries will actually deliver publicly efficient, privately profitable investment, and then there'll be lots of work to do about how to finance it. I'll stop there. Thank you. Sorry. Q&A.
Do you have any questions? We have a minute or two before the coffee break, so. Yes, we have microphones. We can pass out.
Anyone? Or in the back?
I think there's a microphone working its way back to you.
If I followed right, and maybe I'm slow, we were talking a lot about the social returns to infrastructure. So can you talk a little bit about the distinction between social returns and private returns, and how that kind of changes the incentives for investors?
Yes, yes. So just kind of go back to basic definition. So the social rate of return, in the absence of externalities, is basically the economic rate of return. But of course, what investors care about is the private return, the financial rate of return. But we want to start by thinking of the economic rate of return because we first want to understand whether they're surplus, right? So if they're surplus, if those gaps are large enough, if the hurdle rate's cleared by a large enough gap, then it's, that's sort of, I think that is a necessary condition for those projects, us wanting to get those projects done. But then that's why we also need to have information on financial rates of return, which is why I think the microdata can be very helpful. So for instance, looking at past financial rates of return in various kinds of infrastructure projects that the IFC has financed in the past. And of course, past returns, you know, as any investment prospectus will tell you, is not a predictor of future returns, okay? But we know how to think about project characteristics, country characteristics, right? To get some basis for what financial returns have, particularly if you have past projects and you calculate both the economic returns and the financial returns on those given projects, that can tell you something about the level of appropriability on those particular projects, especially when you have project-specific characteristics. And so if you kind of build out that world of data, again, using the kind of meta-analysis that Stefan's group and others are advocating to just help us think sensibly about the data, we can begin to make some progress in understanding whether appropriability, A, is there surplus, and B, what the appropriability is likely to be or not be in particular projects in particular countries. Got some questions over here.
You hear me? Yeah, okay,
Yes, I
it
hear
works now. Yeah, thank you very much. I mean, that was fascinating. And I think the big issue now is how to monetize those social returns, those future social returns, so that we could use this value upfront for financing projects. We have a few tools in, like land value capture, tax incremental finance. Do you think those sort of tools could be used to monetize future social value of projects?
Yeah,
Thank you.
It's an excellent question. And the short answer is yes, and we're going to need many different kinds of tools. And so the main point is, first is the what, second comes the how, right? And the how is very important, because without the how, you can't capture those, that surplus. But we're going to need, I think, lots of different approaches. For instance, Karim spoke earlier and talked about the trickiness of the business model. So depending on the type of infrastructure, you have to think about the end user and what the end user is willing to pay, and the political challenges associated with that. Which is why I go back to kind of the North Star guiding all this is, what would you have to believe right? In order to think that the surplus is large enough that it's worth having essentially a monetization, asset creation conversation, right? But as of right now, we're way behind where we need to be because we don't even have the basic estimates of the economic value.
Thanks so much. I really thank you for this particular framework, talking about the quadrant. This is a question, what I don't see is the quadrant on the left upper, where you can, what you call clear domestic hurdle. No, failed domestic hurdle, but clear foreign investments. I have trouble understand what kind of project that could be in that particular quadrant. That's one. Just a question, but I think it's a great framework to think about. But I do want to make one clarification, because you make it that point several times. I don't think we make a claim in 2015 or billion to Chilean, because we make an appeal, because we know that we don't have the Chileans, but the need is in the Chileans. Because I think I want to make that point because that particular appeal is still valid today. I mean, the need out there is in the Chileans. But if you look at all the publicly available resources, MDBs, emerging market economies, and their own public finance resources, they are in the billions. So how do we fill that gap? That was how we appeal make that appeal. Because that was a time, as you remember, we transitioned from MDG to SDG.
Yes.
We set out the SDG goal, and then we realized the SDG goals is requiring trillions of dollars, but we don't have that. That's why we make that appeal. Thank you.
Yeah, thank you.
Thank you very much. I mean, we discussed the framework a couple of years earlier, and I'm glad to see you have made a lot of progress on it, and additional work is coming. I think we welcome the work that you're going to be doing. I think we need this calculation of social rate of return, et cetera, et cetera. But if I was to be provocative, given the needs that Guang alluded to, we're talking about billions of people without these basic services. So the question would be, why do we need to waste time doing the prioritization exercise? Because we know what to do to bring services to these people. So the question is really, how do you get policymakers to follow that prioritization principle?
Yeah.
In a world where what the voters are asking them, bring me services.
Yep. It's the right question. I would say, in a word, 2 words: resource constraints. Right. So there's a huge demand for services, and limited resources, and we know, since at least the late 1970s, that emerging market and developing economy governments have had challenges allocating resources efficiently. So what I would say is the following. What this framework allows us to do is to take what I would call a portfolio approach to thinking about the role that private investment can play in helping the public sector align its public spending with the public's priorities, in the following sense. Right, so there may be services, demand for services, that don't clear the dual hurdle criteria. Okay? And so, which isn't to say that just because something's not economically justified, doesn't mean it isn't socially justified. But if every project you pursue is not economically efficient, right, you're going to find yourself in a debt crisis pretty quickly. And what this framework does is it gives you a way of distinguishing, right, those projects that can actually attract private funding, right? So it's just a discriminant that allows you to have a more, again, a rational conversation about where can we actually realistically attract private capital, and be even more thoughtful about how we meet legitimate social demands in a way that's economically sustainable over time. So thank you, it's a great question. I think Maria has a question.
No, thank you so much for the fascinating and inspiring presentation. My question is, on one hand, you highlighted in your framework quadrant 2, which for us is very important, because in that case, in some cases, even for, say, middle-income country, that might pose a case that there might be, for some area or for some project, which are extremely important and socially viable, that might be the need of concessional finance, which is very important. That would be my first question. My second question is following up what Guang was saying. On quadrant 3, where it fails both hurdle, I think that even there is a need for, the analysis is very complex, to disentangle two polar cases. That might be a case, say, for high-income country or upper middle-income country, where, perhaps the private investment is so vibrant that, in a sense, countries are already well endowed in that type of infrastructure. So that might be one reason why the hurdle are not. But on the other hand, there can be a poor country with an extremely poor investment climate that doesn't attract, but is undercapitalized. So in a sense, these are the kind of countries where we are facing challenges because the investment climate is not enough to attract private investment. Can you tell us a little bit more what can be done, afterwards? Assuming, it's already a huge challenge to keep all the data and distinguish between the 4 quadrants, but particularly those two. Thank you so much.
Yeah, no, thank you. You just give an excellent description of what's going on in those quadrants, which we talk about in some detail in the paper. And it's important to make those distinctions because in countries that have really poor investment climates, the issue is not so much infrastructure per se, but it's about the policy challenges of how do you create an environment in which both public investment and private investment have higher value for money, right? And so again, the purpose of this analysis is not to say we should, ignore some need or the other, but it's to just sort of be more precise about what the challenges are. Yeah.
First of all, thanks a lot, that was great. And I think it is really important even more today because the cost of capital has gone up. I think part of the reason probably that we weren't paying so much attention on the data and the rates of returns is because for almost a couple of decades, the cost of capital globally tended to be pretty low, historic lows. So I think this type of work today is even more important. But my question is, when I see such huge variations, I'm really worried about the quality of the underlying data. So I wanted to ask you, how confident are we? Why is it such huge variations in the underlying data? And especially when you put, costs or prices in the denominator, that makes me really, really worried about infrastructure. So I just wanted to see how you think about that. Thank you.
Think about it very carefully. I think those are absolutely the right questions. We're calling it learning from lending for a reason. No, but in all seriousness, we think of these initial results as just illustrative, which is to say, okay, there seems to be something in the data. Now we've got to get really serious about that North Star question. What would you have to believe, right? And how noisy are the data? By looking at different types of data, for different kinds of projects within a given country, one can begin to get at your question. Okay, what's really going on here? How reliable are the data really? Is it plausible? And so the question is right, and the approach has to be, frankly, a big part of what we're trying to do with this approach is just bring more realism into the conversation. Calls to action are good, but there has to be a culture of realism, right? Because the key thing is to get reliable data someplace to show that this can work somewhere. And then things can work in a non-linear way. If you can demonstrate the viability of both delivering the data and then actually making decisions on the basis of that data, and if it delivers results, that can have a pretty rapid effect pretty quickly. But in the absence of information, it's guesswork.
I think I have the right to the last question. So I'm glad it's generated a really lively conversation. I knew it would, actually, and you're a great advocate for also for the work we're trying to do.
It's very important work your group's doing.
I think one thing you didn't say, but I know is behind that because we discussed it before, is obviously there's this need to have this one-shot, picture of the situation and where our project in this different quadrant, and the questions went to that point. But behind that, there's this dynamic question of how do we shift project from one quadrant to the other, right? How we design them better, how we, etc., which is also very important. It's a maybe even more difficult question to crack, but it's a really important one as well. Yeah.
It's a very important question, and it's why we're particularly excited about the collaboration with the World Bank, because we've got our colleagues at DECRG, colleagues at Infrastructure, colleagues in DIME, and to your point, Stefan, there's the spirit of this analysis is to say, okay, taking everything else as given, right? What can we say ex ante about prospective rates of return? But we know, for instance, from impact evaluation work that the folks in DIME do, that for a given project, depending on how it's implemented, right, changing procurement costs, improving road safety, all these things can have an impact on the ex post rate of return, which is why you need, frankly, horizontal thinking across groups within the bank, working together, thinking about those kinds of issues, thinking about complementarities, right? Thinking about road networks, right? Given a road that's already in place, what's the margin of value of where you place another one? So there are all these very complex questions that, frankly, to going back to the point that Karim was making earlier, the World Bank is uniquely positioned to help answer these questions. And so I'm hoping as an outsider, but hopefully a welcomed outsider from the from the bank, that will cause some good trouble by working across groups to help us make progress on these issues. And I really look forward to working with you, Stefan, and with your colleagues at the bank on learning from lending and building out data and making progress. Thank you.
Okay, thank you to Peter and our speakers this morning, giving us a lot to think about. Good start to the day. So let's take a short break for coffee. Please come back here in 15 minutes, so about 10:45. Thank you. and ready to go for the rest of our morning. So we will start with our first our first panel session, led by our fearless moderator, Christine, on the global infrastructure financing landscape. So I'll leave it to you, Christine. Thank you.
It works? Yeah. Thank you, Erin. I'm Christine Chiang. I'm the Director for Digital Development in the Infrastructure VPU at the World Bank. So I'm really honored. It's a pleasure to moderate this session. As you know, the theme of this year's Infra4dev conference is the future of infrastructure financing. So we'll start this panel by discussing the current state of the infrastructure financing. So hopefully that set the stage for the discussions in future sessions and panels. And I want to thank Stefan for asking me to moderate this session, not only because the panelists are distinguished experts in their respective areas, but also because I've known two of them for more than 20 years. So it's really great. And for this panel session, we will start with a presentation by each of them. So each has maybe 15, 20 minutes. And afterwards, we will do a Q&A. And maybe we can introduce each of them right before they make their presentation. So ask Henry to start the presentation. And Henry Blas, next to me, Henry joined the Global Infrastructure Hub in 2020 as the Chief Content Officer, and he has been leading the strategy and research and the development of tools and products for the Infrastructure Hub. Prior to joining the GI Hub, Henry was the Resilience Finance Lead and acting COO for the Global Resilient Cities Network. This was an initiative across 100 cities pioneered by the Rockefeller Foundation. He had previously been also leading ECOM infrastructure advisory practice in Asia, advising on asset valuations and acquisition for Macquarie in North America, and consulting on transport projects across Europe and APAC for Sistra. So today, Henry will present findings about investment in infrastructure, cost of capital, and much more from a number of sources, including from the Global Infrastructure Hub, Infra Tracker, and other sources. Henry.
The button, obviously. I'm new, as you can see. So just before I start the presentation, so we've actually just joined the bank PF about a month and a half ago, and so very happy to be able to sort of share slides. So those slides were actually initially presented at the G20, so they were developed at the request of G20 to inform them on global infrastructure trends, and so we thought with Stefan that'd be interesting to sort of share that with this group as the sort of first presentation. My objective is also to, as I say, we're relatively new, sort of see which data set analysis could be useful to all the operation of the bank, so that we can continue the work that we're currently doing with partners. So there'll be a lot of numbers. Apologies for that. It will not be a lot of inspiring pictures, but hopefully that will still it'll be very interesting to you. So let's get started. This first slide. Do I need to press? There was a clicker. All right. I'm very new, clearly. All right. So as I said, the objective is to present to everyone, I guess, the best infrastructure data trends that we could find. And I want to emphasize here, a big disclaimer for everything they're going to see. Obviously, there's no perfect infrastructure data globally, but we've tried to sort of, with the help of partners, try to sort of bring the best that we could find for some of the key priorities of the G20, which are very much aligned. with the priority of the bank as well. And as I say, it's also a way for me to potentially refine a future work program. So here you can see all the different partners that we sort of use to develop those trends. All right, so I'm going to organize, to be about 3 key global trends, to be organized across 3 things. Macro trends, private capital, which is obviously one of the key objectives, and what we call loosely outcomes, sustainability, inclusivity, etc., for which unfortunately the data is not as good, you'll see. So let's start it on the macro trends. I think the first one that we looked at was very basically how much does it cost to actually build infrastructure. We've all read sort of recently, I mean, the last few years, changes in supply chains, increase in materials, labor costs, etc. So what we did was very simply take data from all the G20 countries and look at the official data sets, what they call, cost of building infrastructure. Doesn't necessarily mean that this is the actual cost. Obviously, there's other things that come on top, but this is the official data. And where we can see what's kind of interesting is that while in the past, it was fairly much aligned with GDP, deflator or broader inflation or NCPI, slightly faster, but broadly aligned. Since COVID, and even more so since 2020-21, actually the increase has been very, very, very significant. So what it means is that the building infrastructure today, in real terms, is significantly more expensive than it used to be. And so I think that's something that we need to keep in mind when we look at benchmarks and we sort of compare with it between countries. Things have changed really, really significantly. And the spread is quite big as well. So it's actually some countries, we've seen 30% real terms increase in building infrastructure. There's not a whole lot of difference between developed and emerging markets as far as we could tell, but between markets, there's a huge difference. So it's something to keep in mind, and you'll see that in the rest of the presentation, what we've done is actually try to limit a little bit the nominal issue, which is comparing nominal numbers can be quite difficult, especially with the high inflation on top of this real inflation. So we've used percentage of GDP as much as possible in order to sort of present different numbers. So second slide, the one that we keep hearing about, the infrastructure investment gap. So here what we've done is we've looked at the IEA, the ITF, etc. So we look at the best estimates that we could find on total investment in infrastructure. That's not private, that's not government, that's all of it, SOEs, etc., corporates. Those numbers we have better numbers, I guess, in developed countries than we have in emerging countries, but those are sort of the best estimates. And what we can see is a couple of trends here is that as a percentage of GDP, there was definitely an increase post-2000, but since then we have been pretty flat. The nominal numbers have increased, obviously, with inflation, but when you compare that to GDP, actually it hasn't that much. We're still stuck at sort of 4.5% of GDP, but that includes social. So that if you compare to some other reports, usually social is not part of it. So if you look at the core infrastructure, we're closer to sort of 3.5%. All right. One clear trend is that when you look at total investment, the emerging markets share has grown, especially driven by countries in Asia and other places. And so they do represent a sizable part of the total investment at the moment. Something you'll see we don't necessarily find when we look at private sector. But at least there's total investment, that's what we get. So that's today. And if we look at the future, what it will take to close in the infrastructure investment gap, there's a lot of different studies. You probably have all seen McKinsey and others. The World Bank has his own estimate as well. So what we've done is just taken the sort of the big one and taken an average. And what we can see is that's a very sizable gap, obviously. To make matters worse, we have more and more estimates that comes in terms of the amount of infrastructure has been destroyed every year by climate change. And the latest estimate from CDRI are almost close to 1%. That's a pretty depressing number. So while we're trying to sort of increase things from 3.5 to around sort of 6 to 7%, actually we might be on track to losing 1% every year. So it's pretty bleak. And I think here I think the main message is obviously that prioritizing projects, the right projects, is very important, especially when it comes to resilience, but not only. I think it's just need to make sure that we put the dollars where it can create the best benefits, because realistically to go from 3.5 to 6 to 7%, it's probably not going to happen overnight, right? So I think project preparation, and I think the role of the bank in sort of helping countries identifying the right project is critical. All right, so that was a very, very high level on sort of the broad context, and I'm sure many of you are sort of familiar with those issues. Now let's move into private capital. I'm going to try to keep the level of details relatively low because there'd be great conversation or a great presentation after that by my two fellow panelists on the actual private capital mobilization. So the first one, and we heard about it in the presentation before, is the cost of capital. We don't have amazing data, but we have great data. So luckily, we have some private sector players that actually are working mostly with unlisted funds, but they also incorporate listed equities as well. And they've been able to sort of, they have about 7,000 companies that they use as benchmarks. They've been able to sort of look at the evolution of cost of capital. And indeed, what we can see here is that since 2018, the rise has been very, very significant. There's actually been two slightly different waves. The first one was more equity, actually, post-COVID. So we saw equity sort of gone up quite a lot. And obviously, since the interest rate have gone up, the debt has sort of gone up as well. So overall, very significant increase in cost of capital has been sort of stabilizing a little bit in sort of the last year or so. But clearly something that we need to take into account when we discuss with the private sector. Things have changed. This is not the market that it was pre-COVID in that sense. The better news, I guess, is when we look at the differential between emerging markets and developed countries. The difference has not increased significantly since COVID. Now, the caveat there is obviously that some investors have actually sort of started to invest less in sort of lower income. So there might be a sort of sample sort of change as well. But overall, there's no like an increasing gap, which at some point we thought it would happen. All right. Now, if we look at the other aspect, which is default rates. So here we're going to focus obviously mostly on debt. So there's interesting trends, long-term trends actually. And the first one is actually linked to, I think we were discussing this morning, Basel, is the fact that for the past 30, 50 years, infrastructure debt has always been sort of more secure, less risky than the sort of non-infrastructure debt. Yet, because we don't have a clear definition, we don't have data, it's been impossible for regulators, except in a few places like Europe, to actually create infrastructure as an asset class. As a result, we still ask today banks to put probably more capital aside than what they should. And the so-called Basel IV, the last package of Basel III, will actually make it even more so because the banks will be less able to sort of use internal rating models to adjust for those differences. So unfortunately, on that perspective, I think there's definitely a gap in terms of regulations. And unfortunately, that will impact countries going forward. It's going to be very difficult, to be completely honest. We have a lot of discussion with the Basel Committee, et cetera. Very difficult to change Basel, but I think it made us sort of look at, in particular, the use of de-risking instruments and how they currently sort of being considered when we look at sort of capital being put aside. At the moment, except in very few cases where it's been rated and the credit rating agency have looked at it, it's very difficult to actually get the full recognition of those de-risking instruments. So in a way, we're putting a lot of effort into de-risking instruments, but the banks are not able necessarily to sort of recognize that, hence they still need to put more capital on the side. The default rates is probably one of the hardest data to get through, and I think it's been mentioned. Now we have GEMS as a little bit more open than it used to be. So we start being able to do some comparison. So here you'll see on the right-hand side a graph that sort of compare the GEMS data with the Moody's data. So Moody's has a coalition of banks that forwards default rates, obviously completely confidentially. And so we're able to start comparing them, even though the numbers are not exactly the same. And so what you can see here is that it's not actually too far, but obviously the Moody's sample has got a lot more middle-income country, while the MDB's GEMS has a little bit more lower-income country. So you can definitely see there's a tiny halo effect, I guess, here. When it comes to the MDB, it is probably higher. But we certainly hope that now, being part of the bank, we'll be able to get more data and more sort of useful comparison for everyone to be able to do their jobs and sort of work with countries on those issues. All right, so we went from default rates, so cost of capital, default rates, and the other key aspect, which is more like an outcome, is the capital, right? So what we've seen is actually the first time in probably like 20 years, once the interest rate in particular, more than COVID actually, once the interest rate increased, we've seen a massive crash in fundraising. So for about a year, most investors were in a sort of wait and see. So very difficult for funds to replenish, very difficult to raise capital, except for a few very institutional investors. And so I think here what he shows is that indeed the global, I guess what's happening globally does have an impact in terms of fundraising, and because most of the funds that are being deployed in emerging markets are still being raised in Europe and America, you actually do get potentially sort of a side effect in a few years. Obviously, it takes time. There's still a lot of dry powder, but we definitely saw like a crash back in 2022. It's getting better, so as you can see, the data sort of the capital raise has sort of recovered, but still there will be less capital than it would have been without this shock. All right, so move from, I guess, the big macro to now investment. And here I'm going to go fairly quickly because again, my colleagues will sort of present a little bit more detail. So what we have here is the equivalent. So we've done some work with Realfin, which is one of the data provider of the PPI database, which I'm sure you're also familiar with. And now we actually have a PPI equivalent globally. So we're able to sort of compare not only emerging countries, but also developed countries. And so it's only for primary transactions, so there's no secondary. Omar will present on secondary markets as well. But here it's only primary. And so what we see is that in 2022, there was really large increase, actually. There was probably the largest increase that we have seen in recent years. The only thing is that it was actually driven by very large transactions, very large transaction airports in the US in particular, a lot of catch-up for transport as well in developed markets. And so also there's a lot of inflation, so the nominal numbers are up, but when you actually look at it from a percentage of GDP, it's still fairly flat. So when it comes to mostly project finance, we haven't really sort of cracked it just yet. I think, again, in developed markets, we've definitely seen some very, very strong movements in terms of renewables, but overall, that's still pretty stable as a percentage of GDP. When we look at the MDEs, that's the dotted line, what we see is that actually we still, in GDP terms, we still haven't sort of caught back to the heights of the 2015, et cetera. Okay. All right, so the disparity, the graph on the left sort of shows you that disparity another way, which is when you look at sort of the private capital being invested in projects. Unfortunately, we kind of seeing the persistent divergence, I guess, of the two trajectories. So basically, capital is still flowing a lot more in developed markets. So that's the graph on the left. On the right-hand side, and I think Omar's going to touch on that as well, we've seen obviously the rise of sustainable finance, but again, I think you'll go into more details there. All right, now probably a bit more to the students here. What is the role of DFI? And again, here it's going to be very quickly because Vivian's going to talk about that in a lot more detail. But what we see is that despite the relatively flat numbers, actually the private sector alone in emerging markets, so this graph is only emerging markets, actually the private sector has become, the last 2 years in particular, a lot better at actually generating their own deals. Now, it's mostly renewables, as you can imagine, and it's mostly large markets. But what it shows is that if you manage to de-risk and create markets, liquid markets in those places, with replicable deals such as renewables, it can actually work in the MDEs. It is possible. But what we see is that the other sectors is not as easy, and we see that the share, I guess, of private sector with support from the broader DFI, including ECA, et cetera, has been pretty stable. And interesting, when we compare those numbers with the MDB joint report on private capital mobilization, we find roughly the same numbers. So the two sources, I guess, are relatively consistent. Things have been relatively flat when it comes to DFI being able to raise capital to basically get private sector to invest in the MDEs. All right. So the last point on private investment, because I know it's a key topic, I mean, it's always been a key topic, but it's a key topic at the moment, is FX. And so here what we see is that there is local currency financing is actually increasingly more, especially again in the last 2 years. But again, the same caveat is actually mostly happening in what I think we've decided to call the top 5 EMDs markets. And Vivian's going to talk a little bit more about that. So the Brazil, the India, etc., they are the one where it's actually happening. It's a lot harder in the other EMD. It's not impossible, but again, the share, the increase of the share is mostly driven by some of those markets. Okay, so we're going to leave private sector aside a little bit, and then we're going to look at outcomes. Outcomes is kind of relatively new. I think historically there was very few data sets that were trying to understand not so much the sectors, what is it that we're investing in, but why are we investing in that sector. To give you an example is, it's obviously very different to invest in roads to create economic growth as opposed to invest in roads to make them resilient to climate change. And so I think increasingly we're getting requests, and actually some countries are working on evolving the data to be able to represent the intention and why is it that we're investing in this. And so what we've done for G20, this data set is the only one that's G20 only. We just couldn't do for the countries. We've looked at all the budget for the past 5 years, all central government budget, including transfers. And so what we're able to do is sort of compare the evolution, but also between EMDs and high-income countries, the type of priorities. And so, maybe unsurprisingly, they're not too different, except that they're quite different, especially when it comes to affordability and accessibility. Obviously, emerging markets are spending a lot more in those than developed markets. As a result, they're not able to spend as much in technology. And you'll see that technology is something that, when you look at the future plans, is very important to all the governments. But at the moment, central governments are struggling. The share is increasing in EMDs, but it's still very far from the high-income countries. So there's a bit of a technological gap that, unfortunately, is sort of being created to a certain extent. The other aspect, and I think we hear that quite often, is that even historically, at least from what we can see from the central government budget, the emerging markets they're already investing more in the broader adaptation, including recovery. So not necessarily only linked to climate change, flooding, etc. They're already spending more as a percentage of their budget than the high-income countries. And unfortunately, all the projection is that this is gonna increase. And as a result, obviously, the efforts on mitigation are a little bit lower. So I think there's a little bit, unfortunately, when we looked at the data, that very unfortunate dichotomy between adaptation and mitigation. All right, now if we look into the future, those were the budgets. What we've also done is look at all the G20 plans. So there was about 250 infrastructure plans that the G20 have put together. There's a huge variety, as you can imagine. Some countries have all infrastructure integrated, very few. Some others have, 50 plans, some of them repeating themselves. So we've tried to basically, the question was, what is it that governments of the G20 country are thinking in terms of how do we address all those issues? And obviously there's a lot of them, right? There's supply chain issue, there's, how do we integrate technology, how do we adapt, how do we mitigate? And it was kind of interesting result. I think the first very important one is that technology is almost everywhere. So if you look at all those plans, they all mention that technology will somehow solve a whole lot of problems. So that's why we actually sort of put it aside. It's not an outcome per se. Nobody is trying to become technological advancers for the sake of it, but it's very, very significant. And so I think that basically shows that many of those plans rely on continuous investments in new technology in order to achieve those objectives. The rest is probably a little bit more what you would expect. As I say, a lot on sort of social outcomes, obviously, accessibility, affordability, the huge increase on decarbonization that's sort of seen across all the countries. Less so on resilience. I think where we see on resilience, we did that work a year and a half ago, is everyone is talking about it, but when we look at it in the details, there's not a whole lot of detail. So I think basically what it tells us is that all the government wants the infrastructure to become resilient, but how to do it and which project to prioritize is still a massive issue. And as we know, there's no way we can make every single asset resilient to everything. It's just not possible. So I think for resilience, you have to make choices. And I think those choices require knowledge, models, and data to be able to invest in the most impactful projects. I think I just get two more slides very quickly. ESG, so we have to sort of report on that. Works at the moment are there's several of them. They're not perfect. Here's one that's it's the most used, I think, across all the G20. That's GRESB currently. There's obviously other Fast Infra, Blue Dot, etc., sort of rising. But when we look at infrastructure specifically, Gresby has sort of the biggest sample. It's not a perfect sample, heavily high income. But what we can see is, unfortunately, the limit of the current standards. We can see, if you look at the score, you would almost feel like we've solved all the problems, right? Pretty much all the assets are really highly rated, which basically tells us that it works. Standards do work. That means that investors are actively looking at the assets in a different way. But obviously we still are investing in coal and some other projects, etc. So kind of like it's two stories. It works, but I think they needs to evolve. So I think supporting efforts to sort of make the standards more stringent and also more effective, I think will go a long way. And the last point, I think. It's what is it that investors, when they think about climate in particular or outcomes, there's probably two things that is in mind. The first one is transition risk. So obviously you've seen all the investors trying to make sure that their portfolio is getting greener, very afraid of sort of having sort of brown type of assets. And the second one is looking at the climate risk of the assets. So that has been sort of a key focus of the investors in the past, and we can see that some sectors, especially transport, are sort of heavily potentially exposed to those risks. So that's definitely one of the aspects that investors are really sort of taken on, is relooking very carefully at the existing portfolio and a new portfolio, and try to integrate climate. And that's it. Hopefully, it gives you an overview of what we have. Yeah.
Thank you so much, Henry. Really fascinating findings, and just a few highlights for me is really the investment gaps remain very high, and the capital cost significantly increased in 2022, and that is 50% more than that in 2018 to 2019. And about two-thirds of the investment go to high-income countries. And for the remaining investment, about two-thirds actually go to the top 5 large middle-income countries. And we have seen some gradual sector diversification, including digital sector and sustainable financing, but even that concentrate in North America, Europe, and Asia. So that's a bit the picture we have. And our next speaker is Omar Chaudhry. He is currently manager in IFC's economics vice presidency. He actually joined the World Bank Group in 2000, and now he is overseeing our infrastructure strategy and impact management at IFC. In this role, basically, he leads a team of economists and other professionals across 4 continents. And the responsibilities include strategy for infrastructure to scale up solutions in emerging markets, convening for IFC in the infrastructure space within the MDB and DFI community, including its fora such as G20. But he also oversees the impact and additionality assessment and monitoring via our own AIM system at IFC for investment and advisory operations. So Omar will go through today the private sector investment figures from the point of view of IFC, with a close look at evolving trends by infrastructure corporates to pursue new financing instruments, sectors, and corporate sustainability actions. So Omar, the floor is yours.
Thank you very much, Christine, and good morning and good afternoon and good evening to anyone who's joining us online. I would like to start by thanking Stefan for the kind invitation and Guang for your opening remarks earlier today. I'd also want to start by saying that I guess one of my claims to fame is that I'm one of the panelists that Christine referred to earlier as having known for more than 20 years. So I think we joined the bank at roughly the same time. So Henri, I think, has done an absolutely stellar job at sort of introducing various aspects of the current situation. What I want to do is to zone or sort of zero in on one particular aspect of that, which is private financing, specifically as it pertains to emerging markets, right? So Henri gave you a much broader overview. And I must also start with an apology in that I will continue the bombardment of charts and figures that I think Henri very successfully introduced you to earlier. So just by a little bit by way of introduction, we at IFC do this analysis that I'm going to provide you with some highlights of on a quarterly basis. And the idea of doing it sort of very frequently is to get essentially a real-time finger on the pulse of how the financing situation is evolving more broadly. We're essentially working with the private sector. The private sector, by and large, tends to sort of react quickly. So we really need to have a sense of how things are evolving effectively in real time. And notwithstanding the data quality issues that Henri alluded to earlier, we struggle with that, but I think what we've landed on or converged on is a combination of data partners and sources which allow us to get a pretty good sense of how things are shaping up effectively in real time. And two partners that I want to mention specifically are IJ Global, who we have an ongoing engagement with, and Bloomberg New Energy Finance. And in between the two, it allows us to construct this analysis quite quickly, quite effectively. So what I will do today over the next several minutes is I'm going to touch essentially on 4 aspects of private sector financing in emerging markets. So one is to look at the overall picture, and what we'll focus on is the last 6 years and a bit, and that's largely because some of the structural issues that we see around private sector financing in infra have been around for quite some time, so they haven't really changed. They've just sort of, I think, exacerbated, if you will, in some ways. But we've had sort of global events in this time period of the last 6 years. We've had COVID, and then we have sort of more recently some geopolitical events that have had some implications on that. And I'll break things up into sort of 4 or 5 big areas. So I'll look at the overall financing and try and get a little bit into how it's been distributed, both in terms of sectors and in terms of geographies. We'll then look a little bit into the financing structures that we see, again, over this particular time period. Why the financing is being taken on, so basically the purposes, and then I'll conclude with something that's becoming much more important, and again is something that Henri alluded to earlier, which is this whole area of sustainability financing for the private sector. So obviously not want to sort of go into a year by year up and down kind of exposition over here, but I think that the 2 messages that come out from this is that, one, that global private financing for infrastructure seemed to be relatively sort of unaffected. And when I say global, I mean the whole world, not just emerging markets. Peaked at in 2022. But then when you, on the right-hand side of the slide, if you look at the emerging market private infra volumes, you still have the same kind of picture. So relative sort of stability. But what differentiates the global from the emerging markets side is that whereas the rate of growth on the global side that you have observed over the last 6 years is roughly of the order of 10% per annum, emerging market private sector infra financing has only grown by 1%, right? So that is, I think, a pretty sort of stark, and we can come back to that a little bit later. There was reference to infrastructure gaps in earlier talks, in earlier discussions. We also mentioned it, and there's a whole host of numbers out there, right? But and one can sort of argue incessantly about how one calculates these and which ones are the ones to use. But the fact remains that these gaps are large and growing. And I think what is telling, as we try and unpack a little bit the private sector dimension of this is that if you look at these particular numbers, you have emerging market financing for private infrastructure contributing on average less than a fifth of the total financing, right? Which against the backdrop of what we see, reduced fiscal space, it's a sort of a problem we may want to think about a little bit more systematically than we've done. So digging a little bit deeper into how things are sort of spread out, if you will, both by region and by sector. So if you look at the region, you've over this period you've continued to see Latin America and the Caribbean region dominating infrastructure financing, right? This is it's a little bit of a mouthful, the Middle East, Central Asia, Turkey, Afghanistan, Pakistan. That's largely for organizational reasons, and I do apologize for that. That's a region in IFC, so which is somewhat different from the bank. That has seen a little bit of a decrease, and then Africa sort of went up a little bit, but then is back to 2019 levels. The other sort of thing that comes out from here, this particular sort of snapshot, is that Europe had been growing during the pandemic. Financing is now falling again, and I think that's largely geopolitics driven. And then if you move to the right and you look at the sectoral aspect of it, you've seen telecoms clearly showing a pretty sort of significant jump in total financing, and that's true particularly during the pandemic, and then again, more recently, whereas the share of other sectors such as thermal, combined heat power, a lot of the power sector projects have seen less action, and that's largely due to the transition to renewable energy, stricter environmental regulations, declining costs as we observe of RE. Also, uncertainty in fossil fuel markets, energy efficiency improvements, and the like. And then lastly, this again is just to reinforce, I think, the point that Henri also made earlier, is that it's been dominated by very few countries, right? So the green is everything else, but the other 5 is about 50% of overall financing. So Brazil, India, Mexico, Russia, and Chile. Russia, of course, up to 2021 hasn't seen anything in 2022 and 2023. Now, what's just to unpack this a little bit? What is it that's driving it? Now, obviously, if you look at a country like India, for example, it's a combination essentially of government-led initiatives, such as the sort of PPP models, creation of the NIIF, for example, and sort of dedicated institutions focused on infrastructure development, and then obviously you can quote similar sort of drivers in some of the other countries as well. But I think the telling point is that even if you look at these sort of small group of countries, the share of total financing in these two has nearly doubled, right? So even within the top 5, the share is changing quite a bit. And then looked at sectorally, what you'll find is that the trends that you observe are largely trends that we see holding for the entire group of emerging markets. So essentially concentration in the oil and gas, renewables, and transport space. And then this it's no different essentially for these particular groups of countries. So what I'll do now is move a little bit to the area of sort of structures. So historically we've observed in emerging markets as infrastructure and the private provision of infrastructure took hold or took root, that project finance was conventional way of engaging. That started changing in the the late sort of 2000s, 2010s, to the point where coming up to the 2016, 2017 time frame, you had roughly an even split between project and corporate, and that to a large extent still holds, but you do see some variations, right? So you have, for example, project finance representing 57% of total emerging market financing over this time period. And the reason why that's the case is because these structures and techniques are in many ways uniquely suited to working in emerging markets, right? Use of a suite of contractual arrangements and credit enhancements to allocate and minimize risks in some ways is particularly important, right? Where political and economic risks might be higher and financial markets might be less developed. But at the same time, you do see recent pullbacks, right, in project finance and the emergence of on-balance sheet corporate type financing also becoming more and more important. And that's driven essentially by two factors, right? So especially during this COVID period, we've seen somewhat of a constraint in government abilities to maintain procurement efforts, right? At the same time that they are dealing with the aftermath of having to fight the effects of the pandemic, as well as the impact of higher commodity prices on the overall sort of economic situation, and then of course higher interest rates have also increased the risk premium that investors are expecting and requiring for investing in cross-border type investments into both middle income and lower income economies. Once again, this shows both the sort of sectoral and essentially focuses on sectors, but looks at sort of differentiation between project finance and corporate finance. And I don't think there are any surprises over here, right? So if you look at the left, for example, you see that transportation is, and historically sort of oil and gas has been the highest shares, and those of us who've been involved with infrastructure for a long time, I don't think will find that surprising. But by contrast, if you were to look at the right-hand side of the slide, you'll find telecoms to be the largest share, right? Where corporate finances is much more important. And then if you were to look at renewables, you'll see both, right? Because a lot of companies in the energy space are now moving to on-balance sheet financing, corporate finance type situations. So, sort of moving on and to the third sort of aspect, why do sort of private sector corporates, if you will, take on financing, and especially how does this sort of relate to uncertain times? So, don't need to necessarily go through all the sort of the labels over here. This is typically characterization that a database like IJ Global does. So, primary financing, which is the light blue shades, essentially refers to a corporate taking on debt for the first time to fund a particular infrastructure asset, right? And then additional facility refers to when there's additional financing taken on. I do think that the important message that comes out of this potentially sort of confusing, sort of overwhelming chart is that if you were to look at the primary, the additional, and the refinancing between those three categories, they account for about 2/3 of total financing that corporates are taking on for infrastructure in emerging markets, right? And if you look, for example, at how things have evolved, starting 2018, going into the pandemic, you obviously had a bit of a surge on the primary financing side. You had sort of additional, sort of roughly constant, but you did see company acquisitions, experiencing upticks during the pandemic and during the more recent round of uncertainties driven by the geopolitics in 2022. as well as asset acquisitions that have gone. And we see that, in IFC. So historically, if you look at an institution like the IFC, we've had the bulk of our infrastructure business all the way up to, I would say, 2015-ish, being accounted for by typically project finance type structures. We saw that change quite dramatically as the telecoms business started accelerating, and that led to sort of a little bit of a rebalancing. Renewable energy is also now funded increasingly on balance sheet, so you see that contributing to the trend a little bit more. And then most recently, in the last 2 years, especially in geographies like Asia, we are seeing much more refinancing and many more companies going out to capital markets to raise financing. This just is a little bit of if you will, an expansion of what we sort of mentioned early on. Just to, I think, note top right corner, a lot more acquisition financing as there's, the industry moves a little bit towards consolidation, and then also, increasing debt as companies expand on their own balance sheets. Last but not least, sustainable financing. Clearly, very, very important part of the overall sort of financing picture. And I think that the important thing again here is to differentiate between what we see on the left and what we see on the right-hand side, right? So it's about a quarter of the overall financing into infrastructure, private infrastructure globally, that is accounted for by emerging markets, right? Just a quarter. The other 3/4 goes to the developed world. So that's I would say that's the first sort of key aspect that we need to look at. And then, sectorally, if you were to sort of do the same thing, you also, I think, and this certainly came as a surprise to me the first time I looked at these numbers, was that if you look at the total sustainable finance space, again, the share of infrastructure in that is not as big as one would have assumed, right? Which is a little bit surprising, given that one would typically associate sustainable financing with the likes of renewable energy, right? But what we find is that you see a lot more of this happening in other sectors, like manufacturing and agribusiness and services, for example, as well as financial intermediaries that account for quite a bit of this. Last point. So this is pretty dramatic, as you can see, right? So if we had drawn this chart, for example, all the way before, if we had gone back, let's say another 5 years, right, to the extent that we had data, and you would have seen pretty much LAC accounting for the entire picture. There's much more diversity, if you will, in the picture now, as you can see on the left-hand side. The emergence of the East Asia and Pacific region when it comes to sustainability financing is clearly something that is, I think, overshadowing most other regions. So there's this definite sort of rebalancing over there. In fact, overshooting, I would say, on the part of East Asia and Pacific. And then also, just to reiterate the point that I was making earlier, as recently as 6 years ago, it was all energy, practically, right? And we now see within infrastructure other sectors, coming into the mix a little bit more prominently than was the case. Sorry? Telecoms, media, and technology. Sorry, it's an alternative depiction of the ICT sort of phrase. Again, it's a so I'll sort of wrap up over here. I'll just leave you with some takeaways. I've already spoken about them, so won't dwell too much on them. And so thank you very much once again. Christine, back to you, and look forward to the discussion.
Thank you so much, Omar. Great presentation, and the broad trend really mirrors what also Henry presented earlier. And for me, it's very important that you also highlighted the higher risk premium as a result of the pandemic and the higher interest rate, but also climate change as underlying factors. I guess that has an impact on the cost of capital as well, but also you talk about how the financing purpose and instruments, right, also adjust as a result. So last but not least, we'll welcome Vivian Foster for the third presentation. I don't think Vivian really needs any introduction. She was our chief economist for infrastructure at the World Bank from 2018 to 2023. And she joined the bank in the late 90s and has always been leading research initiatives related to infrastructure. And currently, she's principal research fellow in the Center for Environmental Policy at the Imperial College London. She also serves as international partnerships lead for the Climate Compatible Growth Initiative by FCDO. Trying to harness the know-how of major UK universities to support decarbonization of energy and transport systems in the developing world. And today, Vivian will present findings from a paper that analyzes the evolution of public-private infrastructure investment trends in a sample of close to 140 developing countries over the last 20 years. Vivian.
Thank you very much, Christine. And thank you for the invitation. It's a great pleasure to be here and back with so many familiar colleagues. So in this session, we began with a very broad landscape from Henri, who told us about all aspects of infrastructure finance. Then Omar zoomed in on energy private finance. And I'm going to zoom in a little bit further onto public-private partnerships, and in particular the role of DFIs. I will not be confined to energy, though. I'll be looking at all PPPs based on the World Bank's PPI database. And I'll be looking at particularly it's more of a research type of paper, and it's a more historic paper. What we just heard was a little bit the most recent trends. I'll be focusing primarily on the period 2000 to 2019, so just before the pandemic, but particularly the decade leading up to the pandemic. This is joint work with my co-author and former colleague, Mumba Ngulube. I think the reason this topic of DFI support for PPPs is important is that we've already heard about the huge infrastructure financing gap faced in the developing world. And we've also heard how difficult it can be to attract private investment into these markets. And therefore, a great deal of hope has been pinned on private capital mobilization. That is the ability of a DFI dollar to bring in private capital. There's a lot of optimism, there's a lot of ambitious targets around PCM. And I think the purpose of this presentation is really to look at the historic evidence, to maybe try and temper the targets in line with the historic evidence. I think it's also important to recognize that the period that we'll be looking at in this analysis is, if you like, the golden era prior to the pandemic. We did not have the inflation, we did not have the high cost of capital we've just heard about. So if things were difficult then, I suspect they'll be more difficult now, but we'll come to that in the discussion. So just to frame this presentation, we're going to be distinguishing between three markets. I've called this a tale of three markets. And we've already heard about the importance of the top five. My top five are slightly different from Omar's, but they're quite overlapping. But essentially about 2/3 of PPP investment in infrastructure over the period mentioned has gone to these five emerging markets, with Brazil being number one, India number two, China and Turkey, and Mexico a distant fifth. So when we're talking about PPPs, we're actually mainly talking about these five markets. The remaining 35% is going to other middle-income countries, and only 1% is going to low-income countries, which are often, the most important focus from a development policy perspective. So this is the starting point for our analysis, and we're going to be following these three groups of countries, these three market segments systematically throughout the story. So if we look at the historic trends leading up to the pandemic, we see this phenomenon of a surge of PPP investment, with 2012 being a historic peak, and then the numbers coming down, and you can see there the blue part of the bar shows the dominance of the top 5 markets. However, if we unpack our 3 market segments and we index them to the base year 2000 and we just look at the relative growth within the market segments, we find 3 completely different stories. So the orange line, which follows the fortunes of the top 5, shows that indeed there was a very strong peak in the early 2010s, and there's been a very substantial decline subsequently. The blue line, which follows the other middle-income countries, shows that actually there hasn't really been a major decline, except in the pandemic year, but really a sort of steady growth rate of around 2% per annum over the period. And the gray line, which tracks the low-income countries, shows instead massive volatility, huge peaks and troughs. But if we take the starting point to the ending point, the average growth has been about 8% per annum, so actually quite substantial growth over this period. So 3 very different situations. When we dive in a little further into the top 5 countries, we find that each of them has a sort of idiosyncratic country-specific story that explains the aggregate movement that we just saw. So here you see the time charts for Brazil, China, India, Mexico, and Turkey. And broadly, the story is that there were surges in economic growth and development up until the mid-2010s, which drove an increase in PPPs. And then many of these countries hit major roadblocks, development roadblocks subsequently, which led to the decline. We see that, for example, very clearly in Brazil, which is the largest of the top 5, which experienced strong growth in PPPs that was linked actually to the World Cup and the Olympic Games that were hosted at that time. Whereas thereafter, the country encountered the famous Lava Jato corruption scandal, which then led to a steep decline in these arrangements. We see a similar picture in India with a huge surge in PPP investment, followed by a very steep decline due to a period of massive protests against land acquisition and corruption. And then, of course, Turkey, with the peak occurring a bit later, but the well-known macroeconomic difficulties subsequently. So what comes across when we dive into our top 5 markets is a story of idiosyncratic country-specific drivers that are moving these major markets. If we try and look and generalize, is it all idiosyncratic? So we calculate beta coefficients. We look at the covariance between PPPs in a particular country and the PPP global volumes. And we find a huge spike in our distribution, just above 0, basically saying that there is very little movements in country-level PPP that tracks very systematically global PPP. Everything seems to follow a very country-specific kind of pattern. So we're now, having set the scene on the PPP global trends over the last 20 years and our 3 market segments, the top 5, the other middle income, and the low income, we're now going to look at how DFI support has made a difference in these 3 market segments. And first of all, we examine absolute DFI support, which is the blue bars. And what we see is that the lion's share of DFI support for PPPs goes to the other middle income categories, so the smaller middle income countries. Very little goes to the top 5. Clearly, they perhaps will not need it as much, and we'll see that in a moment. And a tiny amount goes to the low income countries. Only on average $1 billion a year of DFI support has gone to PPPs in low income countries. However, if we recalculate these numbers, we normalize against the GDP of the country groups, we get a very different story, which is the orange line. And what this shows is that while the other middle-income countries have received quite a lot of DFI support for PPPs, it only represents 0.2% of GDP. So it's not insignificant, but it's not major. Whereas that tiny $1 billion that the low-income countries are receiving is macroeconomically significant at 0.9% of GDP for that income group. And so while it looks like a small number, it actually matters quite a lot. We now look at the actual composition of finance for PPP projects in the 3 market segments. And in the top 5, we see that essentially the domestic markets, the commercial domestic, that's the dark blue, and the concessional domestic, that's the orange, account for about 2/3 of the financing of PPPs in the top 5 markets. Particularly striking is the role of domestic concessional finance. So these are essentially national development banks in the BRICS, is what we're talking about here. If you think that these BRICS represent 2/3 of PPP finance and half of it is national development banks, that means that national development banks represent 1/3 of PPP finance globally. So hugely important and maybe understudied and underconsidered. But largely, these markets are largely self-sufficient to a considerable extent. If we go to the other extreme and we look at the low-income countries, we find that 88% of the money in the PPPs is coming from concessional international support. So what that means is that almost all of the finance is concessional finance from DFIs. And there's very, very little commercial international that's being raised there. That's about 10% of the total, and the domestic is, of course, negligible in these countries. If we turn to the middle column, which is the smaller middle-income countries, we find that they obtain most of their money internationally, so about half of it from concessional international and about 1/3 from commercial international, and they have relatively little ability to tap into domestic sources, be they concessional or commercial. So very different pictures there. Moving now on to that key performance indicator or parameter of private capital mobilization that I mentioned at the beginning, which has become such a sort of focus of the shareholders and of DFI policy. We calculate the PCM ratio for the different markets. We find that globally the PCM ratio is around $1. So $1 of DFI support brings in $1 of private capital. There's quite a lot of variation, though, and what this shows is a kind of trade-off between efficiency and equity. So if what you really care about is getting lots of private capital for every $1 of DFI support, you should invest in the top 5 market, because there, the average is about 1.5, whereas if what you care about rather is equity and helping low-income countries, you're going to have to live up to a PCM that is less than a half. So a very sort of steep trade-off between efficiency and equity in terms of what PCM can deliver. We also look at the frequency distribution of PCM. So this average of $1 of private capital per $1 of DFI support, does this include is this an average that masks a huge variation, or is it that every project is around about that level? So this is what we illustrate here for our 3 income groups. They're in blue, orange, and gray. And what we find is that, indeed, the distribution is very, very heavily bunched in the 0 to 1 interval. And the tail is very, very sparse. Obviously, the tail is better for the top 5. So there's more blue columns in the far right than orange columns. And the gray is almost entirely confined to the left of the picture. But essentially, we have relatively few outliers or projects, if you like, that might point the way for what would a higher PCM ratio look like. And just to sort of put these projects down, it was beyond the scope of our research to dig into these projects, but I think it would be an interesting follow-up activity maybe to try and understand what is it about these projects that actually was able to bring this leverage. So you can see that the only low-income project that had anything much above 1 was this gas generation plant in Mozambique with a PCM of 3. We have a few projects that have reached PCMs of around 12, solar plant in Mexico, and solar plants in Bangladesh, Namton 1, etc. But anyway, I think this is not something that we have yet investigated in depth, but I think it's interesting to really dig into these projects and find out what was responsible for such high PCMs in these handful of cases. We also looked at whether there was some kind of trend in PCM, and we couldn't really find one. So here we have it broken down by our 3 market segments, and you can see that pretty much it's a flat trend. It sort of goes up and down a bit, but you can't say that it's systematically improving or deteriorating during this historic period leading up to the pandemic. Now, it's often argued that that there's 2 perhaps reasons why DFI support can be very impactful, and one is that it helps larger projects to become feasible. And we find some evidence to support this. So here we look at the average size of projects, PPP projects with and without DFI support. And we find that particularly in low-income countries, you can see quite a large difference. It's essentially the projects without DFI support are roughly half the size of the projects with DFI support. So clearly, the DFI presence seems to be making larger projects more feasible, particularly in these very challenging environments. Another argument that's often made is that DFI support is catalytic, meaning that it's really important in the early stages of PPP development in a country, but that as a country or a market matures, the DFIs can sort of gradually withdraw and other forms of capital can play a larger role. So in this chart, we look at the percentage of projects with DFI support against not actually the vintage of projects, but the vintage of the PPP program. So the horizontal axis is the number of years since the first PPP was awarded in that country. And what we see is that for the middle-income countries, the orange line, there's a notable decline, which means that there is a strong catalytic effect. In these middle-income countries, DFIs seem to be much less needed by the time the market is 15 years old than they were at the beginning. Whereas for the low-income countries, there isn't a very clear trend. It seems to go up and down. So just to conclude, the main message is that in order to really understand PPI trends and the role of DFI support, it's quite illuminating to unpack the market into these 3 segments, top 5, other mix, and LICs. And we find 3 very different stories. In the top 5, we find a largely self-sufficient PPI market driven by domestic DFIs, which are huge contributors, and the largest single source of PPI finance globally, and a mix of domestic and international commercial capital. And while this has dampened since 2012, it's largely due to very country-specific macro reasons. In our second market segment, the other mix, we find a market almost entirely dependent on international support, but with a nice balance between the concessional support from the DFIs and the international commercial banks, but still of relatively limited economic significance despite the relatively high absolute volumes. And then in the low-income countries, we find a market that is almost entirely dependent on DFI support, with very low PCM ratios and very small contributions of commercial capital. Although the absolute volumes are tiny at $1 billion a year, they are economically significant in these correspondingly tiny economies. So overall, we conclude that DFI support faces strong trade-offs between the efficiency, meaning the magnitude of the PCM ratio, and equity, meaning the desire to target the poorest countries. But overall, the PCM ratios in this relatively rosy period of history that we've just been reviewing were relatively modest at around 1 and did not show any signs of improving over time. But we do see evidence that DFI support enables larger scale projects, particularly in low-income markets, and has played a noticeable catalytic role, particularly in the middle-income segment. So look forward to the discussion. Thank you very much.
Thanks a lot, Vivian. And for me, the finding about the DFI basically mobilized PPP projects, the fact that 7% actually goes to low-income countries versus 1% in general is quite remarkable. Of course, the trade-off between efficiency and equity is important. I was also quite excited about the PCM numbers because at our infrastructure director retreat, the subject obviously comes up very often. And Vivian also, if we can find ways to work together on more disaggregated numbers for PCM, but also on the PCE agenda going forward, that will be fantastic. So a lot of numbers from the 3 presentations. I actually had a lot of questions I originally wanted to ask the panel, but given we have about 10-15 minutes left, so I'll just open the floor directly from the audience. I'm sure you have a lot of questions. And if I could please ask you to introduce yourself briefly, and except for Stefan, everybody knows you, just briefly. And also, when you ask the question, let us know whether it's for a particular panelist or for all of them. Yeah.
Okay, thank you. It's very, very interesting panel. I'm really, it's even better than I expected, and I expected it to be fantastic. So I just have, I mean, one additional graph that I would have seen there, or maybe I missed it. So we zoomed in from global spending to private investment to DFI. So my question is, how much is, so in these PPPs, you showed part is actually publicly or concessionally financed, so the private part is small. So how much is the private part of PPPs over the total private financing? Because it's likely to be quite small, right? Or you had that? Mike.
So there's actually two different ways of looking at it. You get like the actual private, and you have the projects that are with private only. So the project with private only went up quite a bit the last 2 years. So it was a little bit lower. So the data that Vivian shows was a little bit lower at that time. 2022, we almost reached sort of 50% in emerging markets of private of project with private sector that were done only with private sector.
Well, I mean, through PPPs?
Sorry?
My question was more how much done through PPPs versus other type of modalities.
Oh, PPP versus others. No, I think we didn't have that. I get probably it was private, but I think you like, because there's private without being called, like being done as a PPP. So there's data in both IJ and PPI on PPP, the one that are called PPP. This is in one of our reports. I don't have the numbers, but I could get back to you on this one.
We definitely need to do more work on that, right? Yeah.
So, do I go? Philip Benoit, former World Banker, who went to the IA and then Columbia University. So I have a question. In some ways, it extends from Stefan's point, but I'm not sure he's quite getting at this. And I realize this is in some ways an unfair question, which is how much is the public sector doing as a general proposition in infrastructure, right? I mean, what I tend to find, it's always been surprising to me, this issue of catalyzing private investment. That's something, I mean, we were doing at the bank in the 1990s. We've had a certain degree of success. The fact of the matter is most of our lenders tend to be public sector institutions, and a lot of our financing for infrastructures in the public sector. And in fact, interestingly enough, when you look at the recent IFC-IA report, half of the clean energy financing that's taking place in MDs is coming from the public sector. So a question I have, maybe it's for another panel, is what is the size of public sector lending? Sorry, if I could just ask
Maybe we can take a few questions.
If I could just relate a comment on that, because it was always interesting on the access agenda. There was a tendency to always want to focus in on the ability to catalyze private investment. But in fact, when you look at most successful access projects, efforts by governments in this region, in China, in Brazil, it's been done by the public sector. So yes, there's a fiscal resource constraint in theory, but the reality is it's been the public sector that's been leading that. So, same question.
Yeah, Charles Cormier, Regional Director for Infrastructure in Europe and Central Asia. I had a question around I find, so this is very interesting, and I think my head is still spinning from all the data. But I kind of wondered whether we measure PCM right. So I wanted to talk about Turkey a little bit. So Turkey, of course, the macroeconomic conditions you've described, Vivian, are very real. And what we measure is essentially a very narrow definition of a project approach to a PCM. But in Turkey, what's happened in the last 15 years is the the World Bank had done 3 DPF series to completely transform the gas and electricity markets. So you know, unbundling, creating wholesale electricity markets, competition, and PPPs. And so over time, we've created a $50 billion investment forum for, you know, the private sector is mostly privatized now. They're even looking at privatizing transmission. So I'm just wondering if we capture the work that we do, which is reforms leading to private investments, and how do we do that? I did have a question for Henry as well, since we allowed multiple questions from the same person. I was interested in your numbers on the climate losses annual of 0.9% GDP. Perhaps we should talk offline, but I've been looking for this type of analysis, so it'd be interesting to hear where this comes from, and the trends are quite worrying on the climate you know, essentially infrastructure damages from climate.
Great. I think we can take one more question in this round. Yes.
Thanks very much, David Lowe, World Bank, over here. So I found the trade-off between efficiency and equity very interesting in PCM, and I think there's perhaps a related consideration, which is if you have a very high PCM ratio, are you sort of cherry-picking the projects that would have happened anyway, even without the World Bank's involvement? And is a low PCM ratio not really a sign of more additionality than a high PCM ratio in some ways? So the question for the panel is, are we nuanced enough in our thinking about PCM at the World Bank?
So we'll come back to the panel. Maybe, Vivian, can we start with you on the PCM-related question? And then Henry will come back to you on the loss, percentage of loss. But also, Omar and Henry, just in general, private versus public financing.
For the great questions. So, David, I'm inclined to agree with you that, you know, that's a sort of an extreme way of putting the efficiency equity trade-off, but that may well be what it amounts to. Because we haven't, you know, had a chance to actually dig into those projects that did achieve, I think that would shed further light on whether, you know, it really was cherry picking or there was something much deeper took place. And I think it would be important to get to the bottom of that. Charles, I very much agree with you, but I think what you're talking about is PCE, private capital enabling, and my belief is that PCE is massively more important than PCM, but we haven't, I think, yet done enough to put the evidence together on it. I think there is a lot of evidence to be pulled together. I think historically it's been easier for people to focus on PCM. In fact, it was quite a breakthrough when we got PCE added alongside PCM as a performance indicator. So, but maybe the ability to measure it has not yet caught up, because obviously everything that I talked about was confined to project-based PCM, and that obviously has its limitations. So yes, I think we should be documenting cases like Turkey. I think, particularly speaking to Christine, I think the digital sector is an extraordinary PCE success story that's perhaps waiting to be told with precise numbers. Thank you.
Great. So maybe just on the first question, which is actually a very difficult one, the public percentage. It's something that's actually very difficult to establish. There's a lot of different approaches that have been made. So I've shown the total investment estimates, and those are from the IEA, the ITF, etc. And those estimates are usually based on sort of looking at the number of assets that's sort of being built. Then we have, so that's kind of the very, very high level, and it's estimated based on surveys. And then you have, I guess, what we presented around PPI mostly, or IJ Global, which is mostly, not entirely, project finance or corporate finance big enough to make it to the news. So in a way, those are like the big, relatively big projects. What's really a lot harder to estimate is a SOE. So the bank has the SPI database that we're updating, and that gives you the equivalent of large procurement by SOEs. The difficult part is these two. Central government, we kind of manage. Local government finance, very difficult. Fortunately for us, especially in the MDs, except in some very large countries, but usually that's mostly done at sort of the central government level when it comes to infrastructure. So that one is very difficult, and frankly, we don't really have good data. And then on the other part, especially when it comes to energy, but not only, is corporate. corporate finance, there's a lot of investment. If you look at, for example, telecom, I mean, most of the data centers that have been invested are so corporate. They all sort of like, you know, the Amazon and the Google, etc. And they don't, you know, there's so many investment that they don't bother to sort of put in news articles. It's actually very difficult to follow unless you actually follow the corporates themselves. And so what it means is that if you look at some of the estimates the study have done, usually you'll find that in high-income country, actually the corporate investment can be quite large, especially in energy sectors, but only transport, if the transport has been sort of privatized. You look at railway in the US, for example. I mean, they're investing a lot of money in sort of maintaining and sort of grading those, but they never really sort of show up in those databases because it's more like a run-of-the-mill type of financing. So I think in general, we know that SOEs are playing a big role in emerging markets. Corporates are playing a significant role in our income markets. But unfortunately at this stage, and it's something that we're trying to sort of address, is trying to get some better clarity. I would love to be able to give a better answer than this. But those are kind of like the challenges that we're facing. So again, we have the estimate top level, and then we have bits and pieces in the middle, which doesn't mean that data is, I mean, that data is not perfect, but it still gives us like pretty good trend. And the IJ and the PPI, the only database that kind of covers all the sectors the same way. If you look at Bloomberg, for example, you're going to get a lot better estimates across the board, but that's going to be solely on energy. So that's why we're kind of using it. In EMDs.
Emerging market and developing countries. Do you have a sense of the relative size of public versus private?
Yeah, so I think there was one, and I think you were involved in that, in this SPI, PPI tryouts, and so you could see that it was, again, the SOEs was very significant. I mean, from top of my head, I think it might be, I mean, slightly less than 50%, but quite significant. Then private being, and again, it depends vastly between markets. You can't compare LAC to Asia, for example. But I think there was kind of like, 25 maybe, and almost 50 for SOEs. So SOEs were quite significant. But again, it's all sort of based on sort of imperfect, large-scale large package data. So if you compare large package, that report comparing SPI and PPI is probably your best bet when it comes to MDEs. For developed markets, a lot harder because the corporate size is way larger, and obviously you don't have to go through all the corporates. They've tried in Europe, but they ended up with very large corporate share. There's one study on that where corporate was almost like 60% or 70% of all the investment. Yeah, again, I would love to be able to give you a better answer, and we're working towards it, but that's basically the rough number we have. And very quickly on, because otherwise I'm going to talk too much, the adaptation numbers are coming from the last sort of global study was done from CDRI. And so they almost estimated that the projected sort of loss per year for infrastructure would be close to $1 trillion, which is roughly your sort of less than 1% of GDP, which is actually a very significant number when you start thinking about it and you compare that to the total investment. Yeah.
Given all the challenges that Henri just highlighted on the public versus private, I probably don't want to go there, but just want to pick up on the PCM point that was raised. So this has been a challenge for us on the IFC side as well, for the simple reason that our business model has shifted quite a bit over the years, right? So we had a pretty good rubric, and we continue to have a pretty good rubric when it comes to estimating the amount of mobilization that we've done, and we have a pretty high threshold for that, notably on the investment side. But what we found is that over the last 7 or 8 years, we've moved increasingly into what we call the upstream space, right? So more in the project development, both at the retail and at the wholesale level. And that's when it becomes very tricky, because a lot of these are not yielding investment opportunities immediately. They'll yield investment opportunities both for us and more generally for the private sector a few years down the road. So how do we capture that totality? And for those of us who've been involved more recently in the PCE discussion as part of the new scorecard at the bank, those are precisely the kinds of issues that we grapple with on a day-to-day basis. But I do think that it's definitely a missed opportunity if we somehow don't bring that aspect of the bank group's bigger program on the table.
Also, quickly on the public versus private financing, and clearly it varies a lot by sector and varies a lot by market. For the digital sector, for example, telecom sector that I'm most familiar with, the estimates usually range from 60% to 90% coming from private. But it's such a guesstimate. I guess it's a task for Stefan, is that the numbers we're seeing today are already among the best I've seen, but there's really a need to collect and look at such data further.
Just a comment on that. Just a comment on that. There's actually a paper by Marianne Fay and co-authors called "Hitting the Trillion Mark," based on work by ADB, and I was partly involved in that at the time when I was at the university, which says that in emerging markets, public investment, investment is basically on average 80% public, 20% private. If you include China, if you exclude China, sorry, if you include China, it's 11 private, and then obviously it varies across sectors, etc. But the digital sector is much more private, but it's small. But that's a number for 2019, and nobody has updated those numbers, so we really hope to be doing that as well. Yeah.
Great, thank you to our panelists. Let's give them a round of applause. Excellent presentations. So we will take a break for lunch. We will have an hour and 15 minutes. So at 1:30, we will regroup for the next set of sessions, and you will have a choice of where you go. So if you are headed to session 2A, the importance of project preparation, please come back here. And if you are heading to 2B on user fees and value capture, you can go to our other conference room, which is just down the hall. There's lots of signs, but if you get lost, please just find me or Pariwash and we'll help you. So enjoy lunch, and we'll see you all again soon. In the Student Center, thank you, Guang. There are signs, and you can follow our hosts as well. So. Welcome back. Hope you had a good lunch. Just to make sure you're in the right place, this is for session 2A, the importance of project preparation. We have a great panel for you. And my colleague Astrid here, who runs the Global Infrastructure Facility, is the moderator for the session. So I'll turn it over to her.
Very much, and welcome back after lunch. Thank you for joining us. I hope we can make it worth your while. We'll spend the next 1.5 hours talking about the importance of project preparation in private infrastructure finance. But before we get into the subject, first of all, let me thank Stefan, our Chief Economist Infrastructure, for putting this conference together, and then the University of Mohammed VI Polytechnique for hosting us in terms of infrastructure. It's quite an impressive venue since we're talking infrastructure, and of course, welcome to all of you. I don't think I need to say much while we're talking infrastructure. I'm sure a lot was said this morning already. Apologies, I wasn't here yet. But just to remind us that infrastructure is the pulse of modern societies, and that inclusive growth and poverty alleviation will not be able to be achieved unless we all work together on access to energy, transport, digital networks, clean water, schools and hospitals, etc. And we all are aware that the investment gap to reach the objectives in the SDGs and the Paris climate goals is getting bigger, and the urgency of closing it vis-à-vis 2030 is also growing by the day. Various estimates say that we have to close the gap of 2 to 4 trillion per year in emerging markets and developing economies. And of course, we know this cannot be achieved by the public sector alone. We do really need to scale up the private investment in infrastructure to deliver the global goals. We also know that the multilateral development banks and the bilateral ones, fair enough to say, have invested a lot of effort already in working on the enabling environments, making sure that the regulatory regimes are in place, that investment climates are conducive. But when we look at the data of private sector investment to date, and the World Bank's PPI database is always a good reference for doing so, we see that that has not yet translated in the trillions that we would need to close the investment gap. So let me give you a quick nugget of data. The PPI investments have been actually fluctuating. It was as low as 12 billion in 1990, reached a peak of 160 billion in 2012, but then when we look 10 years later in 2022, we're back down to 92 billion. And similarly, the number of infrastructure projects with private participation went up from 50 to 600 between 1990 and 2012, but then down to 263 in 2022. So the machine, and I can't say well-oiled anymore, so well-solar-powered machine of infrastructure project preparation is not yet working as it should be, and there are good reasons for this. Of course, infrastructure is complex projects with a whole range of risks that need to be allocated and addressed, including country risks, as we know, political, force majeure, regulatory, but also project-specific risks, whether it's technical, commercial demand risk, environmental, social, as well as financial risks, including FX, inflation, and others. And the key, of course, in infrastructure is to allocate these risks to the parties who is best able placed to bear them. So if we take a quick step back, I always like to say, in order to close the infrastructure investment gap, we need 3 transformations. First of all, we need fiscally constrained governments to really prioritize private infrastructure finance. Secondly, we need the MDBs to deliver on the evolution roadmaps and scaling up, facilitating private investment, which is very much also where the World Bank is focused these days. And third, but which is de facto first, we need to scale up smart project preparation for infrastructure finance and private infrastructure finance, because unless we have a greater pipeline of shovel-ready projects, all the rest will not happen. So that's what we're talking about in this panel. And one of the key reasons why it is still a little bit stuck is also the fact that the governments in these emerging markets and developing economies do not yet have all the skill sets and the capacities to structure these complex projects. And that's one of the reasons why the Global Infrastructure Facility was created. Just to give you the 1-minute summary of it. It's a G20 initiative created 10 years ago to help precisely emerging markets and developing economies governments in the preparation of infrastructure projects for private investment. It does so with and through its 11 MDB technical partners, and I'm very pleased to welcome 2 of them on the panel here. Both EBRD and EIB are with us. Thank you for coming. And also its private sector advisory council, which unites investors and banks with over $18 trillion in assets under management. To date, we have supported the preparation of 172 projects in 69 countries across all infrastructure sectors: energy, transport, water, wastewater, social, as well as digital and ICT. 80% of these projects are climate smart, as we call them. And importantly, project preparation is really good investment. So we have been able to achieve a multiplier of 1 to 100, meaning $1 in GIF project preparation support has resulted in $100 of actual private investment and financial close, which is another reason why it makes sense to scale up these efforts. We'll hear a bit more about some of the GIF supported examples later in the panel, but for now, let me say that again, welcome to this distinguished panel. And yeah, developing infrastructure as an asset class starts with project preparation. So let's have a deep dive on how we can do this together. And I'm very pleased to welcome a range of distinguished experts. Maybe, if it's okay, I will start with the lady in the room. Joyce Lian, Head of the Division Advisory Service at EIB Global. Can you please tell us, Joyce, how EIB Global is supporting infrastructure development in the markets you're working in?
Thank you very much, Astrid. It's a big pleasure and honor for me to be here with you to address this panel, an important question of project preparation. Perhaps before I dive into the question, I would just like to give you a quick snapshot of the European Investment Bank and what we do. So we are one of the largest multilateral financing institutions worldwide. We invest mostly in Europe. For example, last year we have invested 88 billion of euros in projects worldwide, both inside and outside the EU, across 900 projects. And basically, we invest across all sectors, so energy, transport, water, wastewater, support to SMEs, education, healthcare facilities, so across a wide range of sectors. And within this context, we have our branch for outside EU, which is EIB Global, as mentioned by Astrid. And for example, last year we have invested 8.5 billion of euros outside EU, in countries outside EU. And one of the specificities of the EIB is that normally when we support a project, we don't go beyond 50% of the total cost. This is an important feature because it enables us to have a strong leverage effect. So we attract and we catalyze financing from other sources. And one of also the features that we have is that because we financed a big part of our portfolio inside EU, we have the capacity to bring and do transfer of knowledge and know-how from inside the EU to outside the EU, to outside EU country. And this is quite an important feature that we provide with a team of 300 engineers that provide this top-notch expertise for countries outside EU. So when we talk about support to infrastructure outside EU, we do it via a varied instruments. So it can be with direct lending, intermediated lending. It can also be via direct support to corporates, to PF type of projects. So a wide array of instruments that we can provide, and also investing directly, for example, in infrastructure fund that we support. And in this context, project preparation is key. We all know it, that outside EU, it is extremely difficult to have to invest in project if we don't have this project preparation phase. And therefore, we have a dedicated team that provides advisory services to both public and private sector project, also in a wide range of sector. And this is an activity that is now being scaled up. And this is why, for me, it's very interesting to have this discussion with you today.
Great, thank you so much, Joyce. And can you maybe zoom in a little bit more from your experience? What are some of the bottlenecks that you have seen and faced when you were working on preparing public-private partnerships for infrastructure or trying to bring the private sector into the picture?
Yes, this is really, I would say, if I look at the portfolio of advisory from the point of view of the EIB, we do see that it is more complex and difficult, obviously, to provide advisory support in the private sector and for PPP support. That is clearly a difficult area. I mean, we've discussed at length this morning what are the bottlenecks for private sector participation. I would say that one of the typical elements that we face is simply political instability. To give you an example, we have devised a program for transaction advisory PPP in the Sahel region, and then we had the coup d'etat, so everything had to stop. So this is quite, let's say, a simple but, I mean, crucial element that we have to address. Obviously, then everything that relates to the regulatory and legal aspect, that is quite difficult for us when we see, for example, a country where there is a high opportunity for private sector participation, let's say in the renewable energy sector, and you don't have the right framework for private sector participation, then it's very difficult for us to go there. And I would then mention a third element, which is the need, particularly in this sector, for grant financing and substantial elements of grant financing, which obviously are not available to the range that we should have. And we see that in those cases where we see and we have this grant element, then we can go and we see project materializing. For example, we have signed last year a project, Medusa, for a cable connecting Tunisia with the EU, and therefore there was an important element of grant support. So those are the, let's say, among the obstacles that we see for this activity.
Great, thank you, Joyce. Very useful combination of also then the framework conditions and actually some smart financing. Thank you for that. Let me now turn to EBRD. Matthew Jordan-Tang is the Director of Sustainable Infrastructure Policy and Project Preparation at EBRD. EBRD has been a long-standing partner and friend of the GIF, I may say, and obviously you have a wealth of expertise in structuring PPPs in your market. So can you please share some of the lessons learned you have learned through the years, and also how smart project preparation can help overcome some of these barriers?
Great. Well, Astrid, firstly, thank you very much for the invitation to be here. Thanks to the World Bank as well, and to the UM6P, the university. It's lovely. It's great to be here. So let me start with, indeed, for those who don't know EBRD, it's probably good to explain. So we're an institution that was obviously created in the early 1990s. It has a private sector ethos that means, however, that we really look at things holistically. About 50% of our projects actually are with the private sector. The other 50 are with the public sector. Within public sector, we do quite a bit. Probably half of that is sub-sovereign. So municipal utilities, SOEs, et cetera, direct lending. I mentioned that it's about 4 billion euros per year in fresh financing, so about 30 billion portfolio. I mentioned that part about the sort of ethos of EBRD because really when we think of private sector lending and infrastructure, one of the first things that we always focus on is how sort of corporatized, commercialized is the sector to begin with. And we often start with those utility companies, those SOEs. When you're in an environment that hasn't gone through a process of sort of corporatization, et cetera, it's quite hard to go from, kind of state-run force accounts and then directly leap into 30-year PPP non-recourse financing with the private sector. So there's kind of an interim step, and we took 10, 15, 20 years, really, in some cases, to build that up. And working with partners like the World Bank and other, and EIB and others in the ecosystem. So that's the first point. That's really important. Just a quick note on that. We've done about 150 direct sub-sovereign loans with no sovereign guarantee all throughout, over the last 20 plus years. And the interesting thing is that there hasn't been a single default. And that's working through the Russian ruble crisis, all of the different great financial crises. We've never had a default. And that says something about the kind of durability of the sector. It's public sector, but it's sub-sovereign and it's commercial finance. So just wanted to point that out. But moving on to PPPs, and we've actually obviously been very active. The the second point I would say is, when we look at it, one of the things we focus on, what is the political and institutional environment? How much trust do we have in the durability of the decision-making that's going to happen? It's not just ex ante, but we're thinking, you know, following implementation in the 20, 30 years of life of that project with long-term financing backing it. Do we think that the right kind of you know, political decisions will be made, institutions are strong enough to sustain and be a partner with the private sector? The answer has to be that we believe in that. Otherwise, it's just far too risky. And I think the private sector looks at it in very much the same way. Those who are successful in this space, they spend a lot of effort and time building up local knowledge. They invest in local teams as well. They find the best possible people in the local markets. That's their secret sauce. Of even though there is inherent risk, they get as much information and they believe in the, as I said, the sort of solidity of that. Now, having said that, another aspect that we really focus on is the risk of regulatory and political change. It does happen, and when it manifests, it can be very, very significant for the project kind of economics and financials. And this has happened in some of our projects, and you just have to sort of anticipate it. That's the reason why, it was mentioned this morning, that's the reason why there's a hurdle rate. That is why the hurdle rate is probably more elevated in emerging markets than it would be otherwise. Things do happen, and they will happen. I think a last point I would make is, obviously the projects that over what we've learned over the 20, 30 years is that projects with direct revenue and user charges, particularly, I mean, given the, something that I know the GIF and the World Bank and the IMF are working on right now with the G20, particularly because of local currency, you know, forex risk mismatches, having direct revenues, particularly dollarized revenues, things like ports, airports, is very helpful. And those are some of the lowest, I mean, it's kind of an obvious point, but it is something that we tend to, that's kind of some of the lowest hanging fruit, if there is this out there. So I think I'll stop there with sort of our lessons, but it's been something we believe in for the long term, and we'll continue to do wherever's possible.
And obviously you do it successfully if you have zero default rates, so congrats to that. And also thank you for highlighting the importance of the institutional maturity and environment. So maybe zooming a little bit more into project preparation, what are some of the factors of success that you have seen? You alluded already to some structuring at the end of your first intervention, but maybe, yeah, what are the 3 to 5 kind of key success factors from your experience?
Okay, very good. Yeah, let me sort of tick them off quickly. I mean, I think the first thing to say is there's no shortcut to the upstream institutional building, capacity building, the enabling environment, the legal frameworks. I mean, it all sounds rather mundane and banal, but if you don't have that, you can't build a successful piece. You can't create bankability, or you do so with a huge amount of difficulty. So that's the first thing. And we do that, and we partner actually with, again, you know, I'm here with the World Bank, and you do a tremendous amount of work in that space, and it's absolutely essential. The second is that another kind of project preparation aspect is the first of its kind project in any type of PPP in any particular market is going to be the most difficult one that you do. But it has extended lead times. Now, I know there's a certain amount of you know, fatigue with how long these take to do, but the reality is you have to go through that effort. So we know that once you've done one, you can do more. We're working in Egypt right now in the dry port sector. Egypt wants to become and it's positioning itself to become a logistics, you know, hub for the whole region, and it's got the canal, of course. So you do one of those, you can do a second one, which is coming, and with support from the GIF, which is hugely important and helpful, and we're thankful for. So, you know, subsequent projects get easier. That leads me on to the third, which is scale. We realize that doing one-off projects is something that PPP advisory efforts is something that's always going to, you know, inherently be limiting. Not to say that you shouldn't do the iconic airport or port project in a country, but really trying to think about scale. And so because of that, we've shifted to what we call national project preparation facilities. And we built this on experience in Greece in the last few years. We now have established a new one in Uzbekistan. We're about to sign one in Egypt. And these are really, these national PPFs do three things that single one-off projects don't accomplish, in my view. Firstly, the countries commit their own national budgets to the project preparation effort. So we match that, and JIF is alongside of us. It's very, you know, skin in the game by the countries is helpful. Secondly, they have reimbursability mechanisms. So when it's successfully closed, the sponsors reimburse back into the facility. The third is that it creates a way of creating deeper local capacity by national experts. What we do is the fees we collect, we use those fees, and instead of putting it into our account, we plow them back into hiring local experts who work in the national facility. So those are three things that we've done. I should say JIF, and I'll close on this just in the interest of time. JIF has been essential for us. Almost all of the successful financial closes we've achieved in the last 5 or 6 years have been with direct JIF involvement. And that's not a coincidence. I mean, I think it gets to this idea of and I should extend it beyond JIF to the IFC. I'm looking at my friend Omar Chowdhury. We partner with IFC as well, and it's actually the strength of being able to come to a government and say, listen, this is an MDB-wide effort. It's a multi-kind of party effort, and it's very, very convincing when we do that, and it can make a lot of sense to come together. So I'll stop with that, but yeah, thank you.
Thank you so much for that list. And yeah, I think very important points. Getting to scale is the name of the game in today's environment, right? And of course, strategic partnerships amongst the MDBs can facilitate that process. So great. But let's come back to your first point, actually, that there's no shortcut to the upstream environment, which allows me to bring in my colleague Ludovic Del Plancle, who is the Senior Infrastructure Specialist at the Public-Private Infrastructure Advisory Facility, which is exactly focused on the enabling upstream environment and has been doing this for 20 years in collaboration with the World Bank and others. So please, Ludovic, if you can talk to us a little bit about what are the key preconditions for successful PPPs before we then move maybe to risk allocation.
Yes, thank you very much, Astrid. Yeah, and I hear that upstream is important, and we actually called the critical upstream in our past strategy, still remain the case today. So as you say, PIAF has been created 25 years ago. We are celebrating the 25th anniversary this year. And over this period of time, we've done a lot of things already. We've basically provide support and establish almost 600 institutions related to PPP in various countries. We've trained something like 25,000 officials into PPPs and so on and so forth. And what I want to say in terms of, there's probably 4 main line of things that we need to address to enable an environment which is suitable for private sector participation in infrastructure. The first is the political will, the understanding of what PPP means. And this is often something that is lacking. Officials in many countries do not really understand what it means, a public-private partnership in infrastructure. And they often think that that's a way to let the private sector take all the risk. But no, it's not that. So we need to train them on and educate them on the fact that PPP is a sophisticated public procurement option, and that involves not looking just at the construction of the project and then once it's constructed, it goes into operation, but there is no real vision over the long run. Here we're talking life cycle. We're talking 25 years of visibility. And that is something we need to have officials understand. So we do a lot of capacity building around that. We do capacity building around the way those projects are being developed. And this is around project finance. Project finance is a methodology that is not understood in the first place. So we need to train people on that. We need to make them understand that PPPs have fiscal impact. It's not something where, you know, there'll be $1 billion invested in an hydro power project or a road, and there is no impact on the state budget. No, it has, and that need to be calculated, that need to be monitored. There need to be institutions in place to do that, and so those what we call the fiscal commitment and contingent liability aspect need to be managed and properly accounted for. Another aspect which is not always the easiest to make officials understand is competition. We're talking about inducing competition in procurement so that there is best tariff at the end of the day, best price with also an optimum quality. So these are the sort of capacity building we need to organize, and that create the political will down the track. So that's the first point. The second point is, obviously, we talk about it, a regulatory and institutional framework. I mean, we can work around the creation of a PPP unit within the Ministry of Finance, or sometime independent from any other ministries. It doesn't really matter. But there need to be some institution within those governments that really understand those principles, and then can keep on monitoring and supporting the rest of the government on this aspect. On the regulatory framework, even if there's a PPP law that would be established, and where there would be best practice on competition for procurement and so on, if you've got on the side, let's say, an electricity law that say that direct agreement is still allowed, these need to be leveled, and there's need to be some form of levelized, I would say, framework on the legal and regulatory aspect. So we look at that as well. I mean, and then the third point is probably something where the GIF is also, and we work very actively on that, is the development of pipeline of projects. Because without a transparency on what's there for the private sector to invest, I mean, the appetite of investors would be very limited. So starting with, ideally, a public investment plan, we can start screening through this PIP, identify the low-hanging fruits, and from there start, working on actual transaction and supporting transaction. And this is where GIF would come in. Having model case is not necessarily an end in itself, but it's useful, as my colleague said. It's useful to have model case that would also drive the learning, the understanding, and down the track, a sort of a programmatic approach on developing projects as PPPs. And the last point I want to make is about improving creditworthiness of utilities. Because at the end of the day, when a PPP project is being developed, it means it's selling a service to someone, and that someone is usually, a power utility or a water utility. I mean, those government services need to be creditworthy enough to have the credibility vis-a-vis the banks, the lenders, and the investors, that they are bankable. I mean, the investors will get their return, the bank will get their money back, and that's all about building that creditworthiness. So we provide also support on that. So I guess I'll stop here. And
great, thank you. Thank you for the reminder of the key building blocks of the enabling environment for private participation in infrastructure. And then now, if we zoom into the project level a little bit, because you already touched upon the importance of project finance and the capacity requirement there for the emerging markets governments. Can you talk to us a little bit about the work that PF is doing in supporting optimal risk allocation, and also possibly some opportunities that you see to optimize private capital mobilization in infrastructure.
Okay, yeah. So I'll probably repeat myself on the need for creditworthiness because, as I was saying earlier, investors, they want an acceptable rate of return on their equity, and the lenders, they want a good debt service coverage ratio. Make sure that their money will be reimbursed and the interest will be paid. So I would say, in terms of the model of projects and revenue model, an availability payment type of structure is always preferred. I mean, it's a way to be a little bit more secured as an investor that, even if for some reason there is a lower demand than expected, you'll still be paid and you can cover your cost at least and your minimum return. So I would say that user pay, it really depends on the environment and sector. I mean, if you are in a country where there is an unbundled power market with a regulator, user pay and being on the open market can be acceptable. In other contexts, you will have a need for a long-term power purchase agreement. So it really depends on the sector context. So really that risk needs to be anticipated in terms of, whether you can be, as an investor, comfortable with the revenue model that is being proposed. On creditworthiness again, I mean, in Africa, in sub-Saharan Africa, you got almost 60% of utilities that cannot even cover their operating costs with the tariff that they've got. So let alone reimbursing the debt, investing in, maintaining their assets and so on. So there is so much work to be done there. And what we do at PIAF is we would work on, not only tariff reforms, but also we work on improving governance, improving financial management of these utilities, and that can be done in parallel to developing model projects. And then a third risk that is very dear to me at the moment is access to land. And because it's basically what I would call an uncapped risk. And these uncapped risks are not welcomed by any investors. When you come in a project and when you want to close the financing of a project, you need to know that you will get your land, you will have covered the environmental and social costs. You don't want any unrest down the track that will prevent access to the site by the constructor, for instance. You don't want to have to pay more money to get, the people happy with the fact that the project is being developed. So you want uncapped. You want to cap all of your risk, and access to land is one. But I'd probably expand on that a bit later, if you allow me.
Sure. Thank you, Ludovic. Now moving from the enabling environment back to this perspective, we also have with us Anas Sharafi, who is a Senior Investment Director at Africa50, and Africa50 is, I would almost say a project developer, or at least an early stage investor dedicated to developing, amongst others, infrastructure projects in Africa. So, and you recently launched an infrastructure acceleration fund, also with the objective of bringing institutional capital into this early stage infrastructure development. So can you talk to us about what, from your perspective and experience, makes infrastructure an attractive asset class for the investors, and what opportunities and challenges you see in this context?
Thank you. Good afternoon. Thank you for inviting us. This interesting discussion. I think these sorts of initiatives where we actually sit together and take the time to step back and look at the bigger picture are really important, especially for us, investors who tend to be focused on execution on a day-to-day basis. Just to provide a little bit of context on what Africa 50 is, it is an infrastructure investment platform that was set up by African governments. Quite recently, we started operating in 2016, investing in early stage project development and also investing equity in projects from our shareholder funds initially. And lately, we started mobilizing funds from third-party investors, and this is where the Infrastructure Acceleration Fund comes in. It's a fund that achieved first close last year, with about $225 million in commitments. And what makes it somewhat unique, at least in the African context, is that for the first time, it was mostly subscribed by local institutional investors, African institutional investors. We had, I believe, 16 institutional investors around the table for this first close. And that is actually quite important. Now that we are going to the broader market, we wanted to start with Africa, now we're going to the broader market to raise funds from other investors. They actually are interested to see for the first time that there is an investment product where that the locals are buying into. Because usually these funds tend to go first to the DFIs, maybe raise a little bit of money from global institutional investors, but really mostly international DFIs. The interest from institutional investors for such projects is there, really. We all know that they have, long-dated liabilities. Infrastructure has interesting characteristics in terms of predictability of cash flows, even on the equity side. And so they tend to buy into the proposition. So really the potential is there on the equity side, but also I would say on the debt side. In equity, institutional investors typically don't have much appetite or limited appetite for direct investment unless they're really very big. Some of them do invest directly. They invest mostly through funds. When it comes to debt investment, this is an area where they can play a direct role, and which is really underexploited, I would say. At Africa 50, a couple of years ago, we managed to raise a green bond for one of our projects in Egypt. In fact, it's a project that where I could say, it's a case of collaboration between various DFIs, because EBRD was very closely involved in preparing the program for solar PV in Egypt, which was quite successful. The IFC was also quite involved in that. And so we came in alongside another developer to develop and invest in a 400 megawatt solar plant. And initially it was funded by the DFIs, but what we did after a couple of years, the plant was up and running and performing quite well. We issued a non-recourse bond, which was also for the first time subscribed by international investors. And when I say in the first time, in the case of Africa, of course. And we managed to make it investment grade with the support of, again, DFIs, which played a critical role there in improving the credit of the instrument with liquidity facilities and political risk instrument. And there was tremendous interest from investors for such instruments. So I think the potential is there. These are investors that typically, have limited risk appetite. So, the early stage is really out of the question for them. This is where other institutions, such as ourselves, but also the broader ecosystem, can come in to develop projects and prepare them for late-stage equity investment. And then once projects are up and running, I think increasingly we need to think about refinancing as a standard way of raising funds for these projects, where the DFIs would typically support the construction financing, which has a specific risk profile, requires quite a bit of expertise to appropriately evaluate. But with the understanding that once the project is up and running, they would basically, let institutional investors come in and take their place. So that's, I think, the way to go.
Great, thank you for that. And I know that in the World Bank context, also a lot of thinking is going on this, what, originate to distribute model at the moment, and how DFIs and MDBs can do more along those lines. But thank you so much for sharing that perspective from the institutional investor, and surely all of you together are looking then for pipeline, which brings us back to the questions around project preparation, some of the obstacles you see in terms of reaching bankability and also accelerating and scaling up pipeline preparation, so project preparation. Can you talk to us about some of those aspects?
Yeah, sure. So this is actually one of our main business. Well, the reason why Africa 50 was created in the first place around 2013, 2014, when at the African Development Bank, well, they kind of were among the first to realize that the issue is not really with availability of funds for projects, but really with projects themselves, bankable projects not being enough. I think now it's a bit of a cliche to say this, but 15 years ago it wasn't really the case. And so Africa 50 was really created in the first place with a kind of core being project development, and around it mobilizing equity for infrastructure. But our core remains project development. And so our model is to invest either on our own, but typically in collaboration with other sponsors in the early phases of development, commit resources, financial resources, also our own people. We have a team that works on projects to bring them to the point where we can go to lenders and equity investors for construction financing. The challenges are, quite significant in Africa in particular. There are many instances where, I think the work that GIF does, that EBRD does, EIB does, is really important, in creating kind of a, programmatic approach to infrastructure, working on the, the environment, the public sector environment, etc. That is really important, and ultimately the way to go, where we want to get to at the end of the day. But in many cases, this can take quite a long time to implement, and in the meantime, the needs are quite significant, and governments have, limited ability to invest. And this is where, for us, we come in as a kind of stopgap, player, in the sense that while all of this is being implemented, which is all good, and where we want to be at the end of the day, we like to joke that, if ultimately, we should all be out of a job, if everything works well. But in the meantime, we engage directly with governments to start, to work on projects and deliver them on a direct negotiation basis. And what we found is, as being ourselves owned by governments, so they are our stakeholders ultimately, they gave us the mission to promote infrastructure. So we work with private sector, we understand the private sector. So we're kind of able to sit, in between the two. And in a context that, to be honest, sometimes, direct negotiation can lead to projects that are not very fair or well structured. Through our involvement and also bringing, obviously, the entire ecosystem, we kind of provide some assurance that, projects are balanced at the end of the day. And that is something that we have found in many cases, is quite helpful, creating an environment of trust for the public sector and the private sector to work together, because there can be significant level of mistrust. On the other hand, and so, in keeping what I was just saying, in these cases, we are on the private sector side, we work with the private investors, but we insist that governments need to be properly advised. And, because again, we're working in contexts where capacity is clearly missing. So, we want all belts and suspenders to make sure that the projects are properly, structured. And so, typically, we work with other DFIs to fund advisors for the government, make sure that they're properly equipped to negotiate. And that, we found, is actually something that can really help fast-track the implementation of projects. Because, getting input from professional people who know the sector, the project, governments are more comfortable making a decision. So these are, a few of the challenges and ways we try to address them. Thank you.
Thank you for that. And I think that last point is certainly something that from the GIFT perspective we're hearing, and I guess our technical partners would also confirm. And also, you know, when we consult with our private sector advisory council members, it's interesting when you speak to developers, them what from your perspective is the first thing that requires addressing in scaling up project prep. They don't say, help me bite on my development costs, but they all say, please get the government's advisors to help them on their side, structure and progress this faster. So very much resonates what you say. Okay, you have heard a lot from this really very complimentary and complete, I would almost say, panel along the value chain. Let me turn it to the audience. Are there any burning questions for our panelists? Specific topics? Yeah, please. Are we sharing one? Yeah.
Okay, hi, thank you so much. I'm Anurag from ETH Zurich, so I'm doing my PhD in climate finance, energy, infrastructure finance. Thanks for these insights, really, really helpful. One thing I was thinking is, are you all large enough to really create a large enough pipeline? So I come from a climate perspective, and in the energy sector at least, we have a huge need at the moment. So what I was wondering was, is the pipeline large enough, and how do you really scale it? Because all your organizations may not be able, like you've done 150 projects, deals in the last 20 years. We need much larger, maybe 15,000 project preparation ideas. So how do you scale project preparation? Thinking from a DFI perspective.
Yeah, maybe I'll just jump in. Yeah. Listen, I think it's important to, you know, you get kind of the structure right in terms of the platforms you're building. I mean, I think GIF is excellent because GIF is a dedicated, not just a pot of money, but it's a dedicated team. It's a collaborative approach where we can all sort of leverage off of each other, all of the 11 technical partners, is that right? Yeah. So, I mean, that to start with is a very good structure. At an individual MDB, you know, I work for EBRD, I think what we've tried to do is if you want to achieve scale, you have to replicate. And if you want to replicate, you've got to pick the kind of project that can be replicated. So we're starting to do a lot more social infrastructure. We're looking at you know, schools, hospitals, dormitories, that type of thing. The other is things like desalination plants. I mean, the world is going to need a lot more desalinated water because of climate stresses, and you're in the climate area. So these are the kinds of things you don't have to do specific, unique kind of structures for each one. You can roll these out programmatically. So I think that's part of the answer. But the other is to, I mean, that one of the biggest things for me, the reason after 25 years of working in an MDBs in infrastructure, it's skills. I mean, I want to say this as diplomatically as possible, but we need more skills locally. The local partner, the ability to sort of speak the same language, understand conceptually what the investor wants, what the bank, the financiers need for bankability. To the extent that you build that up and create a broad enough base, you will be able to attract more, you know, a wider band, a greater number of investors who are willing to come in. So it's skills, skills, skills. And that's why I think the upstream environment, all of that work is absolutely essential. Otherwise, it's just, we're a substitute for what actually has to happen eventually in a greater number of countries. So that's my view.
Great. Yeah, please.
Yes. So, I mean, yeah, very good question. And clearly, the needs are immense. And we need to be there all together and to work together. So one DFI cannot on its own cater for all the existing needs. I must say also that for private sector involvement, also for the DFIs, it's a question of time. So it was mentioned, I think, you start project preparation and then you're not sure you will be in the deal. And it will take a couple of years before this yield. So it's quite a big investment for DFIs, and it requires also a lot of grant funding, donor funding. Obviously, there are other schemes, reimbursable TA we discussed, but it requires quite an investment. Yes, it's very heavy, but I think this could be mobilized. And for me, the biggest obstacle in reality also, it was mentioned, is the decision making. So if you have a clear vision in a country and a decision making, to make sure that there are no laws that contradict each other, and a clear framework and a clear path to achieve this journey, then the DFIs can mobilize the grant, the skills, and the rest. So I think this piece of the puzzle is very important in order to address the needs in their immensity.
Yeah, a quick add-up to your question on climate project and renewable energy in South Asia. And I wanted to touch on the land issue because, this is critical. This is a critical aspect as well. In a country like Bangladesh, you've got 80% of the criminal court case that involve land issues. And when you want to do a renewable energy project, you need land. So what we do at the development institution, on the development institution side, we prepare countries first to know where they should do these wind farms, these solar park, etc., as per the best location for wind and installation. But then it's about land access, and we do a lot of work helping authorities to address those land issues. You've got cadastres that are completely obsolete. Valuation is 5 times less than the reality of the market. And at the end of the day, you can't develop a project with those sort of land issues. So we work on those, underlying issues a lot, and we also work on innovation. And when I say that is because you can't do a large solar park everywhere. You can't take agricultural land and do a solar park. So we work on innovations, agri-voltaic type of things, a mixed use, and that is being done with the authorities. As a multilateral institution, we can't say, okay, this is where you need to do your thing. This is a matter with the governments, but we try to help them address those underlying issues first.
Thank you, Anas. Yeah.
Yeah, no, I think these are all very valid points, but I wanted to make perhaps a more down-to-earth comment, because for me, at the end of the day, it's about funding that is allocated to this. Because project preparation, project development, it's about people, and people cost money, it takes time, so that costs money as well. And the amount of funding that goes, it's still insignificant, I think, compared to the scale of the issue, but it is significantly increasing compared to, again, 15 years ago, I don't think there was even a debate around these issues. And now we see a big shift. EBRD now has, a huge program in this area. World Bank is the same. African Development Bank is the same. I mean, many organizations recognize the importance of this. I think this is the way to go for DFIs to focus on their more catalytic missions. And for me, early stage is one. Risk mitigation is another one to enable others to come in, the institutional investors. So more money needs to go to the early stage across the variety of instruments. I think there are many that have proven that they work, but to scale up, they just need more people, and that means more money ultimately, more funding coming from donors and DFIs.
From the Global Infrastructure Facility, we fully subscribe to that. We are in active replenishment mode at the moment, and we also believe that we can deliver a lot more with scaled up resources and a 10-year track record, and having 11 by now implementation channels, which is in our books the fastest route to impact. So absolutely. Any other burning questions? Oh, great. Yeah. Sorry, I don't know who was first. Maybe. Okay, sir.
Thanks, Omar Chaudhry from IFC. So Matthew, I wanted to pick up on 2 points that you made in your interventions. One was the zero default nature of the municipal business, and the second one was around national project preparation facilities and the shift that EBRD has made in that direction. So in the area of munis, right, our experience has similarly been one where it's been, a relatively less risky ex post part of the overall business, but that's often come with a combination of a lot of hand-holding and technical assistance that needs to be provided to munis before you can actually engage with them lending on lending. Has that been the EBRD sort of experience as well, in the sense that, you know, how much of a sort of upfront, upstream kind of work do you typically do with a muni before you can lend, is question one. And question two, the shift towards the sort of wholesale approach to project preparation, right, when it comes to PPPs, I'm assuming is sort of demand-driven, right? In the sense that you would need to find willing and able partners globally that invest the kind of, you know, effort and have a sort of a strategic vision that, look, this is not a one-off project, sort of specific problem, it's something that has to be tackled sort of centrally. How many of these are you sort of finding, right, in any given day of the week, right? To put it very sort of bluntly, right? Or is it a struggle? And how much are you having to sort of balance that with a business as usual approach, which has been country X wants to privatize a port, and you basically go and, you know, sort of work at a transaction level with them. So apologies, very long-winded, but those two questions. Thanks.
Yeah. Okay, I'm back. Thanks, Omar, for the questions. I'll try to be brief and concrete, and we can talk more and share more. On the municipal sub-sovereign model, I use that word because it really is kind of it's a model we've rolled out, a kind of a business model that, as I said, it's started, I mean, I came to EBRD in 2008, 16 years ago. It started in the late 90s, really, and essentially it was, the first step is you need to sort of, you know, create actual corporate entities. They didn't exist prior to. A corporation is a department of public works, you know, that does water and transport and whatever. So you've got to corporatize, you've got to create corporate development, you've got to create balance sheets, you have to have the ethos like built in that they're running a company, they're running a public service. That's the first thing. That can take years, and it did take years. Secondly, you need to have the legal framework to be sub-sovereign. You have to decentralize in the country, so not just fiscally, but also operationally. The responsibility needs to devolve down to the city level for these public services. Once you've got that all in place, then you have the issue of, is that public utility, the municipal, going to be creditworthy to take a loan directly from, you know, EBRD? And it may not, it won't have a sovereign guarantee necessarily. It may not even have a municipal guarantee. If it has, so the way we create the creditworthiness is a model which, I won't go into the details, I don't have time, but it's called a public service contract. It's a long-term multi-year contract that matches the tenor of the loan. We match the tenor of our municipal loan to that company. To the public service contract. It's essentially like a mini concession contract. It has KPIs, it's operational kind of delivery based on a predefined contract. If you deliver the service to the expected KPIs, you will receive a per unit cost of payment. If the revenues are not fully cost reflective, and they usually aren't, as my colleague said. So you've got all of that baked in, and you need one other piece, and beyond signing the public service contract, which we prepare often, we do it for the first couple of times with the municipality, with technical assistance. The second thing is called a municipal support agreement. And the municipal support agreement is signed between the EBRD and that municipality who owns the public utility company. The PSC is signed between the municipal utility and the municipality itself. So you've got this kind of tripartite, you know, double-backed kind of construct, and that's enabled us to create the creditworthiness in about 15 to 20% of the cases where there are hiccups along the way. A new mayor comes in and says, "Oh, you know, I'm changing everything out. I don't like this PSC arrangement. It doesn't make sense. I'm tied into it. We're paying," and if they start to wobble, what we've been able to do under the municipal support agreement is go to the municipal council and say, you signed this and you committed to paying under the PSC for the full duration, which matches our tenor of our loan. And that's been able to shore up any of the situations where there might have been a possible default, and that's why there's been no defaults. Very quickly, on the shifting to national project preparation facilities, there are 3 of them that effectively have been prepared. I said Greece, Uzbekistan, we're very close with Egypt. And we were well on our way to creating this in Ukraine before the war, and we were working very closely with IFC and so on. Listen, they're done because those are countries that committed and show real long-term political commitment to the procurement model, a PPP model. You have to have that in place. You have to have then scale to be able, I mean, you have to have a deep enough pipeline that's pre-identified, which is baked into the national facility. And then you've got to put money and resources, and including people, as Anna said. That's the key thing as well, the people. When you put that all together, and then you match it with some external support from EBRD proper, from other IFIs, from JIF, et cetera, you can achieve good things. The Greek one is the most advanced. In 2.5 years of operational development of that, we've launched 11 PPPs with the Greek government. That is a completely different dynamic than what we had before, which was 1 PPP launched in 3 years in Greece. So it completely changes the rhythm and dynamic. So I'll stop there, but we can talk more about it later.
No, but interesting example of how to get to scale. And ideally, as a multi-MDB collaboration platform, we find structures where all the MDBs can share in that at the national level, right? So that's maybe a task back to all of us. I think there were 2 more questions in the room. Yes, please.
Thank you so much. My name is Atiya Bilkataria, and I head the gender team at MIGA. So obviously my question is going to be a little bit biased in the sense that I wanted to understand exactly as to how valuable do you think that it's important to have conversations about guarantees in the early stages as you're preparing for project preparation. Knowing just from the perspective of us going into supporting private sector clients in emerging markets, it's very important for them to have the consideration and know about the fact that there is going to be availability of guarantees given the political risk insurance products that we do provide. So I didn't hear too much about it in your conversation today. You talked about the enabling environment, and I think that supports the enabling environment because it allows investors to go into emerging markets that maybe they are very risky for them to engage in. And the other element also that I think also was a bit missing from the conversation, but I would like to hear your thoughts about is the area around sustainability. And so how, as part of the project preparation, there's also an important work that needs to get done around environmental and social standards. So I'd like to hear from you as to how you take these elements into considerations in the discussions you have with the different projects that you're involved in.
Excellent question. So I guess the first one is when does financial structuring start in project preparation? And secondly, environmental and social. Yeah, Ludovic?
I can start on the first part of the question. Hello, yeah. So, yeah, actually I was getting into that when I was talking earlier because I talk a lot about de-risking. And de-risking project takes time. And there are different issues that need to be addressed, as I said earlier. And we can't wait until projects are completely de-risked before, bringing in private investors. And one way to support and to bridge that gap is to bring in guarantees. There are different ways we do that. I just give you a few examples. One example in India is we are trying to help the government foster the development of biogas from rice husk. But it's a lot of small entities, small gas facilities, and that need to be connected to the main grid. And those small entities need money to be developed. And what we are doing there is we're providing a risk-sharing facility, basically a guarantee, that then help commercial banks, local commercial bank, lend money to those small developers. So, while the entire environment is being developed to help those commercial lenders to be comfortable, we help them to be comfortable. Let's put it that way. Okay, so that's one way. On a bigger scale guarantee, for like standalone project. We are working on what we call the hybrid PPP concept. And the way it works is we would gap, certain, let's say CapEx is too high to make the project bankable. We could work on the facility, what we call a viability gap funding facility, to help those projects be bankable. And, but those viability gap funds, need to be sourced with public money. So, helping government bridge that gap, through tax, incremental finance or these sort of things, we can provide some form of guarantees there as well. I mean, there are different ways.
Thank you. I think there was one more question in the room, and then we wanted to give you... Oh, okay. Okay. How do we do that?
Can I borrow your microphone?
Oh, yes.
But maybe, okay.
Go
right.
ahead, you can go first.
Christine?
So I'm Christine Chang. I'm in the infrastructure vice presidency of the World Bank. My question is also on this zero default rate. I was very impressed. It's probably because of the long-term investment in institutional and capacity building, and maybe also due to good preparation. But my question is our risk appetite actually at the right level? Because on the one hand, of course, zero default rate is great, but while all the investment needs are huge, it's a general question. When we look at investments in infrastructure, is there any way to actually raise a little bit more risk appetite so that we can maybe cover more projects?
Who would like to take that? Anas, do you have a view on this? You are an early risk taker.
Yeah, I think. Yeah. So I think the experience in general with infrastructure is that it tends to be somewhat low risk because it's highly structured, right? I don't know about these specific cases, but I think what was being explained is that there was quite a heavy element of structuring, and that enables to keep the default rates quite low. And I think it applies as well to project finance. I think your question is actually quite valid, and it's a kind of battle that we as equity investors and sponsors are always fighting with the lender community, because we do think that in some cases there is a tendency to want to have, belts and suspenders and have a lot of comfort, in the structuring. And a balance needs to be found, because on the one hand, if you don't put the minimum requirements there, you don't get the funding that you need. On the other hand, too much, means that, perhaps not as many projects move forward as they should. And so I think that's where looking at alternative, ways of getting comfort, for example, from the fact that there are precedents in the country, and this is where the replicability element comes into place. Working in places where there are precedents can help, and we've seen that in a number of cases where standards are somewhat relaxed, as time goes by, because investors and lenders just get more comfortable. So I think that that's one element, and pushing in that direction to have more, not isolated projects being implemented, but more, programs or, similar projects being implemented afterwards can help in that regard. And I think, a bit of a softer comfort, from bringing around, stakeholders that can provide, a softer level of comfort, not necessarily, contractual comfort, but, access to government, the ability to unlock issues, etc. And so combining, players with different skill sets, or this can also help, can be one avenue, I think.
Okay, very quickly, because we still have a question in the audience. No, please, Marty, go ahead.
Okay, very good. No, just to add, in the last several years, we, with MIGA actually, developed in Turkey in the hospital PPP sector, and that's replicated in Egypt with the Skatek wind project, and now we've just done it in Uzbekistan. Essentially, it's in combination with MIGA's PRI. We developed a product called a standby liquidity facility. It's essentially provides liquidity that is able to be dispersed very quickly in the event of an international arbitration situation. And that actually allowed the projects that I just named all to be uplifted from a below investment grade sovereign rating. So the project rating actually pierced the sovereign ceiling by several notches, making them able to be invested in by institutional investors. And so, I, again, don't have time for the specifics, but it's proven to work, and it could be replicated many times over by many other people. So,
thank you. Good coffee conversation. Yes, Joyce?
Yeah, very quickly. Thank you, Astrid. No, just to come in on this point, and again, it's true, it's a valid question, and I see, where you come from. But I think in reality and in practice, what we see in these cases, when we tolerate, let's say, higher risk, someone has to pay. Yeah, what I'm saying is that in these cases, when we tolerate a higher risk, someone has to pay. So it can be either via a higher pricing that you are charging to the client, or it can be a cost that you are covering from a guarantee facility or from public funds. So there is a question as to, are we ready to embark in such a direction? And I'm not sure in the end that it is to the benefit of the client and the system. Maybe I think with mitigation measures that enable indeed to have lower rate of default is a better assurance also for the continuation and the scaling up of the overall facility. And perhaps just a quick answer to the question on ESG and standards. Yes, absolutely. This is something that is, let's say, fundamental in all the project preparation. Maybe it's true we didn't mention it enough today, but this is a key element where we have to reinforce the capacity of the promoter and in order to improve the project and get it to bankability, all the environmental, social standards on a project, definitely. Thank you.
Okay, and from online, Isaac Nyarwaya would like to know, for all the panelists, project preparation can be extremely expensive. What is the take of the panelists when you invest in project preparation and then the project is found not feasible? How is that potential challenge addressed?
Can we do half a minute each?
No, I mean, I would say that this happens. This happens indeed that we do prepare a project, and especially in the case where you have a dedicated team that is doing project preparation, and then the team that is assessing the project is a different team. So it does happen that the project is, is not judged bankable enough for financing. But it is definitely, something that we have to do, because if we don't embark in this whole process, then you don't get a pipeline at all. So it is a risk that is assessed and taken on board. And we know that there is a high attrition rate operating outside EU in the project that we support.
I would add that, it's a step-by-step preparation as well. You don't jump straight into the full-blown feasibility study that will cost several $1 million. You start with a concept, you go into business case, and as the process evolves, you realize that there's a number of risks that need to be de-risked, addressed, and hopefully ultimately when you start spending the big money, you're pretty confident that you'll be able to reach financial close.
Yes, very quickly. Is this on? Yeah. Thank you for the question. Listen, our metric is if we can get 50%, half of the projects that we start to reach commercial and financial close, I think we're doing pretty well. The reality is there is a certain amount of attrition. Reimbursability, at least full cost recovery, if not more, i.e. success fees on top for the successfully closed projects, that can help, because then you can bring in and replenish your fund even beyond the ones that the half that don't reach financial close. But at the end of the day, this isn't, at least from the DFI MDB perspective, this isn't a profit making activity. This is something you're doing because you're trying to help overcome a capacity gap right now at the emerging market country level. So we'll be doing this, I'm sure, for many more years to come.
Yeah, I guess everything has been said. It's a feature of project development that you lose money on some of the projects. And if you don't, actually, it means that you're probably not doing it right. And so we take that into consideration. You manage capital, and that's it. Try to minimize losses on projects that don't get to the finish line.
And maybe just one sentence from the gift side also. We do also have a project definition activity that precisely is meant to screen for commercial bankability. So then, of course, not all of those screens are positive. That's part of the nature of the business. And as Matthew mentioned, we also look for reimbursability in order to replenish and be able to support future projects. And we did thank you for the great questions. We did want to give you a couple of very concrete nuggets of what we do. So I will invite my colleague João to briefly talk to 2 projects that the GIF has supported in collaboration with some of our partners here to make it very concrete.
Thank you, Astrid, and thanks for the organizers for inviting us. I have a presentation, so if we can have that on the screen, that would be great. But I think as a starting point, as we're waiting for the presentation, I think a lot, if not everything, has been said. And I think the interesting thing probably is to lend those with the case studies, because the case studies help illustrate those elements that we're discussing sort of at a theoretical level, but how we implement it as we do projects in the countries that we work with. Should be coming, let's see. All right, thank you. And let me spend 2 minutes just to further emphasize what has been said about the Global Infrastructure Facility for those that are not familiar with us. And I think Astrid already highlighted the fact that we are focused on helping emerging market governments into developing projects. So although we do understand, there's a bit of an echo, probably a mic, but my point is, although we do understand that the moment for project preparation has a good momentum right now compared to what we've seen in the past, but as we know, the needs are huge and there's a lot to be done. So I would say we're much better off than what we've been in the past, but there's still a lot to be done in that sense. And hence the importance of project preparation and depending on the work we do. Let's move this forward. So as I mentioned, a brief overview of the GIF, and again, global collaboration platform working to delivering projects. We do that in collaboration with the MDBs, and glad to have 2 of them here as mentioned. But we work with 11 MDBs. Those are our generous donors on the left side. And especially, I think, a relevant feature of the GIF is having the investment partners on board as well, because with them, we test products, we test ideas, and we understand what's needed to invest in each of the markets that we go into. I think this is a relevant one to talk about one question that we received. This is when we're talking about the area in which where we work. We see a lot of work on the planning side and policy side. And then we also see a lot of focus on the financing side on the other end, so the implementation of the projects. The GIF is working with the MDB partners in what we call the missing middle. So transforming policy and regulations into actual pipeline of projects going to be financed by the private sector. And then we have 2 instruments to do that, and that alludes to the question that was received. We do first a sort of PDA, which is a pre-feasibility assessment, which is a shorter 4 months engagement where we go and see what are the bottlenecks for potential structuring, if there's a new law is needed, for example, if there are red flags in terms of environmental and social aspects that are not going to be overcome. So we don't engage into a larger and more long engagement, which is the project preparation work that we do. this is a track record that we have in the last 10 years, almost 70 countries that we worked at. And the other thing that we want to emphasize is the importance of the mobilization that we bring through project preparation. We heard earlier today what is the mobilization when looking into financing, but then looking into the mobilization of project preparation, the highest ratio for every dollar of GIF support, we have $100 mobilized in private investment. So going specifically to the case studies, we have 2 case studies, Senegal, the car BRT, which many of you may be familiar, and the Egypt tent of Ramadan dry port. Starting with the BRT project. The BRT project in Senegal is basically divided in 2, I would say, which is private sector is doing the rolling stock, so private sector is responsible for acquiring a fleet of buses, electric buses, while the government, with support from MDBs, mostly IDA, is funding the infrastructure portion, so mainly the bus lines that these buses will circulate. Private sector is also responsible for the batteries, so we expect this project to mobilize 200 million in investments throughout the 15-year concession period, and have benefits on climate aspects, reducing travel times within the city. And as we mentioned before, this is a first project, so it took a long time to structure it, but the idea is now to potentially replicate these projects in other countries worldwide. We have a large portfolio in Africa, and that goes to the importance of the first pilot as a starting point to scale up new investments as the projects get a successful conclusion. On the timeline element, which is very relevant, and here we go back to the enabling discussion and all the work in the enabling environment, the GIF engagement started in 2016. And that was following a PIAF work, which was done on selecting what projects would better fit the Senegal for private investments. So following that enabling work, the GIF stepped in, along with IFC, to work on the structuring with the project. And as you can see on the left side, the enabling work continued post the project identification. So this is a moving sort of engagement. You don't do the enabling environment and then step off, but you did new law at the same time. You did a new PPP fund within the country. So all those elements are continuously helping the environment for private investments, while on the other side, you are structuring the project. But what you're seeing this is how this builds into a better environment for private investors on the government side in one end, but also on the private side that's starting to assess what's coming next within the project. So this is ended up being a long process from 2026 all the way to 2021. And the winning bidder was Meridian with the FONSIS. FONSIS is the sovereign fund of Senegal. In 2024, the project became operational at a pilot phase this year, and then it will roll out in full operation throughout 2024. So the second project that we want to talk about with you is the 10th of Ramadan Dry Port and Logistics Center project. So basically, the idea here is to identify a private partner to finance, develop, operate, and maintain the dry port, focus on containerized cargo, and also a logistics center. The facility is 70 kilometers away from Cairo. One thing that's worth emphasizing is that the facility is within a national master plan, so it goes back to part of the discussions that we're having of first planning how we're going to develop the sector and then doing the projects and developing the projects individually. This project follows another project that was successful, which is the 6th of October dry port. So again, the replication aspect playing in favor, and then eventually this can be rolled out into a program. The idea of the project is to increase the efficiency of operation, also help on decongesting the seaports of Egypt. The project has also some environmental and social benefits. So as we discussed on the structuring aspect, this has been incorporated throughout the process to the project The project will also have railway line, so that will incentivize a more efficient mean of transportation, reducing emission. And with this project, we expect an impact of 150 to 200 million in terms of expected private capital investment. Just two final elements to give a bit more grasp on the complexity of project structuring and why it takes so long, right? So EBRD was mandated by the General Authority for Land and Dry Ports of Egypt. But as you can see on the right-hand side, there are a lot of public institutions that are also involved, despite being mandated by one unit. You have the PPP unit there as well. You have Minister of Finance involved. You have Minister of International Cooperation, Minister of Transport. So all those players are involved on, let's say, the public side in terms of decision-making and discussion of project scope and so on. The way GIF works is the GIF transfers funds and provides strategic support to EBRD, as EBRD leads a consortium of technical advisors that do a comprehensive work to get the project from due diligence and structuring all the way to identify the private sector that will do the investments. As of now, the status of the project is the project had 4 pre-qualified bidders. This is an ongoing project with EBRD, and MSC has been awarded, but now the contract is pending parliamentary approval. Lastly, on the sort of overall of the PPP structure, and this is applied to the Egypt case, but it can be sort of it's a framework for structuring in general, and we're looking into how this is actually done and why it takes so long. In our experience, project structuring has taken between 30 to 36 months in average to get from mandate signing all the way to commercial closing, not even financial. So that's to show all the engagement and time consuming, and then you can imagine political cycles, regulations, and all the changes that go and take place throughout the process that was alluded here today. We're doing we're looking into technical studies. We're looking into the legal aspects that must be considered within the project. Here are the environmental and social aspects. And as of now, we're also including climate adaptation and mitigation angles. For example, in the BRT, you have to understand what in the climate scenarios of the future, what would be the impact of that in the infrastructure as you're structuring the project. And then you're looking after you have sort of a defined scope and the technical elements. We're going to look into the financing and who is coming in, if a guarantee is needed, what are the needs for the private sector to come in and eventually invest. So you need to constantly do this market sounding and understanding of the transaction as you structure it with consultations with the market and understanding what are the government needs and requirements and possibilities. So mixing those elements and then moving to the selection of a tender of a private partner through a competitive tender. So sort of that sort of gives the overview of what the project structuring is in a very summarized way. And lastly, as the government signs the contract, we reach commercial financing with the winning bidder. And then next step is the financial closure. So that sort of gives an overview within these 2 projects of how we do project structure and the cases specifically.
Thank you, Joao. Brings it to life and shows some of the good partnerships we already have. Amazingly rich panel. I do want to have one quick lightning round with the panelists. So I hope you're okay going 2-3 minutes over into your well-deserved coffee break. I won't try to summarize the rich discussion, but I think just to highlight that I think we had the luxury of having the elements that are important to make project preparation work across the private spectrum with us today. Highlighting again the enabling environment, importance of political, regulatory, but also corporatization and SOE creditworthiness. And then the importance of getting to scale through innovative models, replicability, standardization, as well as optimal risk allocation, including through innovative finance. And last but not least, and from my perspective, almost as important as all the technical discussion, collaboration. So my final question to all of you is actually, what is the single most important obstacle standing in the way of scaling up project preparation for private infrastructure investment, and what can we do together to address it? No particular order, but one each. Yeah, please. Lulu, you want to start?
I can start. To me, if I have one to mention is political championing. I mean, if you've got a champion within a government that push for PPP, that understands PPPs and the merit of it, that will work. If you don't have that, that come and goes. And so yeah, to me that's the most important one.
Thank you. Joyce?
I'm sorry, but I would have to agree with Ludovic. I think it's exactly the same, and I have mentioned it, that I think the decision-making process is really key. The rest can come. The grant mobilization, the DFI support, the private sector investment, all this will come. But if there is political decision-making and clarity and vision and coherence, then the rest would follow. So this would be the biggest obstacle, and the way to address it is, I think, to work collectively, as we do, and focus on also the signaling effect. I think showcases the success stories, how in some countries things have worked. I think it can spur and create motivation for others to follow. I think this can be quite an incentive for action.
Thank you. Anas?
I would say creating an environment of trust for projects to be developed. I think we perhaps tend to underestimate the difficulty of political decision making for such projects, and the fact that the decision makers sometimes are not very well equipped, and at the end of the day not always comfortable in making the decisions. And I think creating the environment of trust by bringing around institutions that they trust will advise them properly goes a long way.
Thank you. Matthew?
Okay. Very good. Well, I'm not going to disagree with any of that. Yeah, of course, there needs to be political champion. There needs to be political support. Trust, and I think trust is essential as well, not only in the public sector, but I think the government and society needs to somehow build up trust in the private partner as well. And so that takes a lot of communication. They need to really invest long-term and be seen to be credible long-term. The final thing I would probably say is you need institutional, like in the depths of the governments, that kind of support for the PPP model for private sector involvement. Politicians come and go. Political champions can disappear from one government to the next, but if you have an institutional solidity, that can somehow fill the gap, especially particularly when new politicians come. They may not be champions, they may not understand PPPs. If you have people in the sort of depths of the institution, they can fill that void and educate their new minister, their new prime minister, et cetera. I think for me that's the solidity that's what's needed, and that's why I think we should do probably even more than we do now collectively to invest in people at the local level.
Great. Thank you also very much to the distinguished panel. I think we have the encyclopedia of what needs to be done, and we can now actually move to doing it, hopefully better together going forward. Thank you to an amazing audience and for being engaged and all your great questions. And yeah, we look forward to continuing the conversation. The GIF stands ready to support PPPs and infrastructure in its preparation, and also to continue playing its convening role as a collaboration and knowledge platform. So we look forward to the next conversation on this topic. Enjoy your coffee break. Thank you. Well, we'll do it again tomorrow in general. Well, and then next week. Yeah, I know. But you have to tell me what I do. Good.
Director for Transport here at the World Bank, and he will be leading the session on procurement and infrastructure impact. So take it away, Nicolas.
Good afternoon, everyone. Thank you, Erin, for the introduction. So we are going to, in this next session, we're going to talk about a topic that is not always very visible, but it's very important and strategic to the infrastructure agenda, and that topic is procurement. We know that the way we procure infrastructure works and services can have major implications. Not only for cost efficiency, obviously, but also to bring new ideas, to bring innovation, to ensure the sustainability of infrastructure investments, to enhance social and environmental benefits, to build institutions or local capacity, to facilitate contract management, and so many other things. So it's a really, really important topic, and I'm very glad that to discuss the tendering of infrastructure. We have 4 prestigious panelists this afternoon who will present some of their research. We will first hear from Eric Su, who is a postdoctoral associate and lecturer at the Macmillan Center at Yale University. Eric's work focuses on firm and household barriers to adopting technologies in low-income settings. And he will be presenting his research on how contracting structures affect project outcomes and public procurement. Then we'll hear from Yue Lei and Martin Rama about private cities and value capture. Yue Lei is a senior economist in the office of chief economist, Stefan. She studied economics in the US and in China, and Martin Rama is a former chief economist at the World Bank for the Latin American and Caribbean and the South Asia regions. He's currently a senior consultant and an economic advisor to the World Bank and several other organizations. Last but not least, I'm very happy to welcome Ronald Fisher, who is a professor at the University of Chile. And Ronald will present his research on public-private partnerships and demand uncertainty lessons from the pandemic. So we'll start with these 3 presentations, and then we'll have a discussion. That I hope there will be some time for a few questions. But without further ado, let me turn to Eric for his presentation. Thank you, Eric.
Okay. Hi, everyone. Okay, great. Yeah, thanks for having me. Okay, so the starting point for this paper is that public procurement is important. I think we know it's important for infrastructure development, but it's also important in general. So there's a recent paper that estimated that about 12% of global GDP is accounted for by public procurement. And that's similar in higher income countries or lower income countries. It's a similar number. This is a really heavily regulated activity, and I think we have the sense that it's important, but there's not a ton of work establishing causally what different kinds of regulations actually accomplish. So it might improve outcomes, say, by limiting corruption. It might worsen outcomes by, say, limiting discretion to do things that might make sense in specific scenarios. And I think the reason there's not a ton of empirical research is that it's a really challenging environment. There's often not a lot of variation to be studied in procurement regulations. It might be set at, say, a national level, so we're talking about comparing country A or country B. The variation that exists might be non-random. It might be, correlated with other factors. And the outcomes, I think, are also fairly hard to get a handle on. So maybe costs are easy to observe, for example, but if, regulation A results in lower costs, you really want to know, does it result in also lower quality outcomes in the end too? And that might be hard to measure. So measurement challenges might get in the way too. Okay, let me skip this or go through this relatively quickly. So, I mean, lawmakers and government agencies often set procurement regulations, but also multilateral agencies like the World Bank. So World Bank finances a lot of private sector contracts So this paper is very much like zooming in into a particular government program. So it's a case study of mass electrification in Kenya. The Last Mile Connectivity Project was announced in 2015. The goal was to connect all households in Kenya to the grid. The goal has been changed a couple times since then as the program has progressed. But we're going to focus on the first phases of the program. And initially, it was a single nationwide program seeking to electrify over 9,000 villages. And one government parastatal, Kenya Power, was responsible for implementing all the procurement for the program. So just so we're on the same page, this is a figure from our paper. It illustrates a particular village. In the middle, there's a transformer that was pre-existing. So before the project started, there was a transformer and probably just a few connections nearby, often disconnected, like a primary school or a health clinic or a market. That's why they put it there, but not much else. So the program basically was to take sites like this, connect everyone within 600 meters of the transformer, and that's what mass electrification looked like under this program. So it was to do this thousands of times. And then the part of the program we're studying, these first two phases were funded by the World Bank and the African Development Bank. So there were two funders for this first phase. Roughly half the sites were funded by World Bank and half by African Development Bank. So it's an interesting setting because we're looking at one country, one nationwide program. There's one implementing agency doing these things at the same time, but there were different sets of regulations, and that's because of the way the financing was set up. And as far as we can tell, the assignment of construction sites to who would fund them was done in a fairly ad hoc manner, and I'll show you some more information about that. So we're going to assess what are the costs and benefits in terms of financial costs, in terms of timeliness, in terms of construction quality at the end, associated with two key differences between what the World Bank did and what the African Development Bank did. So for the World Bank funded sites, so between these two funders, there were differences in how contracts were bundled and how ex-post monitoring was approached. And we're going to do two things here. One, we're going to collect a whole bunch of data on the outcomes for this program. So we did original field data collection at each of these construction sites, engineering measures, but also surveys with households and firms that were affected. We have remote sensors to measure actually, electricity quality coming out of this. We have administrative records on how construction progressed nationwide, and we did a bunch of qualitative interviews to get a sense for, it helped us interpret our findings using the data. But, so when we're comparing African Development Bank funded sites and World Bank funded sites, we're really comparing two bundles of regulations. We layered on, and I'm calling this approach number 2, we layered on a field experiment to give us a better sense for what one element of the bundle did. So I'll tell you more about the experiment too in just a second. Okay, here's a map for the AFDB funded sites and the World Bank funded sites. So one thing you see immediately is it's not like the World Bank funded sites were in one part of the country and the AFDB funded sites were in a different part. They were very much layered on top of each other. And all the sites were subject to pretty much the same technical specifications. There were various contracts covering the design of the network at each site, materials, and the actual installation of everything. Private contractors entered into auctions, and so that's how the contractors were selected. And at the end of it all, Kenya Power and a contractor would jointly visit a site after installation was completed And a joint measurement certificate basically says, okay, this is done, and the site is ready for handover, and it would be owned by Kenya Power thereafter. Okay, so those are the similarities. There are two key differences. One difference is how contracts were bundled. So what I mean by that is, so at the AFDB funded sites, there were 10 turnkey contracts that covered design, materials, and installation. So one contractor would be responsible for all those things for a specific geographical area. For the World Bank funded sites, there were a lot more contracts because they were unbundled. So there were separate contracts for designers, for major materials, and for installation. Okay, let's see, what's the trick with this? Okay, there we go. Maybe I'll just say one more thing about this. Maybe this matters, right? So this might matter for costs. What are the, is it cheaper to do it one way or another? It might matter for oversight. Under the bundled contracting, in practice, all these contractors subcontract because there isn't a firm that's a cable manufacturer and have in-house designers and is a pole manufacturer and have teams to do installation. So it's kind of outsourcing the selection of subcontractors. So I think it's an open question if this makes a difference for the outcome of the project. I'll show you a timeline. So funding for both sides of the project was approved around late 2014, early 2015. The gray boxes represent when contracts were signed. So for on the AFDB side, we see things starting out, contracts being signed in 2016. And it's a little more spread out for the World Bank, but that's because of the sequential nature of the project. So you have to do designs, then materials, and installation in sequence. Just to illustrate this bundling element, this is kind of, on the left-hand side, we have a stylized diagram for what bundled contracts look like. So you have the turnkey contractor that answers to Kenya Power, and in practice, they basically coordinate subcontractors that handle design, materials, and installation. And in contrast with unbundled contracts, each of those, the designers, suppliers, and installers answer directly to Kenya Power. Okay, so that's key difference number one. Key difference number two was how ex-post monitoring was carried out. So African Development Bank funded sites, there were various mechanisms to ensure that the work was completed. There were required progress reports, there were spot checks, and the joint measurement certificate, meaning the contractor and Kenya Power actually, their staff visited each site before handover. At the World Bank funded sites, there were a couple additional procedures. So there was provision for independent inspector to look at all the poles because a major issue with quality is poor quality poles. If they fail early, they're supposed to last many decades. That affects service quality and maintenance costs. And in addition, when each site is completed, there's this inspection report that's required, and it's just a little more detailed, right? It requires inspecting particular elements within the construction. That goes above and beyond what just issuing the JMC did. Okay, so I think ex ante, there was some disagreement about what we might find. So I think to generalize, people at the World Bank may have argued that unbundling and these more stringent monitoring procedures would improve outcomes. It would result in higher quality work, possibly for lower cost. People at Kenya Power have argued that this results in excessive administrative costs and delays, lots of paperwork. We presented this in front of people from the AFDB. They disagreed with us characterizing, using the term, less stringent procedures. They prefer to say it's streamlined, but no less effective, right? So maybe things just go smoother, and actually there's no cost to that in terms of quality. So let's look at the data and see what we find. Okay, so a little more on design. So here are all the sites. In practice, for a typical research budget, we're not going to visit all 9,000 sites. We focus on these 5 counties in Western and Rift Valley in Kenya, where there's a lot of overlap. It represents kind of a pretty diverse area. And you can see on the right-hand side, that's a map of just the 5 counties where we'll focus a lot of the original data collection. Now, just to say some things about how these were selected, there definitely was a whole process for how an LMCP site became an LMCP site. We want to know, one issue would be if, say, sites with certain characteristics were more likely to be funded by the World Bank or the AFDB. We don't really see evidence of that. So we see balance in a lot of observables. Throughout the analysis, you'll see constituency fixed effects. So that's one administrative level below the county. It's the thin black lines in the map. So essentially, they'll be within constituency comparisons. And our qualitative interviews also didn't indicate that, say, in the background there was, like political incentives or, to put a site on one list rather than the other list. So we think of this as a natural experiment in thinking about how procurement regulations affect project outcomes. Okay. So once again, there are these 2 key differences between what was done at World Bank funded sites versus African Development Bank funded sites. It'd be nice to break apart that bundle. And we layered on an audits experiment on top of this existing natural experiment. So in practice, what it meant was we basically said to the contractors that were involved in the experiment, we're a team that's going to inspect certain elements of the finished construction, and the results will be reported to the relevant parties. Here, this is a letter that was delivered to contractors, and it would be associated with a list of sites that are under this monitoring program. So a program that says we're watching, and the sites were randomized. So on the right, the black circles represent the audit control group, and the red circles represent the audit treatment group. And we stratified by funder and by constituency. So you can see there's quite a bit of variation along both dimensions here. Is there any clarifying questions, by the way? Happy to be interrupted. Okay, so I'll quickly run through, how much time do I have, by the way? 5 minutes. Okay, yeah. So I'll quickly run through the kind of data we collected, right? So we collected engineering measurements related to the quality of the transformer, the poles, existence of fuses. We looked at the presence of grounding wires, which help regulate the quality of electricity, struts and stays that are meant to keep poles up in situations where poles have unbalanced loads. These are actually, the survey respondents, but a picture showing, that illustrates how we randomly picked households and businesses on the network at finished sites. We installed remote sensors, which basically give you minute-by-minute information about outages and voltage at these sites. And we have the original contract texts. Okay, so here are the findings. So first, relative to AFDB sites, the World Bank sites were delayed a little over a year on average, depending on what stage of construction you're looking at, when construction started, when metering was completed, for example. On the extensive margin, we saw fewer household connections at World Bank sites. And partly that was explained by stricter adherence to the 600-meter rule, where you're not really supposed to connect households outside of it because of degradation in service quality. So these are just the engineering standards at play, but not fully explained. So fewer household connections. And the audits treatment actually impacted how many poles were installed per site. One story this could be consistent with is contractors, they can save poles, right? There's a way to do construction where you achieve the same number of connections, but you skip out on some poles, and it might have impacts on construction quality, but then you have an extra pole you can do whatever you want with. Okay, on the intensive margin, we did a bunch of measurements on construction quality, and we organized them into indices to summarize effects. And so overall, we saw that the World Bank-funded sites had higher quality construction. But, and outcome 3 is many of the key milestones were delayed. So these aren't all of the quality measures, but just to give you an idea of what goes into the index, there are things like, does a pole have a crack that's greater than 1 centimeter wide? Does the pole have a pole cap? Those are meant to keep moisture out and is good for preventing poles from rotting. Is a stayer strut installed when required? Those are important for keeping poles up, standing straight in the long run. Does a pole have a grounding wire does a pole have a grounding wire, which is required, throughout the system to maintain service quality? So if you see this, it's actually quite consistent with some of the elements that World Bank-funded sites have. For example, an independent pole inspector or more stringent monitoring at the installation stage. Okay. We also want to look at if the audits experiment did anything. And they didn't at the World Bank sites. But at the African Development Bank-funded sites, we saw a small amount of delay, kind of a fraction of the quote-unquote World Bank effect. And we saw an increase in household installation quality. It differs from outcome 1 because they're looking at different quality measures. Construction quality is like aspects of the cables and the poles, whereas household installation is like, did you ever have electricity working? Do you even have a meter at all? That have to do with kind of a little closer to household usage of electricity. Okay, and lastly, we looked at power quality. And I think the most notable part of these results is that the audits treatment just for the AFDB-funded sites actually improved voltage. So excessive voltage can also be bad, but in practice at these sites, all of the problems are with low voltage. So this is a good thing for treatment to improve voltage at AFDB-funded sites. Okay, so just to summarize, we saw slower and somewhat fewer connections at World Bank-funded sites. We saw higher quality at World Bank-funded sites, which might affect longevity of the construction. And the audits improved installation quality and voltage quality, but just at the AFDB sites.
Thank you, Eric. Fascinating case study. The bundling discussions are always something that we pay a lot of attention to during the preparation of the project that we finance, and there are always trade-offs. So let's now move to the second presentation by Yue and Martin, and this is about private cities and value capture.
Thank you. Let me see if I can get this. Oh, sorry. Yeah, good afternoon. The question of in our presentation is whether there are opportunities to procure urban development. We have been talking over this day about private participation in things like power, transport, water. And we understand why we wanted. A big focus is finance, mobilizing finance, and it has been the focus of this conference. Another typical reason to think about getting the private sector involved is having better quality, better knowledge. And the question is, can this be scaled up, not just to this particular road or that particular power line, but to the whole issue of urban development. And arguably, urbanization is the biggest transformation that developing countries will have, and is probably the most expensive in terms of the investments. So what is the motivation to ask this question, which may sound a bit far-fetched? But in fact, it builds on the work Yue and I started doing when we were both at the Chief Economist Office for South Asia at the World Bank, where urbanization issue is very central. And the actual participation of the private sector in urbanization is also surprisingly important. So the motivation is starting more on the efficiency side, is that across the developing world, we have governments, local governments that have weak capacity. Like this afternoon, we were listening about how many of these cities, including big cities like Bogota, can have a cadastre, how many agencies are interacting and stepping on each other's toes for quite some time. What happens with property rights on land and land transactions. So we have all these issues, and the high road on urban development has been to try to fix these issues, to try to get very capable local governments that can steer urbanization. But we know that that takes long, is politically challenging. Sometimes you need constitutional changes as to how cities are run, what kind of powers mayors have, and so on and so forth. And while this is not happening, what we see is the emergence of private cities, and that's the topic of our research with UA. And by that, private cities, we mean first major urban areas. We're not talking about gated communities or business improvement districts or industrial parks. We are talking about real cities. And the use of the word private is to emphasize that there is a non-government actor that is playing a very central role. Non-government actor is a broader definition, can be a major company, and we have in the advanced economies like these Amazon investments and all that, but it can be a major company that needs a large-scale base for its operation, can be Tata in India. Typically can be a large developer, and some of them are very large. They can manage several cities at once, which is quite surprising. But we have also seen in our research cases where it's a business association or even civil society organizations that take over a role that we traditionally assign to the local government. Now, so this was the topic of our research that we completed last year on private cities, which was a combination of analytical work on the right side, but also lessons from inventories of private cities in 4 countries, private cities being this entity that I'm referring to, large scale, and at least one major private actor, and also of 14 of these private cities, outstanding examples throughout the world. These are the examples we analyzed, and just to give you a sense that this is not like hypothetical thing. The median population of our 14 cities was close to 900,000 people. The median rank in the urban structure of these countries was about city number 10 in the order of cities by size. So we've been talking about the challenges in mobilizing private sector for investment in infrastructure. And here we have examples of something that was huge happen. And I will argue we were not paying enough attention. Why? Because these private actors are not, at least at the World Bank and in other multilaterals, they are not our usual counterparts. We deal with governments. And some of these characters are not the nicest characters you can think of. So sometimes we want to keep some distance from them. Ask the farmers who had the land before what they think about these guys. And they may not have very nice thoughts. So part of the stories, if you want to read, they are like 14 little stories structured in the same way for each of the cities, is about the characters involved. And each of them is good for a movie. They can mobilize armies of mercenaries and things like that. So the kind of things that you don't associate typically with private sector. But the reality is there. So you have these big cities, and the number can be big. This is from our inventories of private cities in 4 major developing countries. Forget about the colors, I will come to the colors. But you see that we identified more than 45 private cities in Indonesia, about 15 in India. And again, some of these are very big. In fact, this research started when I was based in Delhi, For those of you familiar with Delhi, the area, the 2 million people area that is the aspirational place for the middle class is Gurgaon, next to Delhi. That's a private city with a privately funded metro, entire metro system. Okay, so we're talking about real things. And so the question we want to address is, can we have more of these? Is this a good idea? Can we make them better or avoid the worst things? What we found in this research is that what these investors do is beyond the traditional functions of local government. A local government will assemble land for a city. Some of them do that. Will work on the connectivity enhancement, airports, roads. We have private developed airports in these stories, for instance, in Sialkot in Pakistan. They do the planning. So this is way beyond build me this road that I designed and I want you now to put in place. And they do other things that local governments typically don't do. They do business development. So quite often they have a strategic view on what they want their city to be about, and they will go into attracting the right investors. So it's not just creating the city, but building the economic activity that will come on it. And they can also be very political because they lobby for their city, they influence the government. So they play a role that is completely oversized compared to the private contractors that were putting poles and lines in Eric's presentation. Very simple, this is like a table that we use in our research on how these private cities work. And you see that depending on whether the private actor is active or inactive, and whether the local government is inactive, just reactive, or proactive, we have different settings. For instance, if nobody is active, the place remains rural. If the government is completely inactive, we have, let's call it a company town. Can be company towns of 1 million people, but these are company towns. If the private actor is not active, we have a conventional city. But the case that we want to talk in this new phase of the research we are starting with UA is what we call a strategic city. So it's a city where both the local government and the private actor play a role, but the local government tries to do something to influence the type of city. I will not enter into too much details, but let me give you the intuition of why we want to focus on these strategic cities. If you think of the objective function of the government is to maximize the surplus of an area by developing land, L, and the surplus will be the output that comes out of that area minus the cost of the capital. And that's like a Pigouvian approach. That's what an enlightened government would want to do. The private actor doesn't have exactly the same interest because the private actor cannot appropriate all of the surplus that the city generates. It will appropriate only part of it. Of course, it could do something different if it gets some incentive, but otherwise, given the fact that the private actor will only appropriate part of it, we will have suboptimality in all cases. The government will be suboptimal because it wants to do the right thing, but institutionally is constrained to do the right thing. So it has all these coordination failures, all of these capacity problems. But the private actor, in a way, will be like a monopolist that will produce not enough of the good to sell it more expensive. And the question is there an incentive, I star, that the local government could provide, let me call it procurement, although it's not procurement, I will come to that, that will take the size of the city and the type of the city to what a capable local government will do if it could. Now, what we found in our research is that the government cannot accomplish that by just developing land. It cannot, if you just put the private actor and the government each to develop land, it will be suboptimal, and we can go into the reasons why it could happen. And in fact, the hope to reach optimality is through a combination of things that doesn't look like a typical PPP or a typical procurement problem. So think of this at a time. When we're talking about cities, we're talking about decades. Okay? This doesn't happen over a short period of time. And the first thing where the government intervenes is a kind of policy framework that you have for urbanization. Some of the most interesting cases we have found are in East Asia, where this strategic thinking is very much present in places like China, Indonesia, and Vietnam. And in places like Indonesia, and the UAE will go into more detail, we have frameworks just thinking what a private actor needs to do in a city in order to build a city. We have examples of partnerships. Some of them are in the format of PPP, some of them are in the format of joint ventures. Then we have money going between the government and the private actor. Taxes are the most obvious thing, but it can go either way. And when you think about cities competing to attract Amazon or Google, you see that there are payments involved under different forms. We have, as in PPPs, defaults, renegotiations, things that did not work as planned, and then you have the urban outcomes. So this is not a typical procurement. This may involve PPPs or not involve PPPs, but the question is, can you work on this to get faster and better urbanization? So that brings us to the research program that we are embarked in now, that UA will present.
Thanks, Martin. So let me, oh, sorry. Oh, that's away. Okay, now it's good. Yeah. So just to recap, right? So we did the previous research. We found that private sector involvement in urban development can bring efficiency gains. But at the same time, what we also observe is that if we just, for instance, privatize the city, give the land to the private sector, it may not lead to the optimal outcome. Both could be in terms of scale of the city, could also be in terms of quality we want, social aspect, environment aspect. So there is a good role for the government to play, as Martin mentioned, it's strategic cities that we want to look at. And then we look at literature. So for the previous research, we look at the literature in terms of private cities, in terms of the games playing between the public and the private sector, like Housley in terms of political economy. But here we think we can maybe borrow from the PPP literature of the infrastructure sector related to urban development. What we found is that the existing ones mostly focus on a specific aspect. For instance, urban transportation projects, for instance, could be energy, could be waste and water management, but not so much on the integrated aspect of developing a holistic urban area. And also further, we want to say, okay, where can we identify those cities? So we try to say, how about existing databases on PPPs? So, this morning we learned so much about the trend of PPPs. So we go to the two most popular sources, the PPI, which again covered solid waste, but doesn't cover urban development as such. And also, we look at the GI Hub database. Interestingly, I think this morning we see some element of municipal, but it's a very small portion, partly because data, partly I think also not so much attention to this aspect. And then what we want to do with this research is three aspects. One is continue to do more in-depth case studies to understand what happened, how it happened, and the outcomes. I will get in more details. And also build on those knowledge. We want to codify the cases that we can find, hopefully more than a dozen beyond the 14 that we found, and also modeling the mechanism for this type of partnership. Getting into a little bit more details, we identified 4 out of the 14 cases that from our previous research that somewhat fit into this urban partnership of strategic cities, including Guan of China, so about 1,700 square kilometer of land and 500,000 population now, and Cairo Festival City of Egypt, Maja Township of Indonesia, and Phumihong of Vietnam, also 500,000 people. And then also is through check some of the data and the news, we identified some new cases. How do we codify it? Basically follow what Martin said in terms of framework. We want to start with the design, the policy framework, and then move on to the transactions and how that would distribute the risks between the two parties, and end up looking at, because it's long term, right? So for instance, it could be 50 years, 90 years, more than a typical infrastructure PPP project. So you could have defaults and negotiations, and then end up looking at the urban outcomes. So let me go back a little bit. So for the policy framework and urban partnership, again, beyond the general one, the contracting part, which we put as last, you need to think about the policy framework. As Martin mentioned, in the Indonesia Maja case, in addition to land policy, PPP framework, you need to have in place for the general project. Here, the Indonesian government, Ministry of Urban, also think about how about social housing to address some potential social segregation issues. So they have a quota for how much would need to be low-income housing in primarily middle-income residential and commercial places. And then also, interestingly, in some of the cases that we found, government have special free trade or tax exemptions for these places to be viable economically. And then, in addition to policies, the government, some cases also invest. In general cases, is infrastructure to improve the connectivity of the places. It could be airport, in many cases, the international airport, could also be a metro line and light rail. And again, in terms of business, some of the cases, the Hefei case you mentioned, the local government actually engaged into equity and partnership with private firms. Lastly, in terms of contracting, those are very complex contracts. For instance, for the Guan one, it's 50 years, including land planning, consolidation, infrastructure services provision, management, and also business development on top of everything. And similarly for the Humihong, it's a equity equity share type of contracting, but very complex, including all the aspects of urban development. Next, in terms of tax and transfers, we understand the tax part and also kind of consistent with the previous sessions. Property tax actually account for a small share in terms of how much you can get from the land value increase. Mostly it's general tax. And then in terms of split between the government and the private sector, in the Carroll Festival City case is relatively typical. You allocate land to the private sector in a discounted price, the cost, but in their case, they don't give the land rights or titling until you finish a certain part of a certain proportion of the urban development. And again, in the Guan case, it's very interesting. In addition to pay back the private sector in terms of infrastructure development, they also have a contract to pay back the private sector if they solicit private sector investment into businesses, for instance, aerospace, biotechnology, and the proportion is quite high, 45% commission fee. And finally, in terms of the Hefei case, again, this is quite unique, and because it's already equity sharing, so the government basically share the profit from the venture capital investment they did with the private sector. So a variety of mechanisms the government tried to get back from the profit that the private sector obtained. Two last points, given the time, which we can also come back during the discussion. One is there is unique, issues with respect to the PPP or partnership of urban development. The first two may be common to other infrastructure, but the scale is different. One is the sunk cost. Right? So it's, again, large-scale, long-term, complex investment. So the sunk cost is very high, and then that's create more opportunity for hold-up problems. Second is the institutional factor. We're talking about, again, the reason there is private sector engagement, involvement in this type of development is weak public capacity, but then how you expect the public sector to be able to manage, design, and monitor this type of contract delivery. Lastly, it's very much unique to urban development because over time, 30 years, 50 years, even 90 years, you will develop a different constituency on the urban land, and then the government would change hands. So you have this governance issue that's very much unique to this type of PPP arrangement. Lastly, I think this, again, we can discuss more during the discussion is how potentially we have some discussion and thinking on to address the hold-up problems from both sides. One is the asymmetric information, moral hazard issue of the private sector. So potentially maybe we can build a global market for the reputable and capable developers or private sector investors, not for city development. And secondly is the hold-up issue with respect to the government, how we make sure the government live up to their promises. So in that case, DFI, MDB maybe can play an intermediate role. Okay, let me stop here. Thank you.
Thank you very much, Yuan Martin. This presentation is very timely because as of July 1st, the urban group will join the infrastructure vice presidency at the World Bank, and we expect to have a lot of similar conversation to develop synergies between urban and other infrastructure sectors. Let's move to our third presenter, Ronald, who will talk about PPP and the demand uncertainty.
Good afternoon, and thank you for the invitation, Stefan, World Bank. This is a paper joined with Eduardo Engel, Alexander Galetovich, who were mentioned in the previous talk, and with Jennifer Soto. Well, Alexander Galetovich died 2 years ago, so that slowed up this paper. And Jennifer Soto, who is a finance specialist in syndicated loans for large infrastructure projects. To whom we ask questions on the financial setup of these projects. So let's go on. And as you know, PPPs have become vital to the provision of infrastructure in many countries, and many PPPs are paid at least partially by users, and those are the ones that we're going to look at. There are other PPPs, for instance, hospitals, usually that or other public infrastructures that do not depend on user fees, but we're going to look at ones in which demand is going to be an important feature. And the pandemic was an extreme demand risk event with severe reductions in demand for travel. Therefore, in the case of transport, the effects were very important. By the way, this is the only paper we've written on the pandemic. So and this was afterwards. We didn't write during the pandemic or anything. So there's also the problem, which was very important at the time, in which the pandemic had serious effects on projects under construction. But I'm not going to focus on those issues. I'm going to look at what happened afterwards. As you can see, this is a project in Chile, but this is a typical thing. It's a road, 200 kilometers, double carriage lane. And the demand decreased about, at the worst, by 35% or something like that. In airports, it was much worse. The main Chilean airport, this was the decrease in 2020, and even in 2021, it was much lower than it had been. And that created lots of problems for the companies. So what happened in most countries? Well, Colombia compensated for lost revenues, roads, and Daniel told me that there was that became a problem in Colombia because it was the amount of money they had to pay constrained the government in various ways, or with term extensions in some cases. In Italy, a light rail project at the time got a 2-year term extension. In India, there was a relief of debt obligations and 6 months term extensions. In South Africa, increased payment through minimum revenue guarantees. So it became a problem. And let's see what happened in Chile. Concessions under, this is a World Bank report, 2021. Concessions under a flexible scheme with fixed profit to the concessionaires and variable length contracts to manage demand risk have not been affected by the pandemic or received public support, as a drop in short-term demand is compensated for with an increase in length of the contract's provision in the contract. So the term extends automatically when there's a fall in demand, and therefore there was no effect. But that's not totally true, because there were a few projects that had been signed a few years before, which still remained, which was done under a fixed term, as fixed term. And the problem there is, and this is one case. For instance, the Antofagasta airport also had, as you can see, similar decreases in revenue, but this was a flexible term contract. There's no problem at all. And the previous one was the airport of, the main airport of Santiago in Chile. And that one was a problem because it was a fixed term contract. And in that case, they requested contract renegotiations. There was no agreement. They eventually, at least in the case of the main airport, they sued in CIADI, and it's still going on there. So it became a big problem for government. There were lots of discussions. There was a big pressure at the time in which the government was pressured by other things. The other ones had no problems whatsoever. So there's some advantages. There are clear advantages, theoretical advantages from these flexible contracts. First, this reduced demand risk. That was theoretical before, but now it's pretty obvious that it works fairly well. The other advantage is that since you have an idea of how much you have to pay the companies, because basically the companies bid on an amount that they want to receive in expected value terms in discounted value, and you have an amount received up to a certain point in time, whatever remains is what you can pay as a fair compensation for expropriation. So there's no problem in canceling the project at any time, and there's no risk involved in that. So that means also there's less space for opportunistic renegotiations of the contract, because you can always say, well, I won't accept your contract, I'll give you the money, and I'll auction it again. And the other advantage is that you can change tolls to reduce traffic congestion, and that doesn't increase the rents of the companies. When you have a fixed-term contract and you raise the tolls because you have congestion, the company is very happy. In this case, it doesn't have an effect. It just shortens the term of the concession. Well, how does it work? It's fairly simple. Many of you probably know, but just in case some people don't know how it works, firms bid on the present value of revenues from the project, and the contract ends when the winning bid is reached. So that's the present value of the revenue, that formula over there. Oops, sorry, I thought it was a laser. And the contract ends when PVR is bigger than PVR star. That's all. Note that this doesn't affect what happens during construction. Construction proceeds as usual with the same assignment of risks that you want to have, that you decide to have, for instance, between the company or the private sector. This also is compatible with having subsidies. You can have a fixed subsidy, and then you make them compete for the remainder of the revenue. Now, what is the experience with these things? The first one was the Queen Elizabeth II Bridge over the Thames in 1988, which was a project of 85 million pounds at the time. And the interesting thing, it had no equity. It was a project that was basically all based on debt. And it ended in 2002, 6 years before the maximum term. The second project was a second Severn crossing, which was a large bridge over the Severn, tendered in 1990 and over 95, with a term of 30 years, and it finished in 2018. So like 4 or 5 years before the end of term. It was a 95 million pound project. The first auction, rather than these were contracts that had the structure, but they were not auctions. The first auction was the Santiago Valparaíso project for about $347 million at the time. And it's ending this next year. And nowadays, at the beginning, most of the projects in Chile were fixed term, but now all the projects basically are of these variable term contracts, and 6 were converted to flexible term during the 1990 crisis because, of course, again, there was a decrease in demand. This is approximately the distribution of value of the different projects. These are all transportation projects. As you can see, the fixed-term projects basically haven't increased much. One of the things that happens is there are fewer renegotiations. Now, in 2010, there was a big change in the law, which made it less likely to happen negotiations, but also it was a time in which they implemented PVR. So it's difficult to know which one is explanation for the fact that the renegotiation rate is much lower under PVR than under fixed-term contracts. Note, however, that the AMB airport was post-2010, so after the reforms that were supposed to have reduced renegotiations, but they've been trying to renegotiate it ever since. So the question becomes, it has some advantages, and why is it not used more widely? It was used in the UK, and it's used in Chile, and people, apparently the banks have no problem participating, the financial sector has no problem participating, and the question is, why doesn't anybody use it anywhere else? Well, there's some misunderstandings, I think, we believe. First, people claim that it's difficult to structure finance because of the variable term. Second, and that's why we have a finance specialist in a group, so we could explain what happened. There's also early repayment risk. You could purchase a risk in for instance, in the mortgage sector, etc. And there's at least from, according to the compendium of good practices of the World Bank, there's an asymmetry. There are losses because most of the cases you have a flexible term, but it has a statutory maximum term. So let's say you have 35 years as a maximum, but you're supposed to finish in 25 or 28 or 18, but you might reach the end, and therefore you might have losses. But on the other hand, you don't have rents on the other hand, because once you reach, if the demand is high, you reach the end early, but you don't get any rents. So those things are really not correct. What is valid is that it should not be used if demand is endogenous. It should only be used in cases in which demand is basically exogenous. So how does it work, the financing of PPPs? Initially, at least this is the case with Chile, so I'm not going to extrapolate, but I imagine that in many cases, at least the first stages was very similar. Initially, the banks syndicates lent during construction. In the operational stage, then it was placed through the banking system, but privately. And later, institutional investors, which are fairly important in Chile, or at the time, became interested in lending even in the operational phase. And they had PPP bonds with monoline backing. But after the 2008 crisis, these the banking syndicates were the only ones that remained. You didn't have any monolines, and therefore you couldn't. There was a while in which you couldn't emit PPP bonds, but they came back. They came back after a while, and they started investing. And the reason why they invest very early is because the returns are higher if they participate from the beginning. So there's a lot of experience in this, and the investors feel fairly confident in the projects. Let me explain the comparison. This is the only theoretical points here, which is two graphs. Okay, so suppose that you have two states of the world: the low state of the world and the high state of the world. In the low state, you get a certain amount of flow per year. In the high state, you get a higher flow per year. So under fixed term, basically what you do is you have a certain amount of you have a certain amount of revenue that you want to get, and there's a term in which, given the probabilities of the two states, you have that PH times H plus PL times L is equal to, multiplied by T bar is the revenue and expected value that you'll get. Now, because the project is risky, because the money is risky, because they have two states and you get different amounts in each state, because since the time is fixed, you'll get a smaller amount in the L state than in the H state, and therefore there'll be some risk and they won't lend you the full amount for the project, and therefore you have to, you can't have full leverage. Under a PVR, what you have is that basically the contract ends at TH or at TL, and you can lend up to basically the value of the project. Okay, so if you were certain of the value of the project, of course there's uncertainty there, so you would lend, you would have some risk at that stage. But given that, suppose for instance that the project is already built, and you want to emit bonds, what's the leverage of the bonds? And you can have full leverage on the bonds. That's what I'm trying to say. And the basic reason is that you have access to that little square over there that you don't have access of revenue, that you don't have access to at the right, the one over there, that you don't have access to when you're using a fixed term. And that adds to the ease with which you can finance the project. So, from the point of view of lenders, what the lenders will do in this sort of project is they will divide the cash flow between a riskier part that's left with the banks and in a tranche that is more constant that's left to the institutions. And what lenders look at is the risk of the project itself and not the type of contract. They look at the project flows and they use them to estimate how much the project can pay back. And that's independent of whether it's fixed or variable term. And the risk classification depends on the project. I mean, the Chilean risk classification depends on the riskiness of the project itself and not of the type of contract. And the financial regulator doesn't make any difference between them either. And that means that for the lenders, they're indifferent between which one they use, except that they're willing to lend more in the case of, or lend more, or in the case of, or
we'll need to close in,
okay,
in a few minutes.
I'm ready to go. The additional prepayment risk, I won't explain this, but there isn't any because basically the prepayment that you get here is a prepayment that's exogenous, and it's not endogenous, which is one that creates riskiness for banks. And the asymmetry in returns is the wrong, this is the next to last one. That's the wrong argument because the thing is that you have to consider the auction, the process before you get the project. And when you consider that, all these effects that the World Bank was looking at, in fact, have been incorporated into the bids. So I won't consider that. And I conclude with that the pandemic was a hard test for PPPs. I'm done. Countries with fixed-term contracts have problems with the contracts. They had distractions at the time of crisis. It was potentially expensive for them. It could lead to corruption or delegitimization of PPPs because there was a lot of renegotiations that are not totally clear. And flexible term contracts were unscathed by the pandemic. So the question is, so you should use them. You should promote them. That's my point.
Thank you very much, Ronald. We are getting close to the end. Perhaps we have time for one or two questions. I don't know, in the audience. Yes, here and the second one there.
Thanks very much. I have a quick question for Eric. Eric, I saw at the end of your presentation, you had a kind of a cost-benefit analysis, which might have been kind of the grand reveal on who did it better, AFDB or World Bank, and you didn't get to it. So I was wondering if you could put you on the spot, and that's to tell you now.
Yeah, so at the end, like my last slide, my last slide was like, here are the effects on, timeliness and different aspects of quality. We did want to do like a cost-benefit analysis, try to, make some assumptions and, have a bottom line. Actually, I think the takeaway was under reasonable assumptions, it's ambiguous. It really depends on like what kind of discount factor you want, what kind of, what are your assumptions about household benefits? Because if you really value the benefits up front, then you want to get that out as quickly as possible. And a streamlined approach might be better. So yeah, the takeaway was it really depends on the assumptions, and we use some reasonable assumptions, I think.
You still get dinner if you give them.
That's good.
There was another question.
Thanks. I wanted to continue with Eric. It wasn't clear to me in the end if you disentangled which contracting attributes were responsible for which outcomes. So was it the bundle? Were the bundling and inspection both responsible for the delay and the quality, or is one more associated with the time and the other with the quality? It wasn't clear to me.
Right. I would say, so if you take seriously that the experiment mimicked the more stringent monitoring, and I think there are a lot of similarities between what the experiment did and the more stringent monitoring, then maybe the takeaway is the monitoring contributed a little bit to the delays, because we did see that in the experiment, but like the minority share. We did see different aspects. So, I mean, one puzzle is why was the difference between World Bank and AFDB sites on certain dimensions of quality, whereas the experiment affected quality in different ways. In fact, we saw households were more likely to ever have electricity running, but we can't like point to like it's because they did this better in the construction. And I think that could be because of a mismatch in kind of when the experiment was done, which was kind of shortly after the contractors were selected. It could be that certain things were adjustable, at that point, and other things were kind of harder to adjust later on in the process. So I guess bottom line, they all contributed a little bit, but I mean, one takeaway might be that the monitoring was actually quite cheap and produced better outcomes. It could be kind of a third way that we don't have to be limited to, what the World Bank did versus what the AFDB did in that particular project.
Arturo, you had a question?
Yes. Yeah, okay. No? Okay. Thank you. My question is for Ronald, and I want to link with what Peter and the panel that followed said this morning. In terms of, we are not talking about the quality of the motorization that is happening in our countries. And I will use the Colombian example. Colombia, 20 years ago, had about 100 cars per 1,000 inhabitants, and maybe 10 motorcycles per 1,000 inhabitants. Colombia is now reaching 500 motorized vehicles, and I changed the unit, per 1,000 inhabitants, of which about 350 are motorcycles. And in the Colombian context, motorcycles are toll exempt. So you have a PPP with variable or fixed term, and 65% of your users are exempt. Yes, motorcycles don't damage the pavement. However, they could have been a car. And maybe, Peter, Bolivia, the problem is it doesn't have enough cars that pay the toll. But yet we want to decarbonize transport, so we don't want people to acquire a car. A motorcycle could be a better option. So the question is how to account for the motorization patterns when we talk about toll roads, fixed or variable term.
There's a switch at the bottom.
The question, Arturo, the question I think is, why don't you toll motorcycles?
Because they block the roads.
Oh.
And they burn down whatever they need to. There is a political economy.
All right.
not to make it seem that it's very unfair.
All right, any other final question? Otherwise, perhaps one for Martin and Yue, because one of the frequent criticism against private type of cities is the equity dimension, no? That they might be for more higher segment of the population. Is there a way to do a pro-poor strategic city?
Yeah, I think in the slides that you showed, when it comes to the outcomes, we have 3 types of outcomes. And those are economic, you can think population, productivity, social, and environmental. So in a way, this touches on the issue of the first session of this, the social returns. And what we have found in the social side, in the 14 cities we studied, is that quite clearly they tend to be segregated. They tend to be upper scale. So you have a clear line between the private city that is better run and for the rich, and sometimes makes it a value proposition of not being mixed. So they don't want mixity because they sell property higher if it's exclusive. But they also create a lot of jobs. So when you think in terms of mobility, you may have it going both ways. If you don't have those cities, you don't have jobs there. And it's the same thing with environmental. We find it's very easy to think, oh, environment pollution is like, they are damaging a public good, and they don't care because they are the private guys. But sometimes, some of them have had big awards for greenery because it's part of the value proposition. So on both counts, social and environmental, it can go either way. We find that the cities that are more geared towards production, the ones run by business associations, on the environmental side, they tend to be quite poor. At the same time, they create a lot of jobs. So it's not a clean thing. We think where a big challenge happens is on what in the slides you showed on the broader dimensions of governance, is that some of them go really into almost an institutional secession. For instance, when it comes to crime, if you think about many of, especially Latin America, but where security is a value proposition, all of a sudden what we find is that the presumption of innocence may work very differently in these places.
Thank you. Unfortunately, we need to close, but let me thank our panelists for very stimulating presentations. And let's close and go to the next session. Thank you.
Okay, thank you everyone. We have one more session this afternoon. Since we've all been sitting for a while, I'd like you all to invite you all to please stand up and do a nice stretch. Make sure you're awake for the last part of the day. We'll power through. Stretch your legs. Okay. And I will turn it over to Sebastian for our policy panel, the impact of global events on infrastructure financing.
Thank you so much, Aaron, for introducing me. So my name is Sebastian Molineros. I'm the Director for Strategy and Operations for the Global Infrastructure Practice based out of Washington, D.C. I'm also currently the Acting Director for IPG. There's a reason for the acronym. It's a bit of a mouthful of a name, Infrastructure Finance, PPPs, and the Guarantees Group. And it's a pleasure to welcome you. And so good late afternoon for those of you here in Rabat, and then good morning and good afternoon or evening even for those joining us virtually. So it is my pleasure to welcome you to this panel session on the impacts of global events on infrastructure financing in emerging markets and developing economies. And this session aims to take a bit of a different tack. So we've had a number of really, I found, excellent presentations and panels beforehand that have focused on data, that have focused on research. And what we aim to do with this last session of the day is to take a bit of a practitioner's view of some of the events that are taking place that have shaped and influenced how financing has gone into infrastructure asset classes in emerging markets. And my job as a moderator today is essentially to serve similar to a referee. So the best referees are those that sort of stay in the background and let the stars shine. And we do have a number of stars with you today. I only wish that the referee from yesterday's Bayern Munich and Madrid game would have done the same. As a German, you will understand where I'm coming from. But joking aside, it is a true pleasure for me to introduce really a number of stars that we have for you today. And I'd like to start off by introducing Ms. Fatima Hussein, who's the Managing Director and Regional Head for Project and Export Finance Africa at Standard Chartered Bank. So if Fatima could join me on the stage. Yeah, there you go. Thank you, Fatima. And if I could have a round of applause, please. Thank you. If I could invite next Joyce Lian, who's the Head of Division Advisory Services, Corporate Finance and Global Activities Department at the European Investment Bank. So nice to see you. Next, I'm pleased to invite Karim El-Naoui, who's Executive Vice President of Mohammed VI Polytechnic University here and Dean of Humanities, Economics and Social Sciences Cluster. And last but not least, our own Caroline Otonglo, who is a Senior Infrastructure Finance Specialist at IFG, the Infrastructure Finance Group here within the World Bank. Welcome, Caroline. So again, just to provide you with some very brief framing, and again, I promise to respect the referee mantra and be very short to let the stars shine. Essentially, the World Bank not too long ago commissioned an internal study, which we will be sharing with you shortly, at the height of the COVID-19 pandemic, to really understand how some of these global shocks, these major events impacted the infrastructure finance in emerging and developing countries. And we commissioned a study by PwC and worked with them on the findings and really found some very interesting sort of facts and figures that hopefully we'll be able to touch upon today that really show how these impacts have been pretty severe. And again, it starts off with COVID-19, but it also includes shocks such as Russia's invasion of Ukraine, other conflicts, but then also some of the more minor shocks like Basel IV, interest rate rises across the world, and have those impact markets sentiment in this respect. And I do want to also highlight that PF was a generous contributor and partner in the research, and we very much appreciate their collaboration. So again, as I mentioned, we have a panel of esteemed practitioners here, and we're really looking forward to hearing from them on their particular insights on this topic, and to sort of shed their light and unique vantage point on the findings of the report and how the things have evolved on the ground in real time. So with that, let me turn first to you, Fatima, and I would like to hear from you a little bit on the following question. So the survey results sort of indicate that there has been an impact on the volumes of debt financing and how those have flown into infrastructure finance projects in emerging markets and developing economies. And these, as we've also heard in previous sessions, have remained low over the past few years during these subsequent shocks. And from a lender's perspective, can you tell me what is your vantage point? Where do you see the explanations for these low volumes? You touch upon Basel III, IV, preference towards advanced markets, interest rate policies, et cetera. But again, it'd be great to hear from you. And if I could just immediately ask a follow-up question, where do you see the markets going from here? And have they priced in some of these potential shocks moving forward? So Fatima, over to you, please.
Thank you. Firstly, I'm delighted to be here, so thanks very much for the invite. I fear I'm not going to be nearly as interesting as some of the early speakers and the fascinating research and academia that's clearly going behind a lot of the discussions today. So hopefully I'll give a bit more of a sort of a practical, at the coalface view. As a banker, I think I'm the only commercial bank in attendance at this conference. So actually there's a lot of interlinked factors, I think, that has contributed to the lack of, or continued lack of, investment in emerging markets. Basel IV definitely is going to be one of them. I don't think we've yet seen the full impact of that. That's still in the process of being fully adopted by banks, and has been a huge amount of work behind the scenes with banks in terms of getting themselves geared up for Basel IV and thinking through the implications of that. So I'll come to that in a minute. I think the bigger and sort of wider-ranging issue in terms of the lack of investment lending into emerging markets is really, a long-held view around the risk perception of a lot of these markets. And that's been compounded in the last couple of years, certainly. And I look after sub-Saharan Africa project financing for Standard Chartered, and that's an incredibly challenging market. But I have my colleagues who cover Asia, Middle East, and Europe and Americas. And frankly, all of us are competing for capital for deals that we have to take up to global committees. And the way that, and the practical realities of how we decide where to deploy our capital is with two lenses. One is a business lens, and that's simply looking at, am I getting a proper return for that capital, a risk-adjusted return for that capital, and can I get a better return if I deploy that somewhere else? And then the second half is the credit risk aspect. My credit risk committee is looking at it from a completely different angle, which is, am I going to get repaid, and what are the risks of us not getting paid back? So in the last couple of years, obviously with all of the COVID, the inflation impact, interest rate hikes, that's been really felt acutely by a lot of the emerging markets. And we've seen a spate of, sovereign downgrades, and political instability as well in a lot of the markets, certainly in a lot of the African markets that I cover, both of which has really resulted in a severe constraining of risk appetite for lending, particularly long-term lending, and infrastructure financing by nature is long-term lending. So you're really taking a 15-plus year view as a lender, and right now, it's, in a lot of those markets, the risk is, what we call off or severely constrained. At the same time, what you're seeing is a huge amount of activity, particularly in the areas that banks these days really want to support, because it fits a much bigger agenda, which is supporting sustainability, supporting the energy transition. And there are all of these policies and support that we're seeing in the developed markets, in particular in the US with the Inflation Reduction Act, and the EU across the board with multiple policies, which is resulting in actually a huge amount of pipeline of opportunities in those developed markets. And then you're taking a view really, okay, firstly, we want to meet our targets. We want to be deploying capital in those projects. We've made announcements, made commitments to the market that that's where we want to deploy our capital. Where are those projects coming? At the moment, they're coming in those markets. And at the same time, you have this real concern about the situation in a lot of the emerging markets. And there's a big group of emerging markets, and I'm not really talking about middle-income countries because countries that we heard about earlier in LATAM, India, China, that I would consider them actually in the bucket of more developed, actually, from a lending and bankability perspective and opportunity perspective. But certainly in the lower developed countries, you see the value, that there is a desire to lend into those countries and to support the infrastructure development. But at the same time, right now, there is a real concern about the viability of those projects versus the opportunity to deploy capital in other markets. Now, with Basel IV, I think that's going to get even more challenging because the risk-weighted capital, that really determines the return on equity. The sum that we're all doing for every transaction we look at as a private lender is as those countries, as we are having to assess the risk and we're being asked to set aside more capital against all of our exposures in project financing in particular, Again, that impacts your overall return on capital. And again, you're more likely to be incentivized to finance projects which have a higher credit rating. And unfortunately, that happens to be in the developed markets.
Fair enough. And just very briefly, where do you see the market going from it? Do you see this trend continuing? Do you see any Basel IV itself is under a bit of attack by some jurisdictions and countries? So where do you see this market heading?
Yeah, I mean, there's certainly nothing we can do about Basel IV, and it's something that will be adopted, is being adopted, and you know, as a regulated bank, international bank, is something that everyone is already, you know, in the midst of working towards. I think right now there's finite capital chasing and multiple opportunities to deploy that capital. There continues to be a lot of appetite and opportunity to deploy that capital in developed markets, but at the same time, banks like us, actually, where our roots are in the emerging markets, Standard Chartered is an emerging markets bank. There is a real desire to work with institutions like the World Bank, with other multilaterals and development finance institutions, to also find a way of supporting particularly projects which help with the transition, climate risk, sustainable development goals. So I do see, I don't think that this will result in a wholesale exit of private capital, but what everyone is trying to work towards is getting sort of to the goal of working in partnerships to mitigate the risk to the point that we can, hand on heart, say we feel that this is a bankable project and be able to commit long-term capital.
Fantastic, thank you so much. Joyce, let me turn to you, and we've heard now from a lender, right? And I'd like to hear from your point of view a bit more from an equity perspective again. So do you see similar trends impacting EIB and how you're viewing emerging markets? And what would you attribute to the low volumes, again, that we've been discussing and taking, again, some of the major shocks that we've been experiencing in the past? So it'd be great to hear your views, Joyce, and also similarly to the question, where do you see the market heading from now? So not only looking at what is happening today, but what do you think is going to be happening moving forward? Thanks. Over to you, Joyce.
Thank you very much. Thank you very much. And thank you also for inviting me to be part of this closing panel for today. I think we've had very interesting discussions, so it's a great honor to be part of it. I would say that similarly to what was mentioned with regards to the lender's perspective on the equity point of view, and as a multilateral development bank, we do see, yes, I would say the same trends, and we also see, again, the causes that we have discussed today. I mean, what we have mentioned, we see a higher risk perception from the equity side. We also see there are exacerbated trends that were there already, but with these global shocks, we see that those have been really exacerbated. So I would say that it is quite similar. Also, we've seen quite social economic challenges that have increased. The crisis also of the sovereign debt that has really impacted also appetite of financiers to go onto this market. So I would say quite a difficult stage at many fronts. So again, not to repeat this, I think what is important, and let's take the say of not losing a good opportunity for a crisis that can present also opportunities. We also see a reconfiguration in some aspects, and I will present, for example, what we see from the European perspective. So we can see that on the crisis that we have with the war on Ukraine and on the energy front, there is quite, let's say, a reinforced focus from the EU for energy security, security of supply, and this is also a focus on renewable energy. It is something that has also creating new opportunities also for the private sector in this aspect. And it is important also to emphasize that, I would say also in the health sector, we also see opportunities for development for the private sector. So there is this reconfiguration ongoing. And again, I think it is important to see, future trends. So you have asked, how do we see, the markets going from there? I think there is really an important opportunity in everything that relates to the technology and the innovation. And where we also see opportunities for investment to grow. Again, we've mentioned today the digital sector, the telecom, renewable energy. Also an important aspect, again, driven by policy, is everything that relates to critical raw material, supply and supply chain for EU. Green hydrogen also, this is an area where we see, again, a lot of emphasis. So again, yeah, I would say same trend, but opportunities that would be good as well to emphasize at this stage.
Thank you so much. And by the way, I'd like to invite the panelists, whenever you would like to come in following somebody else, if you have a double-hander, please, by all means, makes it a little bit more lively. And so I do encourage you to come in if you would like to disagree, even, dare I say, with some of the panelists, or just simply to add as well. So Karim, I know obviously you're right now with the university here, but you also have a vast central banking background. You're a former practitioner as well, with a strong sort of macroeconomic policy background. So I would really like to hear from you, what can the bank and other MDBs do to help attract more private sector investment and capital into emerging markets? Again, taking a step back, looking at it from your vantage point as somebody who's worked in the system before and now would like to offer some advice from the outside in. So please, over to you.
Thank you. And a proud World Bank pensioner.
So some sort of private, sector flows from DC to Morocco.
Well, listening to our friend from Standard Chartered, so let's divorce. Let's divorce. Hearing, and it's not you, but you just echoed the mood, the zeitgeist of the day. Which is, the financial sector has a tendency to, behave like a herd. There are moods and fashion and, because it's reassuring. If we all go there, if you guys just stand up and all go in the corner of the room, I stay here, I'll go there too. So I think, and I'll come back to the theme of this. I'm saying this because, okay, this is the view, and let me simplify and we can discuss. This is the view of the North of, let's say, the financial condition of infrastructure investment in Africa, to simplify. Basel IV, it's too small, too risky, we have great projects elsewhere, etc., etc. Well, you should ask us what we think, no? And I'll go back to the theme. The world is changing. Let us remember China's investment in Africa. Now we have an experience of, let's say, in China itself and Africa and the world of, let's say, 20, 25 years of investing with a specific model. It had some results, it had some deficiencies. It's been evaluated by China itself, by Africa itself. And I think if we continue to have what in French they call the dialogue de sourds, it means dialogue of the deaf, we're not going to go very far. And I don't have much expectations from the private sector, and I shouldn't have, and you shouldn't have, because they behave in a certain set of incentives which are rational from their standpoint, but are not optimal from the standpoint of Africa and are not optimal from the standpoint of, and here this is Infra4dev organized by the bank, so not optimal from the standpoint of a cooperative that was created to, help the development of the world with values, with, a moral standpoint and view of the world, which is important. We shouldn't forget why the bank is here, why the United Nations were created. There's a view of the world there. It's politics. It's 1944. It's an idea of a global community living in peace and security with human rights, etc. Never forget this. I mean, even if you're doing, tough deals, business deals, but this is what you stand for. And I think, and I'll make the juncture with the current world where there is an emerging divide between a South, to simplify again here, and advanced economies, where geopolitically it has changed. I mean, today's world is certainly not the world 20 years ago. We have much more space, we have much more partners. So if the behavior continues to be what you described very well, what you didn't defend, but what you described very well, I think we're going to get organized differently. And it is starting, guys. I'm sure you have many examples. I just want to throw out you the creation of the funds in the Middle East targeting Africa. Okay, it's a response. I'm not saying it's perfect. You can say, well, I don't have the experience, But in 20 years, think 10, 20 years. It's going to get organized with or without the finance that is structured, organized for advanced economies. A new finance is going to emerge in the South. It's going to be, China did an attempt. It will improve. There are new players. Let me remind you of the projections for the size of the economies in 10 years, 20 years. The top 10 economies will be mostly in Asia. Many of the G7 countries today won't be in the top largest economies, and so on for the banks and et cetera, and the funding and the finance. So for you guys at the bank, this is the sort of the broad picture in a very short time we have here. But the background, the picture, the set of incentives, the mindset of the decision makers you will have in front of you will be very different. Unfortunately, our students are in exams, but I would have organized, a meeting with them, and you will see. They're not me, and they're not you. They have a different view of the world. They're freer. They're not very impressed by, the firms we would dream to work with, back in 20 years ago. So it's a different kind of world we're facing, and the topic of your conference is not sort of stranger to that. This is the environment you're operating with. Infrastructure investment is highly political. You said it. For Europe, it's a matter of strategic autonomy. To have a pipeline today, we've discovered it recently with the Ukraine situation. So where are your friends? Where are your friends? You need friends. Solar panel. How many thousands of hectares do you have in Europe available without the resistance of local populations? Zilch. How many windmills can you put in the countrysides of Europe without having resistance for environmentalists and local populations? Very little. We have hundreds of thousands of hectares available in Morocco for green hydrogen. And this is only Morocco. You can go elsewhere. All the Saharan desert, all the way from Morocco to Sudan, is available for, provided we fix the conditions, and they will be fixed one day. And you have many examples like this. Okay? This needs to be financed. Morocco has a project of a pipeline, all the way from West Africa, running through Morocco and running through Europe. These are the kind of projects we want to see. There's capital here, there's capital abroad, but this is not going to be done by the private sector, no way. So, as I said this morning, let us not forget, and I'll come back to the trust and the middle sort of organizing the market and why it's not working, but let us not forget the context. The context is of a changing world. It's a context where there are intense rivalries abroad. It's a context of competition. It's a context where populations are changing. They're freer. They're not going to wait. We're not going to be there to wait and read the Financial Times or The Economist to see what's the mood of the day in London on Wall Street. We're going to organize ourselves. This is what I teach to the students here. But with really no ideology, but with just a form of militancy, of pride, of sort of self-confidence in the future, but without being ideological or arrogant, or it's really what we call the New South. That's not, we don't want to fight, we love Europe, we love, the North, but at the same time, we want to have serious discussion. We can't be suspended to rules, to regulations where we're not consulted. The last point is industrial policy. The state is back everywhere. The state is back everywhere. We were not consulted for the huge subsidies program that are implemented in the US, that have been implemented in China for years, because coming from a low level of development would make sense. And the European reaction that is affecting the returns everywhere. It's affecting the risk ratio return. Don't tell me that there's an efficient market. Come on. It's full of governmental interventions. Okay, great, and I'm sure you referred to that. It has, it has distorted the risk-return ratio everywhere, like remember the central bank policies of the Fed and the ECB buying debt on private market has distorted the long-term curve, the rates of returns of long-term bonds. We were not consulted. It affects us, of course, because this is an arbitrage. So why should we all be on one of the variables that is being arbitrated all the time without having a stake into the discussion? And where we have a stake, Paul, it's here. It's with the bank. We're part of the cooperative. We're members, okay? So you have to listen to us. Yes, you have to listen to us. We don't have a share of Standard Chartered, but we have a share of the capital of the World Bank, of the IFC, of MIGA, and etc., etc. Not yet in the EIB. Soon, coming.
If I can...
But Morocco has a share of the EBRD. It was a smart move years ago when it was created. We have a small share of the capital of EBRD. I'm just joking, but really this is, I think they are fundamental structural changes. Don't forget this is about people. This is about the will of people. This is about culture. This is about, the transformation of societies. And until it happens, we think yesterday will be like today. But until it happens, and when it happens, these are critical junctures, these are changes of paradigms, and then we discover, oh, God damn it, the world has changed. So what we're saying here, because this is the research we do at this university and at the Policy Center for the New South, is trying to engage our partners to tell them, look, it is changing. We want a world with the values I described before, but you have to listen a little bit more and you have to adjust a little bit more, and particularly for international financial organizations. The private sector is a different thing. You don't expect much. They adjust to specific set of incentives and they are in their role. Okay? Many thanks.
Thank you, Karim. I think... So a clear takeaway on dialogue, and the good news is that we don't have to listen, we want to listen, right? And so especially for MDBs, and we have that built into our MDB platform. But I do think you raise an important point, which is that of partnerships and jointly forging, ideally, the future, because there is a risk that if you don't do this jointly, countries will go their own way with actors that you may or may not agree with. So I think this is an important aspect. So Caroline, let me turn to you a little bit, and you know, Karim and others have spoken about risk, right? Quite extensively. So my question to you is as follows. Risk is an important aspect of obviously managing risk and transferring risk, and how you deal with risk is an important aspect of attracting long-term financing. But we don't really have a series of risk players, or in particular the private sector, right, that are active in many of the emerging markets and developing economies. So can you tell me from your vantage point, again, from the bank perspective, where do you see sort of maximizing the role of risk mitigation product providers, and how do you see the bank, but also others stepping into this role?
Thanks a lot, Sebastian. First of all, I'm very appreciative of this opportunity, so thank you, and also to Stefan and the management of the bank and the university as well. So just to say that indeed the sentiment you have expressed was well reflected in the report, in the findings that came from the practitioners who responded to the survey that was behind the report. You know, they say that you know, the prominence of risk mitigation was not as strong as it would have been expected. And it does play a big role, especially in the kind of markets where we're looking to bring in more, you know, private sector participation, just given sort of the extent of the needs vis-a-vis the amount of funding out there, right? So just to say that, number one, I think it's very timely that you're talking about risk, particularly because I sit in a department of the bank that actually does look at risk mitigation. And I think in line with what has just been described by Karim, you know, a changing universe, and how can we think about, you know, a more systemic and programmatized approach to risk. You know, with the new administration at the bank, with the President Banga, we are going to see sort of a coming together under a unified guaranteed platform of the bank. So this is going to merge MEGA, which many of the participants know is a provider of both guarantees and political risk insurance products. And my group, which many, you know, participants as well know, that has been a provider of also guarantees, essentially payment guarantees at the project level, termination guarantees, and also risk mitigation for financial intermediaries. So from the perspective of the bank, we want to make it simpler, or let me say, when I say the bank, I mean the whole World Bank Group, which essentially involves the IFC that provides financing to private sector, IBRD and IDA, which you know are the World Bank, that provide financing to our shareholders, which is the governments, and then MEGA that I just described. So the idea is to have a sort of one-stop shop, or a one-shop front, where various participants in, you know, PPPs, project finance, infrastructure financing, go to seek a sort of comprehensive sort of risk mitigation solution to their, to their problems, rather than having to try and figure out who provides what. Because the way we have it now, we have many different products provided by these three institutions, and there are some overlaps, you know, between different products. So I think the unified guaranteed platform is going to be a fantastic way in which the World Bank Group is seeking to meet a very ambitious target of about 20 billion in terms of risk mitigation products provided in our emerging market clients, to bring in financing from private sector to really achieve their infrastructure goals. We know that in many of these countries, there's a huge population dividend, in the sense that there are very many young people. Many of them have had an opportunity to go to schools, they have good education. We are seeing schools, you know, such as this university coming up. So there's need to provide opportunities for these young people through jobs, and one of the ways in which to do this, obviously, is through infrastructure. I wanted to also reflect a little bit on some of the main risks that were mentioned at the report, Sebastian, as well. And in line with what has just been described by Karim, you know, we are seeing a lot of, let's say, pushback from our clients in terms of the currency in which our products are denominated. So increasingly, we are seeing a strong push to have local currency financing. And I'm sure Fatima is also seeing some of the sentiments coming through at the bank. So at the bank and even in the unified guaranteed platform, we're trying to think a little bit more creatively about how do we do things, how do we bring local currency financing solutions to our clients, especially because with COVID we have seen what the impact of currency devaluation has done in terms of the existing stock of debt and the obligations that countries had to meet and what it has done to their central fiscal. So there's a very, very strong pushback. Unfortunately, currently in many of our client countries, the hedging product. So typically in infrastructure projects, just because of where the market is today, a large part of, let's say, the input that is required for the contracts, is normally denominated in hard currency, primarily the US dollar. So you're talking about the material, the equipment, and some of the labor. And for that reason, most of the financiers, and most of these projects are financed mostly through debt. Most of the financiers provide their debt denominated in USD or Euro, and the same for equity. And this translates into huge, obligations on the side of both the governments and the users, because what happens is just to have a bankable, project as it is called, you'd have to have either the payment unit being in the same currency that has financed the contract or indexed to that currency. This is the only way that it is done today. And because of that reason, and because of the fact that these countries are really at the mercy of these exogenous shocks that then really drive up the stock of debt that they have in an environment where the resources are very scarce and the priorities are very great, products to mitigate that risk are not available, and if they are very expensive. The tenors are very short, yet these contracts are very long denominated, as we know. And then, we know that the financial markets in those countries are still evolving. So because of all of this, we have come up with some solutions for now that have worked very well in some projects we have done. And for example, we did a project in Cameroon where we financed quite a significant hydropower plant, which was very expensive, and which was financed both by hard currency debt and also local currency debt. And the only way we made the local currency debt work was to bring to bear our payment guarantee and to structure it in such a way that despite central bank limiting the maximum tenor that local lenders can provide, that they can denominate their debt into around 6 to 7 years, and yet you're looking at a contract exposure of 25 years, we are able to, at the end of every 6 to 7 years, we're able to extend the tenor by another 6 to 7 years through structuring it to ensure that we have a sort of put-call option that we can stand behind. And this did two things. So it brought in quite a bit of local currency financing to the project, and it also provided confidence to the commercial banks that in the event, for whatever reason, the put-call option that they have to government to buy out their debt at those 6, 7 years is not honored, and they have to meet their central banking obligations, the World Bank can come in to ensure that that financing is provided. So that's one of the examples of projects we have done. And then even from the perspective of our funded products, because guarantees are not funded, they're off balance sheet. But our funded products, with their creative ways in which our treasury has been able to get financing, our IDA financing, which is very concessional, has got a long grace period, is quite affordable to countries, to ring-fence it in certain escrow accounts that then allows governments to approach commercial markets and get sustainability bonds backstopped by the funds that we have ring-fenced. And that has really been able to bring, at the sovereign level, affordable, local currency-denominated funding to countries that has been very important to meet their local needs, and also, just to help the market grow, to deepen it. So those are some of the solutions that we have done. We also have some synthetic debt solutions that we ourselves at IDA and IBRD are providing, as well as our counterparts at IFC. So just to say that, local currency risk is real. It was very real during the crisis. It remains real, and we are still finding creative ways to resolve it. Thank you.
Thank you, Caroline, and also thank you for plugging tomorrow's session on FX risk and its impact on infrastructure finance. So that's great. I'm going to do one round of questions still, but I'd really like all the panelists to be as succinct and short as possible. Really aim for 2-minute answers, and the reason is we don't. It's not that we don't want to hear from you. It's that I would like to open up the floor to Q&A. I'm sure that the audience has a lot of questions for you as well, and I'd prefer that sort of dynamic interaction. So Fatima, I'll start off with you. Very briefly, there is no shortage of sort of a wish for transformational projects in emerging markets and developing countries. Think of here in Tunisia, next door in Tunisia, you have a cable that's being laid, undersea cable, to transmit some of the renewable energy to Europe. You have the Lobato corridor in the south of Africa, and many other projects really that could be game changers in many ways and in different ways. Can you tell me what are some of the constraints that you see, again, as a commercial lender, for you to step in and to support these kind of transformational projects that could really make a big difference here on the African continent, but elsewhere in emerging markets? Thank you.
I guess it comes back to bankability. That's not to say that there are not instruments that can make a project bankable, and you know, a lot of the things that Caroline outlined are exactly what we need to be able to support those financings. We are doing actually quite a lot of those transformational projects through supporting some of the contractors who are working on those projects. So there's actually a very active export credit agency funding angle that a lot of banks are working alongside ECAs to provide projects which maybe on a standalone basis may be more difficult to get banks comfortable about the viability, but where it's effectively being backstopped by a government, and usually these projects are on the government's balance sheet, and clearly that's not sustainable over the long term, which is why PPP is important, and which is why sort of blended finance initiatives and collaborations are important. I think, just to defend myself from Kareem's earlier comments, we're not taking a hard-nosed approach that we don't want to support these projects. On the contrary, we want to find ways to support those projects, but it's got to be in a collaborative manner, which is why innovative thinking around risk sharing, foreign currency mitigation, so important for the viability of a project over the long term. So transformative projects is something that actually both the private sector and the public sector see the value of doing. It's really about how can we find a way of working and supporting those projects rather than the conventional non-recourse project finance. It's about blended finance. It's about bringing all the pockets of liquidity together and thinking about tail risk. And maybe it's just bespoke structuring to deal with specific tail risk events. That may be enough to catalyze that private sector investment in some of these projects.
Fantastic. So Kareem, before we go into divorce, as you had mentioned earlier, I think maybe we need some marriage counseling first, right? So that we get back to the dialogue and very good. Thank you so much. So Joyce, to you, the question as follows. Ever since I've been in development and sort of looking at finance and infrastructure, there's always been this holy grail of saying there are these trillions of dollars on the sidelines by institutional investors, right? That have these long-term sort of money that is just sitting by the sideline and is just waiting to be released and you know, flood into emerging markets to fund all of the infrastructure gaps that we are so familiar with. So again, from EIB, I know that you also take a long-term perspective. You work with institutional investors. What can MDBs such as ours, what do we need to do a little bit better to help crowd in some of these resources, this investment from institutional investors, so this long-term capital into, again, EMDEs?
Yes, thank you, Sebastian. And perhaps before answering your question, I would just like to go back to the example that you gave about the ELMED interconnector between Tunisia and Italy. So this is exactly the type of transformative project that was possible because of the crisis that happened. So because of this crisis and the fact that the EU realized that energy of supply, security of supply is crucial, there was a decision for an allocation of 300 million euros by the CEF, an EU fund, in grant fund to support the project. And this has helped the three institutions present here, so the World Bank, EBRD, and EIB, to co-finance the project together with KfW. So this is very an example of this major project that can happen when all IFIs work together with a clear direction also coming from entities such as the EU. Then answering your question with regards to what can be done by MDBs to mobilize these funds that are available. I mean, clearly we have to see that there is an appetite also from those investors to support impact type of investment and investment that are in line with the environmental and social requirements that we see. So in this respect, I think one of the changes that we can bring is, for example, an initiative that also we are now jointly working on with the partners that I have mentioned and with the EU, is the Global Green Bond Initiative that you may have heard of. So this is an initiative where we will be helping issuers from EMDEs to prepare projects that comply with all those requirements and will be able to attract funding directly on the markets to support green projects that would help in this objective. So I think typically this type of intervention that bring together both guarantees, funds, and also the project preparation facilities that we have discussed, the capacity building that we have mentioned also to help issuers bring all the taxonomy that they need in order to implement those projects would be critical. And absolutely, we have to have a positive mindset. I fully agree on that. Thank you very much.
Thank you so much. Karim, help me solve a conundrum.
No, I mean, the solutions we have. I mean, you gave examples of squeezing banks' capital in all ways, so to extract the maximum of it. You've gave examples, the Tunisian example. We have the solution. It's difficult because it's multiple actors. They're very sort of specific to every country. There's not sort of a blanket approach to those solutions. But there are ideas and solutions, and you said, I mean, that you need sort of guarantor of last resort, and that's the role of the bank and those institutions. So we have the ingredients. What I'm worried is that we don't necessarily have the political sort of impetus for the technical staff to do that. This is what I said. This is, we all have an analytical mind and a transactional mind, and we tend to sort of be on one side or another. So the beauty of those institutions that they are both they stand on both feet. But and I think there's the issue of increasing it's not the topic of today, but increasing the capital of the bank at some point, it will be a question. And we are observing that. So, and it's in the hands of advanced economies, and particularly one country. And this is our institution as well. It's important for us. We don't want it to be hostage of rivalries. It's important for us that we like the bank in Africa. It's useful. In Morocco, they like the bank. We have our friend from the central bank here. He likes it. It increased the reserves. It's good. He likes that. We squeeze the maximum and then we go to the market. That's the mindset. You get as much as you can and you. So I'm saying there are the solutions, but it's difficult. It's maybe a different way of working. It's country specific. It will take much more from the staff. It will take a different set of incentive inside, but the most valuable contribution, as I said this morning, is the trust that this institution can bring, and with trust comes a reduction in risk. The financial folklore and art we have, you guys are, it's unlimited what we can invent in terms of there are some limits like Basel, but you're always a step ahead. So let's put this imagination and this creativity at the service of development. And I think the moment is right. The moment there is a demand. I can tell you, we speak to many colleagues and friends on the continent. There is a demand for that. So the moment shouldn't be missed. We don't have time to go into also some fundamental structural transformations like demographics, it was said, but this is very profound. It changes our relation with advanced economies. At the university today, we meet many partners, other universities. They want to take our students. They don't have any more students. Their discussion to organize by state policies the brain drain. It's been subsidized by governments, you know, semi-skilled workers. Today's Moroccan doctors are learning German. They're learning to become medical doctors, and at the same time they're learning German, because there's a huge demand in Germany for medical professionals. So it is one word. It is, you know, and it's not immune from this topic of infrastructure. Let us keep this in mind. So it's a whole sort of, you know, complex interactions, and it's at the heart of it, it's the development of Africa, which will solve a lot of those issues and also pacify the internal fronts of societies in Europe that are, you know, sort of a bit scared of migration. And so I think the mission here is very broad. No? It's just not, let's just finance a road here and a port there.
Thank you. So Caroline, I think we've reached not a Washington, but a Rabat consensus here, right? Among lenders and policymakers on how to move this infrastructure finance agenda forward. So now all we need are bankable projects, right? To invest in, right? Now, we all know that, unfortunately, there is still a dearth of bankable, shovel-ready projects for the making. So tell me, from your vantage point, what needs to be done? What do we need to do to unlock this potential?
Right. So, yeah, I agree with everything that has been said now, and I think it has been a good lead-up to this particular question. There was a very interesting panel discussion just before we came, and I know we're short of time, that talked about how do we do project development in a way that gives us good pipelines of projects that can be financeable. So where I sit, I want to say two things. And first of all, I want to pick up on something that Karim has said. It is one world today. And our governments, including, you know, our client governments, need to be aware of this. We're all competing for the same capital. And this is also to echo something that Fatima said, right? Interestingly, even where there may be opportunities to get concessional capital, like for example from the West, we are also competing with them for concessional capital. We saw that the US just has the 600 billion Inflation Reduction Act. Europe had, no, US I think was, no, it was less. It was maybe 300 and something billion. Europe has 600 billion. So a lot of equity has gone there and debt will follow. So I think governments, our governments, we cannot belabor this point enough. We are competing with everyone else. When we are developing these projects, we have to work with the end in mind, ultimately. So we have to think about how we procure the projects in a way that is going to withstand scrutiny. That means working backwards and ensuring that the institutions, the regulations, the policies can't stand master, that there's trust built in those particular markets. And ultimately, the way projects are prioritized and originated means that this project should be credible and will transcend different political administrations. And at the end of the day, we have to think in terms of how are the financiers going to think, the equity investors, the bankers, what sort of risk mitigation products can we offer from the beginning? And then we have a blended way of approaching these solutions and collaborating all of us so that there's a win-win approach. Thank you.
Thank you so much. So why don't we open things up for, we have about just over 10 minutes left, so why don't we open things up for question and answer. If I can ask everyone to please identify yourself and then ask a question. If you could direct it towards a panelist, that would be helpful as well, or to everyone is fine too. So with that, any questions, please? Everybody's thirsty. Oh, I have two hands up here, so. I think Vivian was first and then Astrid.
Thanks very much. It's been a really fascinating discussion. We've long been, hearing about the idea of infrastructure as an asset class, and this morning it was, highlighted that that's been elusive. Why is it so elusive, and would it really make a difference, and what needs to be done?
We'll take 2 questions and then we will come to the panel. So Astrid, would you like to follow that?
My question is to Standard Chartered. An interesting panel discussion. I think in my books there's a lot of perceived risk also still being priced into emerging markets, because when you compare, opportunities in the subsidized OECD markets versus emerging markets, infrastructure is infrastructure, and I think the data that is available, for example, the Moody's 2009 study showed that actually the average infrastructure rating in emerging markets is somewhere in the BBB- area, so even investment grade. So what, from your perspective, do you need as a private investor to overcome that, in my view, irrational perceived risk? The World Bank is already making more data available. I think there's finally commitment to make more GEMS data available. And is that not a way to help you overcome some of the hurdles that may be a little bit artificial after all? Thank you.
So why don't we start off with the question on the asset class. Anyone want to take a first crack at that? No? Any? Caroline, please.
I can try. I'm not sure I'm going to be able to respond, comprehensively, but many times, particularly when we approach investors, domestic investors in particular, and even international investors. Okay, let me start with the domestic investors. In many of our client countries, there's still a lot of hesitation because of the perception of infrastructure, particularly when they're packaged as project finance as being very complex. So there's that challenge of complexity, and now behind that complexity just means that they're unable to even properly diligence the project to price them. And also behind them, we find that regulators are very limiting insofar as the allocations that they can allow both private equity and also institutional investors like pension funds and insurance funds to invest in infrastructure as an asset class, which is a little bit inimical if you think about it. It's a little curious because at the end of the day, we know that when these assets have been de-risked, meaning that they have been constructed and they are operational, they are fairly low risk insofar as, the sort of cash richness is concerned. So I think there's a little bit of a mental hurdle that needs to be overcome, especially in developing countries. And I have personally been privy to some of these conversations. What we have seen with respect to international investors, when we talk about emerging market infrastructure risk, one of the problems they face is also related to the packaging as project finance, because what they like very standardized approaches. They like the same contract, simplified, standardized, the same thing. So for them it's, this is our hurdle rate, this is the allowed minimum risk I can take. The contract has to be standard, this is the way it's wrapped and all of that. And the challenge with project finance, it is very bespoke, it is very structured. So that is just something that it's a stage we have not arrived at yet.
Just to add, I think we are seeing a lot of appetite, particularly from institutional investors, asset managers, for good quality long-term infrastructure assets. And you're seeing a lot of deal activity, not necessarily in widely in the emerging and developing economies, but certainly in where you can get a investment grade rating. There's a lot of capital, institutional investor capital, looking exactly for that long-term stable yield that you can get from infrastructure assets. And our goal really, just touching on the point around pricing and perceived risk in pricing some of these infrastructure assets in emerging economies. I agree that, there's a huge gap in pricing between emerging, particularly the lower income country assets versus developed market. It's multiples when you look at actual interest charges across the projects. The issue is there are bumps along the road. That you may not have losses, and I think the Moody's data and data around defaults actually holds up really well for developing economies, really does. But that's thanks actually to the way those projects also are structured to deal with short-term liquidity issues. a lot of the projects that we do in Africa for infrastructure has partnerships with the World Bank through the PRG product or Africa Development Bank. But those instruments are exactly what we need, because what that does is help those projects sustain, perhaps if there are short-term blips, liquidity issues, without those projects going into default. If we could get the rating agencies to see that, that would be great, because what's holding back that institutional investor demand for infrastructure assets, which we're seeing deployed in developing economies hugely, is if they can get an investment grade rating. And it's one of the things, again, I know there's a lot of work happening, certainly with the MEGA team in conversations we've had and other parts of the World Bank around what kind of instruments, structures can go hand in hand with the financing that would allow those projects to be seen as investment grade, because that will unlock a huge amount of liquidity if we can get that kind of rating treatment. Right now, country ceiling determines, unfortunately, the rating of a project. So it's quite challenging to get piercing above country ceiling for a lot of projects. We do apply that treatment for a lot of projects where we have specific instruments like a PRG that's part, and a liquidity line that's part of a financing. We're allowed to pierce the sovereign ceiling, but that's not consistently applied by banks across the board. And certainly if rating agencies start seeing that and apply that approach, I think that again will be a huge opener for liquidity from other investors.
And in fact, Vivian, there's this private sector investment lab that you may have read about that has been established precisely to foster this dialogue between sort of financial sector institutions, the bank, and to see how we can develop some future financial solutions to crowd in some of that private sector capital and help de-risk some of the projects. I think the guarantee platform that'll be housed in MEGA is just a very first step, and I think you'll see more innovations coming in the very near short term. Fatima, there was also a question by Astrid on how Standard Chartered, could sort of further come in, and what comfort the World Bank and others might be able to provide a little bit more.
So I think I addressed some of that, Astrid, right? Certainly I think it's the guarantee products that where we can then use as a means of piercing sovereign ceiling, because the way that the risk-weighted capital treatment works and our scorecards work in terms of capital allocation is all around the risk rating, and unfortunately there's just a huge gap between sovereign ratings in the developed world versus the emerging markets.
Thank you. Any other questions, please, for our panelists? I guess that means that everyone, yep, Dimitris, please. One last question before we break for coffee or drinks, I hope.
So the question I have is, and I appreciate what Karim said about the fact that infrastructure investments are always a bit political. Do you see any effort from the central banks to look at infrastructure investments in a different way? There's a lot of conversations, and we see central banks sometimes doing credit lines for SMEs, refinancing facilities for SMEs. When it comes to infrastructure, even though you have to look at assets that are very long-term, in many cases they can help with green development. Do you see any new thinking, especially in the global south, on how central banks look at financing for infrastructure? Thank you.
I don't think so. This is very foreign to the culture of central bank. This is a slippery slope. There will be lots of resistance from those institutions. In some countries you may have, but I wouldn't recommend it. But I have a proposal for you. And we've written a paper on that. The title of the paper is Why the World Needs a Green Bank. So rather than trying to have the private sector at the project level, create a bank with the private sector and have them in the capital. You know, you can have the majority, but you have them with you on capital, and then they do business with you. Create a bank, you know, dedicated to infra and green finance. There's a paper on our website, policycenter.ma, on that, and we have advocate for the creation of a green bank. Sorry for our friends at the World Bank. We said they can't do, they're not sort of organized to finance green, the green transition. So we advocate to have something, you know, dedicated to that with the international financial institution in the capital, but also the private sector there, together, in the board, in the capital. That's, you know.
On my side, yeah. I mean, I see your point, but it would be, you know, diverging from their mission, the core mission of the central bank. So we don't see such a trend taking place.
The core mission in ECB is changing already.
Yes, but I would say not to that respect. I mean, I would say that, okay, as EIB, for example, now we have a new program that is working closely with the central banks on greening financial systems. So, for example, to help central banks and also commercial banks support better, you know, all the green projects. So this is indeed growing, but I wouldn't say really going towards infra as described, but yeah, indeed, the role is changing, but not to, I would say, to that extent.
And if I'm not mistaken, even the EIB's new moniker is the Europe's Green Bank, if I'm not mistaken. So
yes,
building on what Karim is saying, and even the bank and World Bank and others are also taking on
yes,
this.
So we don't have the private sector, obviously, in the capital, but the EIB, we try to be the climate bank. Now we have an objective of 50% of our funding for climate projects. So this has been quite a substantial shift that we have done over the last years, and that is translated on the ground.
It's a very interesting model, by the way.
Yep.
It's an interesting model, European model, but very interesting in terms of, you know, helping.
Could use your microphone.
Countries to catch up.
Bon.
I'm saying I like the model. The EIB is an interesting model. It's a very interesting model that it's, of course, a public, you know, it's an intergovernmental institution, but it's a very interesting model, and that has delivered for Europe, for, you know, all the catching up of Western Europe and countries like Spain and Greece. And I mean, in terms of financing infrastructure, European funds, it's an interesting model as well.
Yeah, absolutely. I mean, it was the model of the Marshall Plan, so it was really super ambitious and indeed quite a strong delivery as well outside the EU.
So with this, I will end it. As a referee, I've added 3 minutes of extra time, so I hope you will forgive me. But I did want to respect, you know, this excellent back and forth and allow you to ask questions and then hear our panelists' answers. So with that, Fatima, Joyce, Karim, Caroline, thank you so much for taking time, and enjoy the well-deserved applause. Thank you so much, everyone. Have a good evening. Thank you. Aaron, any last-minute administrative?
1 or 2 little announcements. So. Okay, thank you, everyone, for a great day. Congratulations. You made it through day 1. A couple of quick announcements. So on your way out, feel free to grab a snack or a water or something on your way out. For panelists and speakers who are coming to the dinner this evening, please join us at the gate at 6:30 to get a ride. And then tomorrow, our keynote speaker from the University of Chicago will start at 9:30, and coffee will be available beforehand. So we'll see you all again tomorrow. Thank you.
Sebastian, sorry. That's right. It's all good. I get it all the time.
very complicated.
Well done. Even if you're under a bit of fire, but well done. I was hoping to, right? But you don't.